Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
As we are seeing deals materialize, I think the market will pivot more towards growth.
U.S. assets are still a safe haven.
The net trend is pretty strong. The challenge is looking forward.
The economy's still hanging in there in terms of the hard data.
We have momentum going into a difficult period, and the question just is, will this momentum be strong enough to get us through it?
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
There is some resilience in the U.S. economy. The payrolls report on Friday certainly speaks to that going into the weekend as we kick off a brand new trading week. Good morning to you all. The third hour of Bloomberg Surveillance starts right now, and your scores look like this, with equity futures on the S&P down by 0.8%. On the NASDAQ 100, we're down by 1 full percentage point, following quite a run on the S&P. 9 consecutive days of gains and up 10% over the period, the best run we've seen on a daily basis going back to 2004. In the bond market, 2-year, 10-year, 30-year, just a bit of quiet. Yields are down by 3 basis points on a 2-year, 3.79. Better data on Friday, unlocking higher bond yields going into the Federal Reserve meeting this coming Wednesday. Chairman Powell taking center stage, and the pressure once again building from the White House.
Pressure's building from the White House. You see the job voting once again over the weekend from the president, but he did say that this is a Fed that is stubborn, and he doesn't think they're going to move very quickly, but in a year he can replace him. So at the moment, we don't have to worry about a termination of Jay Powell. Tricky moment for the Fed, because the market is still trying to digest where policy is going. Trade deals, which one will we get? Potentially we're going to get one this week. Who will it be with? And then, of course, the lingering, more important trade deal is going to be with China. At the moment, the president says him and Xi Jinping will not talk this week, but he says that those rates are coming down. But coming down, Jonathan, to where?
It's difficult to provide an outlook at this point, particularly for the Federal Reserve. I'd go back to the speech that was delivered from the governor of the Federal Reserve, Chris Waller, and what he said in the middle of last month, a tale of two outlooks. And maybe they'll offer multiple scenarios. Maybe they will. And for that reason, I think for a lot of you, the most important testimony this week might come from the Treasury Secretary, Scott Bessent. Just how close are we to those deals? And please, define what those deals might look like. What do they include?
Well, I think you've been hitting the nail on the head all week and last week when you were talking about the fact that these are likely going to be purchase agreements. We already saw the Europeans come out and they're saying we're looking at buying 50 billion euros worth of goods. If this is agricultural products, soybeans, LNG coming from the United States. We know this president hates MOUs. He made it very clear in the first administration to Ambassador Lighthizer, never use that term. So it might be purchase agreements. It might be tiny deals, because to have a proper trade agreement, that can be months or years down the road.
The president's getting one thing he was looking for. Crude, lower, down again today. We're down by 1.5%, $57.40. You're getting the same emails we're all getting. Can you find gas for $1.98 anywhere in the United States?
I'm not unclear what the president is talking about when he says he sees gasoline at $1.98. When I checked over the weekend, AAA, I believe it's a little bit above $3 when you look at the national average. Maybe there's this one gas station in Florida he passes that has $1.98. Maybe he's looking at the wholesale prices. I'm still trying to understand from this White House where, in fact, in America is there gasoline for $1.98. Let me know. I'm going to go tell my parents this when they should go buy gas.
The good news is that either way, crude is lower. We're down by 1% this morning and down by something like 20% so far year to date. Coming up this hour, we'll catch up with Stephanie Lang of Holmberg Berg after stocks complete a major turnaround. We'll catch up with Dana Taussig of the Taussig Advisory Group as Trump's tariffs hit supply chains, and Erin McLaughlin of the Conference Board on the importance of a China trade deal. We begin this hour with stocks lower after erasing post-April 2nd losses. Stephanie Lang of Holmberg Berg writing, we're on borrowed time before the tariffs have a material impact on the broader economy. Stephanie joins us now for more. Stephanie, welcome to the program. Let's get straight to it. I want to pick up on that line. I think it's really important. We've heard from several economists that maybe last month's payrolls report was the last good one. Do you think the weakness could appear as soon as this month, as soon as next month?
Well, I think we probably have a little more time than that, but the essence is we are on borrowed time. We've had some pull forward of activity in terms of the consumer, businesses trying to get ahead of the tariffs, but eventually that's going to play out, and we know it. It's just a matter of how soon will we see it, and that's what we're concerned about in terms of how this will eventually play out unless we start getting some deals on the tariffs.
Stephanie, as you know, at the index level, we've seen a total turnaround for the equity market. Are there certain areas of the market where you think there's more capacity to absorb negative news if we do indeed get some through the summer?
Well, I think, in terms of the sectors of the market, there are some more resilient ones. Of course, we've seen in the earnings reports, retail, travel really getting hit. So I think it makes sense to be a little more defensive at this point because we have so much uncertainty. Of course, consumer staples have been really strong, but they have high valuations, and healthcare is something that we're a little more bullish on, given that it's had tremendous earnings growth, and you also have some lower valuations there.
When it comes to the expectation for trade policy, you say we're on borrowed time, but are you seeing impact that the damage is already done right now, even though we're in the middle of this reprieve from the White House?
Well, I don't think we've seen the damage yet. You just start seeing it from the CEO sentiment data, which essentially, if you look at what they're saying, is that they aren't going to hire as quickly, that they aren't going to have the CapEx, and the consumers are in the same spot. Maybe they'll put off on that home renovation or those big purchases. But just last week, Apple said that they expect $900 billion in costs added because of tariffs. So it's an expectation that's coming on, and we're starting to see it in terms of earnings estimates moving forward. While this quarter has been quite strong in terms of where earnings have ultimately come in, if you look out the next several quarters, we are starting to see estimates come down. And ultimately, we were at 15% in terms of earning growth for 2025. We're back at 10, which we still think is pretty good, but we expect it to come down if we don't see some resolution on the trade front.
How important, then, is it for the administration to push forward the other agenda items when you look at the policy perspective of the administration, meaning deregulation and the tax cuts or tax extension?
That's exactly right. The sequencing of the policies from Trump this year, we've essentially gotten all the drag on growth policy through tariffs, and we haven't gotten any of the pro-growth measures through the tax cuts and deregulation. In fact, deregulation was supposed to be a big spur to growth this year, and actually it's been quite the opposite. We're not seeing any deals coming through. So essentially, we're getting all the spinach with no dessert so far this year. And so it's critically important not only to see what this tax bill can do to spur growth, but really help that sentiment from both the consumers and the CEOs, that they can settle down and feel a little better about the trajectory of the economy and really start, hiring, don't put off the spending, and that would really help things looking forward in terms of the trajectory of the U.S. economy.
Stephanie, just out of interest, what would you like to see in the bill beyond just extending current law?
Well, I'd like to see, some of this deregulation come through, and that's, been a big part of what we thought would spur the market. It's been the exact opposite. So we need some new measures in there in terms of, what can be pro-growth, not just an extension of the tax cuts. So deregulation, maybe some additional tax cuts that we weren't going to see. But of course, how are we going to pay for it? And that's what's really going to be the big negotiating front in Congress in terms of how we're going to get to the final bill.
Could define the rest of this year. Stephanie, appreciate your time. As always, Stephanie Lang there of Homrich Berg. Stephanie, thank you. This is the challenge in the second half of the year. Extending current law plus what? And it's the plus what that we're still wrestling with.
Well, the Treasury Secretary seems to think that they're going to get everything Trump pretty much promised on the campaign trail. No tax on tips, no tax on Social Security. I would say look to what's happening in Congress, the factions that are building, and these slim majorities you have in the Senate and the House. How do you get all these individuals on board, especially leading up to the midterm elections? Speaker Johnson, or maybe Speaker Donald Trump, will be herding cats when it comes to getting this bill across the finish line.
Can we call them the SALT lobby? Just how strong is the SALT lobby right now?
It's pretty big. They can tank the bill if they want, and they're pushing for a minimum 20, 25K when it comes to SALT. And we should remind the president he came to places like Nassau County in New York, where he did not have to go out on the campaign trail and promise to lift the SALT cap.
That's the trade story plus the tax story for later this year, and the reason why a lot of people are still unsure about the next 12 months or so. Equity futures on the S&P 500 negative here by 0.8% on the S&P, following what has been a stellar run in this equity market. With the latest on news elsewhere with your Bloomberg Brief, here's Yahara. Hey, Yahara.
Hi, John. Israel is promising a harsh response to a missile strike by Houthi militants that penetrated its aerial defenses and struck near an airport. Prime Minister Benjamin Netanyahu responded on X, saying Israel will respond to the Houthi attack against our main airport and at a time and place of our choosing. Taiwan's dollar surged by the most in over 3 decades on speculation exporters are rushing to convert their holdings of U.S. dollars to the island's currency. Traders are betting that Taiwan's central bank may be allowing the currency to appreciate ahead of a U.S.-Taiwan trade deal. And Disney's Thunderbolts debuted at #1 at the weekend box office. According to ComScore, the superhero film grossed $76 million in U.S. and Canadian theaters. So far this year, box office sales are up 167% from the same time last year, according to ComScore. That's your Bloomberg Brief. John?
Yahara, thank you. Maybe it's me, but I thought the movies were pretty terrible so far this year, no?
I don't think I've seen any new movies this year.
Wait for Mission Impossible, the new Formula 1 movie. I think all of that coming out in the next month or so, so stay tuned. You haven't been to the movies, have you?
I still haven't been since the pandemic.
So for like 5 years?
Yeah.
Okay. You worried about the pandemic still?
No, no one's invited me.
Okay. We'll go. As a team, we'll hold your hand. Get you into a movie theatre. Equity futures right now in the S&P, negative by 0.75%. Up next, the morning calls. Plus, Dana Telsey of the Telsey Advisory Group as Trump's tariffs hit supply chains. From New York, this is Bloomberg.
Brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
The opening bell is 1 hour and about 16 minutes away, and equity futures going into it look like this on the S&P 500, pulling back just a touch. We're down by 0.75%. On the Nasdaq, we're down by 0.9%, following a stellar run of gains on the S&P 500, a run over 9 sessions, a move of more than 10% on the S&P 500, and totally erasing the losses since April 2nd. Confidence that maybe these sides can come to a table and strike a trade deal. The president talking up the chances again over the weekend.
So we're talking about the chances, and I think there's a lot of smoke signals out there, Jonathan, for there to be deals with trading partners that are allies. The big question, though, that everyone wants to know, whether you're a small business or you're a financial investor advisor, what is happening with China? The president said those rates are going to come down. Right now, it's 145%. You also see China going through third countries, washing out goods, selling to third countries, and those countries selling to the United States on a lower tariff basis. They also want an agreement. You've seen an olive branch, but what rate do they settle on? That is the big question.
TK used to say on the show all the time that corporate America companies can adjust and adapt. They can adjust and adapt, but to what? They need to understand to what. Give us a level, give us the law of the land, and then we'll adjust and adapt. But in the meantime, they're in wait-and-see mode, waiting and seeing what will the outcome be from these negotiations.
What else can you do if you wait, besides wait and see? You don't have the rules of the road just yet. The president is in negotiating mode. He's talked about this. He's taking a maximalist approach to get to the best deal at the table. Strategic uncertainty, this idea of game theory. What else are you supposed to do? You have to wait for the White House to let you know where you're going. But you do know the direction of travel, and it's down.
And that can trigger a period of economic weakness. That's the risk for the next several weeks, the next several months maybe, through the summer, depending on what the outcome of these negotiations will actually be. Equities right now in the S&P negative by 0.8%. That's the price action. Your morning calls look like this. First up, Barclays cutting its price target on Exxon to 127, saying it's, quote, staying the course despite macro uncertainties. That name is down by 0.8%. Your second call from JP Morgan cutting its price target on Nike to 56, citing more price cuts and elevated inventory. We'll talk about the inventory story in just a moment. Nike's down by 1%. And your third and final call from the team at Bernstein cutting its price target on Target to 97, expecting negative consumer sentiment and boycott headwinds to weigh on traffic. Target is down by 0.4%. Sticking with the consumer, retailers preparing to raise prices as supply chains take a hit.
Retailers are saying we've got about 5 to 7 weeks of normal inventory in the country right now. Then we start to see spot shortages if it goes on much beyond this. Retailers are telling me that realistically, with even the 10%, I'm going to have to pass it on to the consumers.
Dana Towsey, the Towsey Advisory Group, writing the following: there appears to be a pull forward of demand and higher prices are coming, which is likely to negatively impact demand more broadly. Dana joins us now for more. Dana, good morning. Good to see you.
Good morning. Nice to see you.
The inventory story. Let's just sit on that for a moment. What does it look like? What are you monitoring across retail specifically?
It's very murky out there. I mean, definitely retailers have to bring in inventory early in order to have the lowest cost inventory. This 90-day reprieve, what happens in early July, is going to be the big question mark. Goods need to be ordered, frankly, now and through the next 4 or 5 weeks for the holiday season. So retailers have to place their bets in terms of what they're going to do. And we've seen it in some instances where we're still early in the earnings reporting season, but some have already pulled forward some demand. Five Below was a surprise on Friday, better than expected same-store sales that they delivered. You look at companies like Primark, which is a value retailer with only around 30 stores in the U.S. from the U.K. They're talking about the fact that even prices on items that are below $10 would need to be raised 40% plus with these tariffs.
Target's an interesting company to follow here. They've stepped on a couple of inventory landmines. There was a pull forward, then they had too much. Do you think they've been scarred by that going into this episode? Could we see the repeat of a mistake, but maybe the reverse of the mistake, not having enough?
It all depends on the categories, and retailers are going to bring in goods early because it'll be lower cost goods. We began to see in what we track on inventory levels, we began to see a pickup in the fourth quarter of inventory. As these first quarter numbers are reported, I expect to see inventories increase again. Keep in mind, there's no China like China. For footwear and many of the apparel items, you can go to Bangladesh, you can go to India, you can go to South America, but the ability to source what you need fast and with the expertise, you don't just change factories in a day.
Who is better placed? Obviously, it's the big retailers, who we also know seem to have some imprint and impact on the president when they went to the Oval Office and said, we do not want empty shelves, and almost painted this very dire picture of what we could see in the coming months. But out of the big names, who is best placed for what we're dealing with right now?
In some of the names overall, and just even specialty names, Birkenstock, which manufactures their goods in Germany, the cork in Portugal, Bath & Body Works, they have around 80% of their goods that's manufactured in North America, so they have some advantages that way. I take a look at other names out there where what else is changing. I mean, even a Tapestry has a low percentage coming from China, not as big as it had been in the past. All of the apparel retailers have diversified their sourcing, but you're looking at consumer electronics, you're looking at dollar stores, and footwear, where you're going to have some of the biggest impacts.
I wanted to ask you about Temu, because they're halting shipping directly from China because of what's going on with de minimis. Where are small businesses, consumers going to get goods like that?
Very challenging in terms of where they're going to get goods like that. I think one of the things you could see happen, you could see some of the resale shops, you could see some of the vintage shops turn up and be very popular given where they get their goods from. The ThredUps of the world, the Real Reals of the world, resale can become very popular during this time period.
Who's got pricing power at the moment?
Some of the brand leaders. I think the pricing power is coming from the Ralph Laurens of the world. I think you're seeing pricing power. For example, it's some of the other brand leaders like a Birkenstock. That's where your pricing power is coming from. You look at luxury brands, LVMH took up the price of their Never Full tote last week, just under 5%. We have a weekly price tracker that we're issuing every Tuesday, given price of 80 items that are iconic items that we monitor every week.
There's only one LVMH. Chanel can maybe do the same thing. Who's struggling to do just that? What's the dispersion like within luxury?
I think within luxury, Chanel is one of the ones that has a harder time in terms of raising prices. Certainly you're not seeing on aspirational luxury, Michael Kors doesn't have the pricing power anymore.
Well, when it comes to raising those prices, though, the luxury players are really in a category of their own.
Yes.
What about the middle luxury market? How challenging is it going to be for them?
It is challenging for them. You look at some of the mid-tier luxury markets, look what we just mentioned with Michael Kors, that definitely is a challenge. They're going to have to watch their prices carefully because there's a trade down happening all over the place. You look at what Doug McMillon of Walmart said, his biggest growth is coming from higher income customers for them, which are nearly six-figure customers.
If some of these brands are going to be struggling to pass on the cost, do you think is a moment now that's ripe we see consolidation in the retail industry?
You're not seeing consolidation yet. I mean, you've seen some sales. You look at Caleres bought Stuart Weitzman over from Tapestry. You look at Versace was just sold also. But of the others, I mean, I think there's more of, is there going to be a watch list? And right now, the watch list is slim. But people are watching companies that have to refinance some of their debt, like Kohl's.
Can we mention one luxury brand you didn't mention?
Yep.
Gucci, Kering. What's going on?
Not good. I mean, you look at Gucci and Saint Laurent business has been very weak lately. New designers taking over. Their product won't be shown till later. It gives other luxury brands an opportunity to take share. And you look at those other luxury brands, it will be the Pradas. It can be the Hermes at the very upper end, but the Brunello Cucinellis is still very different than others.
How dependent were these companies, some of them, on the buy now, pay later explosion that we saw over the last several years? Because I've been looking at the recent buy now, pay later data, and it's pretty sad to see what's happening there. Yep. You're seeing missed payments, you're seeing a bigger allocation go towards groceries. I think people are really missing a story that's emerging in America, that's been emerging for several years now. There are many people in this country who are using buy now, pay later credit to buy their groceries. That's a sad indictment of this economy, away from whatever the payrolls report told you on Friday. How bad are things?
When you think about buy now, pay later, who is always the biggest consumer of buy now, pay later? Younger consumers, people 30 and under. You take a look also what you think about credit card and delinquencies, look what's happening there too. So yes, we still have a strong labor market, but there's definitely price increases on essentials that's leading consumers, particularly in that lower to middle income category, trade down.
Is that hurting more brands than others? Are you seeing that already, or is that just the risk for later this year?
Risk for later this year, but you're definitely beginning to see it. Look at restaurants, where you're seeing how people are frequenting restaurants, definitely much more quick serve than what you've seen in others. It's impacting what you've seen in some of the apparel companies in terms of what they're able to deliver. You have companies that have been weaker, like Nike, that has to rebuild their product innovation pipeline. But the pause that you're seeing and the concerns are there. Yet, we've seen through the first quarter, given we said every week and month is divorced from each other, given there's new data points, resiliency in terms of some of the, for example, retail store openings. We're watching it carefully.
What's the resiliency right now when it comes to the consumer in China? We're spending a lot of time talking about the consumer in America and how they're going to be hit from the tariffs. What's going on in China and the demand?
Slowing in terms of demand in China, whether it's luxury goods or whether it's other U.S. brands, you're definitely seeing that slowing. You're seeing some brands continue to remain strong there, and by that I mean Ralph Lauren in China has been solid.
Dana, appreciate it. It's good to see you.
Thank you.
As always,
Good to see
thanks
you.
for the update. Appreciate
Thank
it.
you.
Really do. Dana Towsey there of the Towsey Advisory Group. Just want to give you a sneak peek of the week ahead because later on this morning we get some economic data. ISM Services comes at 10 a.m. Eastern Time before the Federal Reserve meeting on Wednesday and that Chairman Powell news conference. Look out for the testimony from the Treasury Secretary, Scott Bessent. Secretary Bessent has talked about retailers having sufficient inventory to get through this over the next several months. And I think questions about that, trade volumes and inventories are going to be critical stories to follow over the next few months.
All right, because Gene Soroka was telling us that really it's 5 to 7 weeks. This is a week-by-week basis when it comes to inventories for some companies. Others have planned out for this a little bit better. Also, I'm interested in looking at the data because depending on whether it's good or bad, how is this administration going to talk about it? Is it going to be Biden data or is it going to be Trump data? Friday with the jobs report, they were very excited about. That seemed to be Trump data, even though we lost about 1,000 jobs in the manufacturing sector. It's what makes all of this so complicated Wednesday for Jay Powell.
The cheat guide, if it's bad, if it's good, I think it's obvious whether it's Trump or Biden data based on the White House's perspective. The importance of retailers, though, Home Depot, Target, Walmart, putting pressure on this White House just a few Mondays ago, going into the IMF World Bank spring meetings, and maybe just shaping a different approach towards China in the coming weeks for trade negotiations. Up next on this program, we'll catch up with Erin McLaughlin of the Conference Board, Deborah Cunningham of Federated Hermes, as we count you down to a Federal Reserve decision this coming Wednesday. As we count you down to the opening bell, 1 hour and about 5 minutes away, equity futures here, negative by 0.8% on the S&P. From New York, this is Bloomberg. Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly. There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Africa.
a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
This just in from Goldman Sachs. The May Fed meeting should be uneventful. There's your promo for Wednesday's show. But we expect enough evidence to accumulate for a cut by July. That's the team at Goldman Sachs and their call on the Federal Reserve. Equity futures this morning going into that opening bell 1 hour away. Equity futures down by 0.8%. On the Nasdaq 100, we're down by close to 1 full percentage point with some movers this morning. Your morning movers. Here's Danny Berger. Hey, Danny.
Hey, John. Well, Berkshire Hathaway's board has taken Warren Buffett's advice last hour, announcing that they have indeed named Greg Abel as the new CEO of Berkshire Hathaway starting the 1st of January. Follows over the weekend at the shareholder meeting. Warren Buffett saying that he would be stepping down as chief executive for Abel. It's a mammoth task ahead of him. A new era for Berkshire Hathaway without Warren Buffett, with a huge cash pile on hand. Shares down nearly 3% in the pre-market trade. Also falling this morning, most of the media companies. You have Netflix, Disney, Warner Brothers Discovery, all down at least about 3%. Netflix doing the worst of them after President Trump posting on Truth Social saying that he would tariff foreign films 100%. A lot of questions as to how exactly that would work, but even so, we are selling on that. Meanwhile, we also had some earnings coming from Tyson Foods in the last hour. Those shares down 2%. They did indeed beat, but there's some concern that the results were really just lifted by their chicken sales. Their beef sales have been really poor. Higher costs, they're having a hard time passing that on to consumers, and questions whether we've reached peak chicken. If there are tariffs now coming on, does that mean we'll have retaliatory tariffs? So that means less Chinese demand for U.S. chicken as the economy slows. They did keep their guidance, and they didn't mention tariffs or economic weakness. John.
Danny, thank you. Appreciate the update. Consumer price tolerance, a big feature of the conversation for economists, that's for sure, going into the summer. Investors looking ahead to Wednesday's Fed decision and Fed Chair Jay Powell news conference. Joining us now is Mike McKee with more. Good morning, Mike.
Good morning, John. There isn't a whole lot else on the calendar. This is a very light data week. You mentioned the ISM services report later today. Most people will be looking under the hood at the sub-indexes, particularly for new orders and employment, some sort of hint as to where we're going with this economy. Trade tomorrow, that is the adds in services to the goods trade balance, which hit a record last month. Fed decision on Wednesday, as you mentioned, and I think Goldman Sachs pretty much has it nailed. Not going to do anything in terms of rates, and there's no new forecasts. So at this point, it's going to be up to Jay Powell, who probably, you could probably have a Las Vegas line on how many different ways you can say, I don't know, in his news conference. Claims and productivity will come on Thursday. Then Friday, the Fed is back. We'll see what the rest of the Open Market Committee thinks about the future of the economy. We have an enormous number of people speaking. Williams, Barr, Kugler, Goolsbee, Williams, Waller, Musalam, Hammack, and Cook, all speaking on Friday. The interesting thing to watch is going to be John Williams, because he's speaking at the Bank of Iceland in Reykjavik, and then he's speaking to the Hoover Institution in California on the same day. One of those, California, is by video. So he's got 2 in 1 at opposite ends of the United States and the world.
Mike, how much distance is there between him and the rest of the committee at the moment?
Between Powell or Williams?
Well, you mentioned Williams. I'll be focused on the New York Fed president, the first one after the Federal Reserve meeting. What about the rest of the committee?
The rest of the committee is behind Jay Powell, behind John Williams, and the idea that they're not going to do anything in the short run. They have to wait for the data. But then there is some division about whether they're going to need to move quickly or not. And that's why you get back to the same thing from all of them about being data dependent. Some think they'll have to move more quickly if the economy slows. Nobody's really on the side of a rate move up because of inflation at this point.
Mike McKee, thank you, sir. Appreciate the input as always. Erin McLaughlin there, the conference board, writes the following. The focus needs to be on getting a China trade deal. The current tariff level is unsustainable. Erin joins us now for more. Erin, good morning.
Good morning.
Do you want the good news? The administration agrees with you.
Yes.
It's unsustainable. Does that mean tariffs are coming down then in the next few weeks?
You know, I think it'll be really interesting. I think what we're going to see is that there are going to be deals struck potentially with the other Asian economies while we sort of wait for China. You know, we keep hearing that there's discussions with China, then we hear that maybe there isn't. So my thinking is that we're going to see deals with the other Asian countries ahead of time.
Before we get the bigger deals, how distorted will this economic data be through the summer?
Well, and that's really what we're waiting for is the data, just like the Fed is. One data point, which is not directly about consumer spending that we look at, is our own consumer confidence index and the expectations part of that index, which continues to be at more than a decade low. It's in sort of that recessionary territory. We're also looking at port numbers, including the fact that the Port of LA is taking in about a third less cargo right now than it usually does in this time of year.
When it looks at the expectations of consumers, what does this environment remind you of? What other point in time have you seen some of the survey data look like we have today?
It looks like the Great Recession or the years after the Great Recession, which took a lot of time, to come out of that moment. It doesn't necessarily look like the pandemic, because the pandemic obviously was something that sort of gumming up of supply chains was caused by an external factor. This is obviously something that is policy related and something that can change potentially.
We know that consumers are nervous about inflation and prices going higher because of the tariffs, but what you're also seeing is employment deterioration. This idea that prospects for getting a job is also challenging.
Yes, and that makes consumers more nervous than anything. Having a job, and we've seen in our history of looking at this, when consumers have a job, they're going to spend. But when they don't have a job, or they really think that their job, is at risk, then they will sort of pull back spending and just concentrate on sort of the necessities.
And they won't be asking for a pay rise. What does that tell you? The attitude towards the labour market right now, what does that tell you about the risk, the perceived risk of second-round effects from the tariffs and what it could mean for prices?
I think it means that, well, on the company side, the Conference Board, our members are companies. So many of them are right now trying to figure out how to best communicate and analyze how to pass on prices or how not to, and really how to message with their consumers. And I think for consumers themselves, it's really a matter of sort of pulling back and wait and see. But that's sort of that continual uncertainty that sort of, makes it increasingly risky.
Is there a particular date on the calendar that you're worried about an air pocket in the data? Is it weeks away, months away?
I think it is somewhere between weeks and months. I think it is 6 to 8 weeks away, which is, at the Conference Board, similar to Goldman Sachs. We are thinking that July may be the first meeting where the Fed, takes another look at interest rates.
The Polaris CEO last week said that they're implementing a recession playbook. Do you see other companies having to do that now, and how self-fulfilling is that?
That's a great question. It can be self-fulfilling from a consumer side. Obviously, we're still in a consumer-based economy. I think it's very interesting that companies are having, as we've seen with some of the earnings reports, they almost have two scenarios, the scenario A, scenario B. But no matter what, for companies to plan to onshore production, if that really is the goal here, is something that takes years, if not up to a decade, depending on what you produce. So it's very, very hard to have a long-term playbook if you really don't know how long these trade and tariffs are going to be in place.
Right, so you just wait on the sidelines. So if you think we're going to see this hard data in July, but companies are already saying they're doing things like a recession playbook, do you just feel like the Fed then is bound to be late?
It's hard to tell because obviously the employment numbers were still strong. Inflation is still pretty flat or coming down. So they have to have a reason, a data point in order to make an adjustment.
We'll get more data later on this morning, 10 a.m. Eastern Time. You'll get the ISM services print. Erin, it's good to see you. Thanks for being here. Erin McLaughlin there at the Conference Board. Following the consumer confidence numbers, and the consumer confidence have been rock bottom, not great at all across several measures. What you haven't seen, though, is the hard data collapse to the soft data, and that's something economists and all of us are still waiting for.
Absolutely. What you see in the surveys is that consumers are nervous, not just about price hikes, they're nervous about potentially losing their job. But so far, what have you seen in the hard data? Retail sales has been stellar. If you're nervous, you brought up this point, if you're nervous about losing your job, why are you going out and getting goods? Because you're nervous about prices going up. when this actually starts to trickle down to the hard data, we'll finally give the Fed a little bit of some breathing room to potentially cut. Until then, though, expect the White House to continue that job voting.
ISM services coming later this morning, down about an hour and 22 minutes away. Then on to the Federal Reserve on Wednesday. More claims data on Thursday. The scores going into the opening bell shaping up as follows. Equity futures negative by 0.8% on the S&P 500, following a 9-day run on the benchmark in America. On the NASDAQ 100, we're negative here by 1 full percentage point. In the bond market, the Treasury yield looks like this. The 2-year, 380.75. The 10-year, 432.97. Yields are higher on the 10-year maturity by about 2 basis points. Joining us now to discuss is Deborah Cunningham of Federated Hermes. Deborah, welcome to the program. Something that you said last time we caught up with you, when we last spoke just around April 2nd, you said long live higher for longer. Is that how you see things still?
It is. It is. I'm much in agreement with previous discussion on the show this morning, which is we don't see any kind of a cut from this Federal Reserve until at least July, and maybe even longer, depending upon how the data stacks up between now and then. There is additional information that I think Chair Powell is going to continue to want to see, and without his being comfortable, the leadership is going to follow, everybody's going to follow the leadership from his standpoint, and it's a wait-and-see sort of situation.
Well, in this wait-and-see sort of situation, though, Deborah, we are hearing from policymakers in Washington, the president notably signaling that there will be trade deals. So do you expect clarity in the next few weeks and months?
We hope for clarity in the next few weeks and months. I can't say that we would expect it. It seems as though there have been ups and downs from an administration standpoint with regard to discussions around tariffs. They are being discussed, and then all of a sudden they are not being discussed any longer. So I think what we're trying to do is measure what happens as it happens, rather than try to guess what might happen in the future. The guesses are really, I think not very well formed given the information that we have to go on so far.
Right, but the administration is talking about, say, with China, which everyone is focused on, that the rate is unsustainable, and the president said he is going to drop it. Does that give you at least some hope that potentially you can see some positive trade momentum and give the Fed a little bit of breathing room in terms of where policy is going?
Definitely there's hope along those lines. And I feel like we in the United States are closer to it than others. I've spent some time in some of our global offices outside the United States over the course of the last month. And there is much less optimism, both in Asia and in Europe, with regard to how these deals play out, when these deals play out, and to the extent that these deals play out. But I feel like at least here in the United States, where we are closer to it, where we hear and see things on a local basis that maybe don't hit the global news channel, we definitely have more of the appreciation of that hope here in Pittsburgh, at least.
Debbie, lots of people talk about rate cut expectations and market pricing. When you speak to economists right now on Wall Street, you can drive a truck through the range of estimates. At the one end, you've got zero, at the likes of Morgan Stanley. At the other end, you've got the likes of Citi looking for 125 basis points of rate cuts. It just feels like market pricing, averaging out two very, very different scenarios. Which scenario is your base case, if you can even have a base case?
Our base case is 2, maybe 3 cuts for the remainder of 2025. However, much like other world economists, our own, what we call our STIC committee, our short-term investments committee, has a number of voters that are looking at, expectations for the rest of this year and into 2026 and 27. And you could also drive a truck through our own estimates. We have, one person that's in the camp that before the end of the year, there will be a need to hike just from an inflationary perspective, whereas others are, in the more normalized 2-3 cut scenario. And then there are some that are on the far other side of the equation. So long tail with regard to our expectations internally as well.
Debbie, appreciate the transparency. You're not alone. I think that's a reflection of investor committees across the country and around the world right now. Debbie, thank you. Deborah Cunningham there of Federated Hermes on the current situation, not just for them, but for pretty much everyone, trying to make a forecast for the road ahead. Equity futures at the moment, near session lows on the S&P, down about 8 or 0.9% on the S&P 500. With an update on stories elsewhere, here's your Bloomberg brief with Yahira. Hey, Yahira.
Hi, John. The Trump administration is planning to release a proposal to modernize the U.S. air traffic control system. The need for the upgrade was brought into focus on Friday when United said it would cut 35 daily round trips at Newark International Airport due to technology breakdowns and a staffing crunch. Shell is considering an acquisition of its rival BP. Sources telling Bloomberg a final decision will likely depend on whether BP's stock continues to slide after losing nearly a third of its value in the last 12 months. Deliberations are in the early stages, and Shell may opt to focus on share buybacks rather than a merger. And Scottie Scheffler just wow, dominating the CJ Cup. Byron Nelson tying the PGA Tour's 72-hole record with a score of 253, totaling 31 under par. Scheffler cruised to an 8-shot victory, his first at the hometown event he grew up attending. His performance broke the tournament scoring record and marks his first win of the year. Very cool to watch. That's your Bloomberg brief. John?
Yahira, thank you. Ridiculously low scoring over the weekend. Up next on the program, we'll set you up for the week ahead. You're watching Bloomberg TV.
The President of the United States does say he wants to keep a more mutually beneficial trade balance with these countries. What does a country like Egypt and Kenya and some of these others have to provide that won't completely dent their own GDP?
No, it's tough. I mean, there is the commodity side. There is the. I think it's less about bringing it to the table and more trying to take advantage of the hit elsewhere. So China exports 30% of all the textile exports to America come from China in 2023. It's something like $40 billion. And whatever the tariff rate ends up being on China is going to be a lot higher than it is on Africa. So there might be scope for African countries to say, well, let's move those textile factories.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
This stock market put back on a lot of weight over the last 9 days on the S&P 500, adding back on 10 percentage points, and a raise in the post-April 2nd, post-Liberation Day losses. This morning, we take some of it back. We're down by 0.9% on the S&P. On the Nasdaq 100, we're down by 1 percentage point. Going into the opening bell, 41 minutes away. As we head towards that opening bell, here's the trading diary. The calendar looks like this. At 9:45 Eastern Time, we get some S&P PMI data. At 10 a.m., ISM Services. After the closing bell, earnings from Ford. Tomorrow, the trade balance, plus Treasury Secretary Scott Bessent testifies to Congress, and President Trump meets with the Canadian Prime Minister Mark Carney. On Wednesday, a Fed rate decision and a Chairman Powell news conference. Joining us now from the nation's capital, Tyler Kendall. Tyler, what's on your calendar? What are you focused on in the days ahead?
Yeah, hey, John. Well, we'll be watching for any potential movement when it comes to these framework trade agreements that the White House clearly wants to show forward progress on. And perhaps we could get some indications during dual hearings this week from the Treasury Secretary, Scott Bessent. He'll be in front of House Appropriations tomorrow. That's considered to be an oversight hearing. It's going to focus much more on the Treasury Department's mechanics, questions geared towards the IRS, tax receipts, things like that. But then on Wednesday, that's really going to be more of the blockbuster hearing that we're going to be tracking. It's in front of House Financial Services. It's his annual testimony to Congress, and he will no doubt face those questions about tariffs. But when we look at his Wall Street Journal op-ed from over the weekend, it is clear that we can predict some of the things he's going to say, particularly as he pushes forward that this three-prong approach to their economic agenda when it comes to tariffs, taxes, and deregulation shouldn't be viewed separately, but rather as these interconnecting parts. And I bring that up because while these lawmakers will be grilling him on these tariff plans, it's clear he'll also have some messages for them, particularly when it comes to advancing that reconciliation package, as the White House really wants to see their tax cut agenda done as quickly as possible. Now, later on today, we do have 3 chances where we could hear from President Trump. The first will be at 1 p.m. Eastern. He is expected to announce, according to reports, that Washington, D.C. will host the 2027 NFL Draft. John, not a trade deal, but I guess you could consider that a deal of some other sorts.
Looking forward to that, at least to see the color around that announcement, Tyler. I'm glad you brought up the tax agenda. The Treasury Secretary has said the market is way too focused on tariffs. They need to focus on tax, and deregulation. Scott Bessent has been very clear and adamant that they think they can get more done than just the extension of current policy. But how likely is that when you're up on Capitol Hill talking to lawmakers?
Well, at this point, there are still some big disagreements because we are talking about tax cuts, but we are also talking about the spending cuts that are needed to offset them. And Republicans right now really are raising their concerns about what this could potentially mean for Medicaid. We've been talking about this for months, even as President Trump over the weekend vowed that there will not be any changes to Medicaid, Medicare, and Social Security besides for cutting down on waste, fraud, and abuse. But when we look at the numbers, it's really hard to understand how they could accomplish more of these tax priorities without these benefit programs potentially seeing some slashing to their annual budgets. Now, the Treasury Secretary has made clear that of those long list of tax priorities and campaign promises, they are trying to not only make permanent the 2017 tax cut plan, but also zero in on no taxes on tips, overtime pay, and Social Security. As of now, those appear to be those big 3 priorities that they are trying to also latch on to this bill. We're going to wait and see how lawmakers potentially thread the needle on this one as the White House really does ramp up the pressure and begins to be part of these negotiations. There has been reporting that House Speaker Mike Johnson has asked those committees that oversee most of where this reconciliation package is going to be coming from, particularly House Energy and Commerce, which oversees the budget when it comes to Medicaid, to actually hold off on writing that legislation for this week and then pick it up next week as they start to get more input from this administration on exactly how they want to see this done.
Well, the administration wants to see it done by Memorial Day. Tyler, honestly, how likely is that?
Well, at this point, that's considered to be a very ambitious timeline. We've spoken before about how Senate Majority Leader John Thune has called that aspirational. Scott Bessent has put a July 4th timeline on this, on when he would like to see the final reconciliation bill passed. But I spoke to a senior aide to Senate Republican leadership who said that they do not expect their chamber to really start working on this in earnest until August at the earliest. There is a lot that needs to happen here. But one thing, though, that is clear is that Republicans are really starting to fall in line behind President Trump's agenda, at least on the Senate side. They seem to be more likely to go behind having these bigger tax cuts, whereas the spending fight really seems to be coalescing in the House. So we're going to have to watch those two dynamics, because while House Speaker Mike Johnson wants to see this done by Memorial Day, that means he's really going to have to ramp up his pressure on his members to get a deal done if they want to meet this July 4th timeline.
Tyler, appreciate it. Tyler Kendall down in Washington, D.C. Memorial Day, just a few Mondays away.
It sounds very challenging. They're going to get this done on Memorial Day. It's not going to happen. But what I would say we need to really keep an eye out for is when the Treasury comes out with the X date, when we're going to hit our debt limit, because they want to include lifting the debt limit in reconciliation. And pretty much by design, that gives them a timeline. Of course, though, they could do carve-outs and they could just do the debt ceiling and say we're not done yet when it comes to taxes. This tax deal, I know the administration has a ton of priorities in it. It is going to be very challenging to get all of these Republicans to line up and vote for it, given the fact that they all have different constituents. A New York Republican is very different than a Nebraska Republican right now.
Timing and substance. Substance informs the timing. Because the substance is so controversial, it's going to push out the timing potentially. That's the risk here.
Potentially. Some are even saying it could be done by the end of the year. Chris Harvey was talking about January because of the weather is so awful in D.C. by August when it comes to humidity. But I think it is going to have to get done this year. And this administration is desperate to change the talking points. They want to talk about taxes. The question is, though, for market participants, and you brought this up before, is it removing the headwind or is there going to be a tailwind? Meaning, is it just going to be an extension of current policy, an extension of TCJA, which we saw under the first Trump administration, or are they going to get some of these sweeteners?
Something to think about going into Memorial Day and July 4th, Independence Day, several weeks after that. Equity futures at the moment on the S&P 500, negative by 0.8%. The opening bout just around the corner. Coming up tomorrow, reacting to all of this, we'll catch up with Cameron Dawson of New Edge Wealth. We'll speak to Jonathan Pingle of UBS, Sarah Hunt of Alpine Saxon Woods, and Congressman French Hill of Arkansas. Where the congressman is, not just on the tax effort, but on trade. What is Walmart in Arkansas telling the congressman, French Hill, about the situation when it comes to supply, goods crossing the border, and when it comes to prices and inventory?
He's probably telling him it's been a very challenging few weeks and we were desperate. We'd love some clarity from Washington, D.C. We know that Walmart executives have said that to the Oval Office, so I'm sure they're bringing that up with Congressman French Hill, who's also the chair of Financial Services.
I believe that's come up repeatedly, going back just several Mondays. The pressure building on the White House from retailers in America. You've seen the trade volume drop off. You haven't seen the hard data drop off. Payrolls on Friday resilient, which leaves the Federal Reserve still stuck between a rock and a hard place and unlikely to change policy on Wednesday. From New York City, big week ahead. Thank you very much for choosing Bloomberg TV. This was Bloomberg Surveillance.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Another art museum called the Guggenheim. Now, Louvre's big enough. Why do you need a Guggenheim as well, right next door?
I think it's a great question. I think the beautiful thing about the UAE and Abu Dhabi is we live with over 200 nationalities. And in doing so, they have become a part of the country's and the city's fabric. And we need to celebrate that. So we need to celebrate everybody's identity, everybody's background, everybody's heritage, everybody's history. And what a beautiful way in doing so in these beautiful institutions. These museums are educational institutions and they're community institutions. So we wanted to curate really a story where you come to Saadiyat Cultural District and you, if you allow me to curate the story, you start off at the Natural History Museum. And at the Natural History Museum, you get a glimpse and you get an understanding of how we came to be, how our Earth came to be, how our universe came to be, from a scientific perspective. Once you leave the Natural History Museum, you go to our National Museum, the Sheikh Zayed National Museum. There, you understand the history of this great land. Not just the history of the country, but the people of this land that have been a part of this land for over 300,000 years. You get a glimpse of what the past and the present and the future looks like here in the UAE. From there, you maneuver yourself to the Louvre Abu Dhabi, which is a beautiful universal museum. It is universal in its thematic approach. So there, you basically see a part of you on an equal pedestal with the entire world.
In case you missed it, on the China Show,
President Trump has called Wednesday Liberation Day, and that seems like liberation from the rules-based order on trade.
We're seeing a lot of orders being canceled, particularly on product being sourced out of China. There's a threat to seeing a shortage of certain products because, look, China's our #1 supplier of footwear. When I got this job 15 years ago, it was 88% of our volume into the U.S. It's now 56% of our volume. But the fact of the matter is, most of that volume is for price-conscious consumers here in the States.
One of the things you see here when you talk to suppliers and buyers is that this essentially gives Asia and Africa to Chinese supply chains an influence, because now as American firms have to focus more on the home market, the companies and organizations with the money to invest in new areas, that will be mostly Chinese money.
Don't miss the China Show live every weekday.
The end of a 9-day rally, 30 minutes until the start of the cash trade. I'm Matt Miller. Katie Greifeld is off. Shonali Bassick is at the Milken Institute Conference in Beverly Hills. Bloomberg Open Interest starts right now. Coming up, President Trump says trade deals may come as soon as this week, but Hollywood had better watch out as he threatens to tax films shot abroad. And it's the end of an era for Berkshire. Warren Buffett hands the keys to Berkshire Hathaway and its $350 billion cash pile to Greg Abel. Plus, we are live at the Milken Institute Global Conference in Beverly Hills with Mark Rowan and Bill Ackman, and much more today on Open Interest. In terms of the stocks that we're watching this morning, Berkshire Hathaway is one of them, now down 3.3% after Warren Buffett said he will step down as CEO after 6 decades running the behemoth, returning 20% a year. In terms of Skechers, we see a massive jump here. It's going to go private in a deal with 3G Capital, and Netflix is down right now almost 5% as the Trump administration, I should say, plans a big tax on the industry. Films made abroad will face a 100% tariff. The president wrote on Truth Social last night that he will tariff movies coming to the U.S. that are produced in foreign countries. Let's discuss how this would work with Felix Gillette. He joins me here at the set. Felix, thanks very much for coming in this morning. Let me ask about this tax. How exactly would it work that the president wants to put a 100% tariff on films made abroad?
I mean, a lot more questions than answers at this point. Does it does this apply to Hollywood movies where part of the production is done overseas? Because at this point, you know, every big movie does some shooting overseas, some post-production parts of the overall movie gets made there. So is that going to apply? Does this apply to TV shows that are made overseas? You know, the streamers at this point have a lot of operations. Netflix in particular has done decades of work building operations in foreign markets, both to cater to audiences overseas, but also, you know, Squid Games, shows like that from Korea come over and get consumed here. So yeah, at this point, I think people are scrambling around trying to figure out how this would be implemented.
How did this come up? I mean, apparently John Voight was at the White House. The two of them may be screening the Clint Eastwood classic Escape from Alcatraz together. Is Trump angry that Hollywood doesn't have as much production as it once did?
Yeah, this goes back a couple months when Trump first announced that he was going to have some Hollywood ambassadors, John Voight, Sylvester Stallone, Mel Gibson. And yeah, the issue was, you know, Hollywood has seen employment drop in the entertainment industry. A lot of the jobs have gone overseas as some of the production moves to places like Hungary, New Zealand, Canada, that have lower production costs on labor and also offer a lot of tax incentives. So, John Voight and his team were at Mar-a-Lago talking about all of this with Trump over the weekend, apparently. Our understanding was that they were going to propose some sort of federal incentives, tax incentives for moving some of those post-production filming operations back to the United States. Already there's, state incentives to do that, but, the idea was maybe offer some additional federal incentives, and then out of that, we get this announcement about the 100% tariff.
All right, so they were screening at Mar-a-Lago. I'm sure they have a good movie.
I'm sure they had a good
there
lineup.
as well.
Yeah,
Felix,
for sure.
thanks very much. We will, I'm sure, talk more about this with you. Felix writes about Hollywood for Bloomberg. Outside of Tinseltown, a potential merger between oil supergiants Shell and BP could reshape the energy totem pole. Bloomberg was first to report that Shell is discussing a possible takeover of BP, and we're going to discuss now with Alex Steele. Alex, what do we know about this potential? It would be a big deal.
Huge deal. Suffice to say that it would be weird if Shell was not considering this in some form or another. Now, I had asked the CEO of Shell this exact question, and he's like, we're not thinking about it, we're not going to talk about it, but you got to be thinking about it. In part because the synergies would be so huge because they both have operations, say, in the Gulf of Mexico, for example. So the synergies alone, you could argue, would be really worth it. Also, Shell sold its Permian assets to Conoco back in 2021. So they don't have any U.S. onshore assets that relates to shale. So BP could be a big pickup for them on that. And even, say, refining operations, even if you're looking at say, gas stations and any sort of distribution stations, that would be huge for them as well.
I want to know why OPEC continues to raise production numbers, especially when we see Brent crude at $60, right? WTI below it. Torsten Slok reporting that that's less than the break-even cost.
You cannot really drill them around these levels. For even operating expenses, that's into the 40s for some of the wells. Now, it's a couple-fold. One, if you look at the forward curve, you're still seeing backwardation. It just means that prices right now today are more expensive than prices, say, in a year. So you're still seeing a little, and that usually says that there's some demand strength. One, economic data, still been pretty okay. So we haven't seen that fall off a cliff. And then three, it's cheaters. So Kazakhstan and Iraq have been pumping above what they were supposed to under this agreement, also the UAE. So if you're Saudis, you're like, why am I going to keep subsidizing their output at the expense of mine? And that's really the stressor. Now, some reports like RBC, Halima Croft, said that the Kazakhstan government said that there's no indication that they've been asked to cut oil output. Mike Wirth of Chevron told me the same thing on Friday. So that also might have moved the needle a little bit to be like, all right, guys, you're not even talking about it? Here we go.
All right, Alex Steele anchors the close for us, but also obviously covers the oil patch very closely, so I appreciate your time. I want to switch gears now to Omaha. Warren Buffett surprising the world by announcing he will step down from his CEO role at only 94 years old. He's only been running this company for 60 years. The news even came as a surprise to Greg Abel, his successor. For more, let's bring in Matthew Palazzola of Bloomberg Intelligence, who was at the meeting, has flown back to New York to talk to us about it. And I guess you weren't blown away, right? Because he's got to step down sometime.
Yeah, I would say this. The meeting, it was towards the end. I was up since 4 o'clock in the morning. I was getting tired. I was looking at my watch. I said, oh, there's 5 minutes left. And then Buffett said, there's 5 minutes left. I have to make this announcement. So the way he made it was a little surprising. Like you said, Greg Abel didn't even know, but it coming was not a big surprise.
What does this mean? I mean, it almost seems like Buffett has prepared for this. You know, he's sold off so much into this downturn. He looks like a genius. He's raised a massive cash pile, and he's like handing Greg Abel a clean slate.
Yeah, well, so he is a genius, right? Yeah. You know what was funny? He came up at the meeting where there was this thought that perhaps he was not making moves or doing things, like you said, to kind of clear the slate for Greg. And he said, no, I'm not. I didn't clear the slate for Greg. I just wanted, I reacted to what was happening. So, you know, the table is set. I think it is a great position for Greg to be in going forward.
All right, Matt, thanks so much for covering this. Matthew Palazzola writes for Bloomberg Intelligence. We will be covering more on Buffett in just a few minutes. Right now, on Open Interest, we're going to show you what our extensive coverage of the Milken Institute Global Conference in Beverly Hills will look like. Shonali Bassick is there, and we go to her now. Shonali, who do you have lined up for today?
It's interesting, Matt, that you started with Berkshire Hathaway because Buffett does loom large in Los Angeles because, of course, there are a lot of lookalikes. There are people who are building baby Berkshires. That includes Mark Rowan, who's going to be joining us in just about a half hour's time. Of course, Apollo has really adopted the Berkshire model in a lot of ways. Tomorrow, we have an exclusive interview with Todd Bowley of Eldridge. We'll be figuring out his plans for that as well. Later in this hour, we'll also be speaking to Paul Taubman. It's interesting. If you look this morning, we have a bit of a merger Monday on our hands. Let's see how far it could come back. Of course, we'll be beating the drum down to Scott Bassett, the Treasury Secretary, who will be speaking here at Milken. We will get you a readout. Stick with us. This is Bloomberg Open Interest.
Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
What is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
But what mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
Season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Get to high interest now. We'll look at what's making headlines around the world. Israel's security cabinet voted to intensify military operations in Gaza and call up tens of thousands of extra reservists. The cabinet also decided on a means of distributing aid in Gaza with non-Israeli private companies set to handle that aid. The decision comes a week before President Trump visits the Gulf. Trump pushed Israeli Prime Minister Benjamin Netanyahu to get more food and medicine into Gaza. And about 10 potential borrowers are looking to raise fresh capital in the U.S. investment-grade primary market today. That's according to an informal survey of underwriters who declined to name those firms. Over $38 billion was sold last week, and issuers are expected to keep selling fresh debt into the primary market, with $35 billion to $40 billion projected over the next 5 days. More corporate participation is expected this week compared with last, as companies break free from their earnings blackout periods. And President Trump says he has ordered the reopening of Alcatraz as a prison to house America's most ruthless and violent offenders. His Truth Social post didn't disclose an expected timeline for the reopening. Alcatraz, of course, sits on an island in San Francisco Bay. It was closed as a federal prison in 1963 after just 29 years of operation because it was too expensive to continue. The storied prison once housed Al Capone and George Machine Gun Kelly. And getting back to one of the top headlines of the morning, Berkshire Hathaway named Greg Abel the company's next CEO as of January 1st next year. For more, we're joined by Kathy Seifert, CFRA analyst and senior vice president. She has a hold on the shares and a price target of $535. So, Kathy, I wonder what you think of this. Not a surprise, right? It even looks as if Buffett has prepared the company for a successor.
It wasn't a surprise, although, you know, the way it was communicated was a little bit of a surprise, especially to Greg. That was interesting. But, you know, the two heir apparents were set up a number of years ago, with Greg getting the nod as being Buffett's heir apparent. So he's had a number of years to prepare for this. I still think there's going to be a period of adjustment. And I think the important thing for investors is calculating or figuring out what happens to the Buffett premium in the shares. And I think that's where we see some of the pressure this morning, is as investors weigh the implications for a post-Buffett Berkshire Hathaway.
What is that Buffett premium, Kathy? I mean, you look at some companies. I think right now Tesla is probably the best example, with a market cap of almost $1 trillion, and obviously it's a small car maker. Is Berkshire Hathaway the same kind of thing, where because they have a superstar CEO, they get a huge premium in terms of their market cap?
I mean, he has become a superstar, but I think it's because Berkshire had a CEO who was acknowledged to be, you know, a top-tier investor. And I think that's the premium embedded in the shares. And with him gone, investors are going to have to decide what kind of a premium does the company, you know, is the company afforded? I mean, they do have a very strong balance sheet. There is a lot of cash on the books, but there is still a Buffett premium that I believe is going to have to be extracted from the shares. And I do see they're set to open lower this morning. I think in the very near term, there could be some pressure on the shares. And then as the year progresses, there may be a little volatility as investors come to get more comfortable with Greg Abel, as they look to see what potential changes he may make or not make at the company.
I mean, over his tenure, he's returned, Warren Buffett with Berkshire, an annual 20%. That's double the S&P. Why is this just a hold for you? Don't you want to own this for the rest of your life?
I had it as a buy last year and took some profits when the stock had run up and when revenues had slowed. Revenue growth last year was under 3%. They reported, lost in all this was their first quarter results. And, you know, on a fundamental basis right now, the shares to me look fairly valued. Obviously, if there's a pullback, I'll reconsider that. There are a number of, I mean, I believe Berkshire at this point is at an inflection point from a number of perspectives, not just managerial. I think a number of their businesses are at an inflection point, sort of echoing where the economy is at an inflection point. So I think this could be a transitional year more than just from a managerial perspective. So I think it makes sense right now to be a little cautious on the shares. Yeah, I mean, longer term, it's a great stock. In the near term, there are a couple of headwinds I'd be a little concerned about. Not overly concerned, but I think it merits a little caution right now.
You know, Warren Buffett looked very smart coming into this year, selling off stock and raising a ton of cash as the market, came crashing down. Obviously, we've had an incredible run over the past 9 days, but is that just part of his genius? Did he get lucky? The timing looks pretty amazing.
Let's give him the credit where credit is due, and he did a smart move, and in many respects, I realize he said he's not setting things up for Greg, but he did sort of get his ducks in a row, got his house in order, however you want to, express that. Greg is inheriting a company that's in a good position, but does have some challenges. There is the cash hoard at Berkshire that people are looking to see how that will be deployed. I would also caution investors that entire cash hoard is not going to be deployed. A lot of that is also a reserve to pay insurance claims. But even if we assume that Berkshire has, $100 billion of dry powder, I think investors are going to be watching closely to see what kind of moves Greg may make.
Do you see anything, Kathy, that you think it would be smart to spend that money on, or do you think they should redistribute that back to shareholders?
Well, you bring up an interesting point, because I also think that there may be a cohort of investors in Berkshire that may start agitating for the company to pay a regular dividend, and I don't think that that's an outrageous request. And so I think, add that to the list of things that we may see change at Berkshire. Now, it may not change this year. It may not change until Buffett is no longer at the helm. But that is one thing that I do anticipate there may be pressure on the firm to consider.
Kathy, great to get some time with you. Hope we talk to you again soon. CFRA's Kathy Seifert talking to us about Berkshire Hathaway. Coming up, we begin the trading day with Threadneedle's Ann Berry. We'll ask her if she thinks now is a good time to get out. This is Bloomberg Open Interest.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizon's Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Looking at the S&P 500 over 9 days, we had more than a Well, here you can see 7.5% gain. It was an incredible rally that took us back to levels we haven't seen since Liberation Day, when we heard about the tariffs that shocked the world. Here at the desk with me is Threadneedle Ventures founder Ann Berry. And Ann, you know, that was the climb after the huge drop that had everyone just in a panic, right? And I'm wondering if those people who were panicking because they held on to stocks knowing that Trump was going to do this, but not to that extent, is this now a time for them to get out while they still can?
Sell the rip is the question. I don't think so, and here's the reason. I'm a long-term believer in the U.S. equity market. But I don't really understand why we're at this particular moment at the level where we are at. To be honest, Matt, you and I were talking about it right before we went live. The fact that we're now at a level that's above where we were pre-Liberation Day, despite the fact the macro outlook is so much more uncertain, is baffling to me. I do think where the market is at is hopeful that this will resolve itself in a way that we saw the 2017 tariff regime level out in a way that, quite frankly, there was bipartisan tacit agreement that something needed to be done with respect to the US's trade position. And I think the hope is that tariffs land in a somewhat sensible place, and then we have the halo of deregulation and tax cuts on the horizon. So I wouldn't sell in case it gets to a sensible position, but I do not understand why valuation right now is higher than it was.
So here's my concern with, first of all, tax cuts. Really? I mean, we're just going to get an extension of the tax policy that we've had. So you and me, we're not going to feel like we got a tax cut, right?
Well, I think there are some other tax policies that President Trump has talked about. He's talked about, in some cases, having no income tax at all, right, for certain folks, for example, below the $200,000 a year level. He's talked about trying to bring in more tax incentives for families. So yes, it's the extension of what has been, but I think there are some other places. Also, he's not given up on the idea of lowering corporate taxes, right, even lower. So I think that's something that's still hanging out there.
And they already don't pay taxes, right? The U.S. government gets like less than $500 billion from corporations. In terms of deregulation, that's also where a lot of people were very hopeful and I think have been, to some extent, burned. We haven't seen a huge wave of M&A as we thought we were going to.
Well, we haven't seen M&A yet, but I don't think that's because the belief is that deregulation isn't going to happen. So we've seen, for example, deep sea drilling, like deep sea mining, for example, is something that has come back on in. I don't think we have seen yet the end of where President Trump decides to go when it comes to financial regulation. Look at what happened at the Consumer Finance Bureau, right? So I think things have been quietly happening that haven't had the headlines because of the tariff noise, and I don't think we're done yet. So I wouldn't give up on deregulation yet.
All right, we're going to keep you with us over the open. We'll see if we lose at the beginning of this session. It does look like the 9-day rally is over, but futures are only down. You can see Dow futures down 260 points, S&P futures down about 0.8%. In terms of the other interesting moves, I go on the Bloomberg terminal and type GLCO GO a lot lately because that shows you global commodity prices. And we've seen a real drop in oil that I think is absolutely fascinating. NYMEX crude down to $57.35. Brent crude off down to $60.43. This after OPEC Plus said it was going to raise production again on Saturday. And that's what's, I think, President Trump hopes is going to bring gas prices down. He's cited a price at the pump of $1.98. I'm still seeing $4 in Westchester, but, you know, it's not West Palm Beach. We're going to get the opening bell up next here in New York City as we bring you coverage also from the Milken Global Institute in Beverly Hills. This is Open Interest.
asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, anti-money laundering, BSA, Bank Secrecy Act, KYC, know your customer, know your customer's customer. You know, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes up in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up to the minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Luanda, Angola, and this is Bloomberg.
We are looking at futures down at the end of a 9-day rally. We're moments away from the start of trading. I'm Matt Miller. This is Open Interest. You can see we're off about 0.8% on S&P futures as some of the big tech stocks that rebounded so heartily. It looks like investors may be taking profits there to some extent. Also, President Trump has said he's not going to speak. He's not planning on speaking with Xi Jinping this week. NASDAQ futures are down 0.9%. You hear the opening bell in the New York Stock Exchange. Vesta ringing the opening bell. They're a group of happy men there, up 10% year to date. So they're actually making money in this market. You can see Morningstar ringing the opening bell on the NASDAQ, a service that I think a lot of us use every day. So great to see them there. In terms of the stocks that we're watching, Berkshire Hathaway is a huge one. Obviously, more than $1 trillion company, moving a little bit lower today after Warren Buffett's decision to step down as CEO. It has been 60 years. You know, it's time for the guy to rest a little bit, although I'm sure he won't. Skechers is going to go private, an $8 billion deal with 3G Capital, and the shares are up 25%. Netflix, though, down more than 3% in the early cash trades as the Trump administration says it plans to tariff the film industry. So let's get back to Threadneedle Ventures founder Ann Berry. She's still here and has thoughts on Netflix. And what an interesting move by the president. I guess he was hanging out with John Voight. Maybe he'd been thinking about this for a long time because people make films a lot more often now in foreign locations. A company like Netflix goes to South Korea. They go to Germany. They go to Spain, right? Instead of doing it in Hollywood. How does this affect them?
Well, I think it affects their near-term pipeline, right? As they think about their cost of production, that's going to have an immediate-term impact. But Matt, Netflix, when you take a big step back, is fascinating to me. And I've been long on it for a long time. It's been a terrific run-up. When I think about this particular environment and a consumer that's feeling squeezed and uncertain, I put Netflix in the bucket of what I now call the new affordable luxury. I think we're going to see strength in Netflix subscriptions. I think we're going to see strength in Netflix advertising dollars because it's one of the platforms I think that big ad spenders still want to go to. So I think this is a concern. I think this still falls in the bucket of a negotiation tool. I wouldn't be surprised if some of these sort of film credit and film cost issues disappear over time. So I'm still bullish on Netflix.
All right, so that's Netflix. In terms of your affordable luxury theme, what else is in that basket? Because I get that, right? You're only spending $15 or $20 a month. I don't know how much Netflix costs these days, but obviously I'm buying it too. And it's less expensive than going to the actual theater. What are the other affordable luxuries you're looking at?
I put Spotify in that bucket too, and actually it's trading at a cheaper valuation than Netflix. Certain elements of beauty has been under some stress over the last year. But areas like premium skincare are still doing very well. Blue Mercury's moving to, I'm on the board of Rodan & Fields. Ulta's pulled them in. Evidence that dermatologically backed brands are still something that people are willing to spend on, because as they cut back, for example, on cheaper cosmetics, they want to go in on efficacious. That, I think, continues. L'Oreal, as a result, from a public stock perspective, I think is better positioned than others. The last thing I would say, Matt, and you and I have talked about this before, I think the cruise sector is undervalued. I think post-COVID consumers are going to fight tooth and nail to keep some budget allocation to travel, and I think the value proposition that delivers it are people like Royal Caribbean and Carnival Cruises, an affordable travel luxury or vacation luxury.
So the idea is that because these are usually package deals, and it's less expensive than booking your own flight, your own hotel, your own activities, a babysitter, et cetera, they're going to the all-in-one Royal Caribbean or, I don't know, the other cruise line.
Yeah, so Norwegian or Carnival. And it's interesting, when you unpack the actual value that's being delivered to the consumer, the rough estimate is the land-based equivalent is about 20% more expensive than that cruise package when you put in travel and food. So if you're a consumer thinking about how to allocate your budget, again, post-COVID, I think people are saying, I do not want to be not traveling again. Where do I go? I think cruises are a good value proposition. You look at something like a Royal Caribbean trading at a high single-digit EBITDA multiple, same with Carnival. It's pretty good value, to your point, in what's been a toppy market despite the noise.
But the bottom line is you're still looking at a downturn. You're looking at a consumer that's weaker. You're looking at lower CEO confidence. So these are consumers holding on to what they can, or even trading down a little bit.
Trading down, and we've seen Walmart be the beneficiary of that. But if you look back to post-2008, for example, this affordable luxury thing came up then, and we saw people still doing things like buying certain cosmetics. We saw people doing things like buying Starbucks, right? If you actually think about it, coffee out of the home should be the most discretionary item. Why are you dropping $5 on a coffee when you're feeling stressed? And you actually saw consumer psychology and behavior. Folks were saying, in a moment where I am feeling compressed in terms of my choices, compressed in terms of income, I want to find just those small things that are small enough share of wallet that they spark enough joy that I'm going to do it anyway.
$5 a day.
Back in the day. Do you remember that? Coffee
$25 a week, $100 a month. I mean, you could really save a lot of money that way.
It's really discretionary, but people were still doing it.
Ann Berry, great to have you with us. Thank you so much for joining us. Ann Berry there of Threadneedle Ventures, talking to us about the affordable luxuries that the consumer may try and hold on to in this economy. Let's talk about Merger Monday. Shell is looking into the possibility of acquiring British Petroleum, BP, and what could be a mega deal that reshapes big oil. Bloomberg's Leanna Baker covers deals for us here at Bloomberg and joins us to discuss just one of the many deals that we could be talking about today, but this would be a big one.
So this is big news, but if you read our report, it's pretty nuanced. So Shell is speaking to their advisors, their investment bankers and others to see if now's the right time to make a move on BP. BP, as you know, has been the target of a big activist investor, Elliott Management, and the value has just really not been good. It's worth half of what Shell is worth. So Shell is trying to figure out, is now the right time opportunistically to make a move? They haven't made a move yet.
Would they face real regulatory pushback? I mean, I imagine this is the kind of thing, if not U.S. regulators, then European regulators or UK regulators are fighting back hard against.
They would definitely face scrutiny all over the world, but from what I've read from research analysts, there is a good fit between some of the geographies that these companies are in where there wouldn't be that much overlap. We would look at, the Gulf of America, Gulf of Mexico, for example. That's one area to look for, but this would not sail through regulators if it got announced.
I personally worry about the gas, right? Because I'm a sucker for marketing, and Shell has the whole Ferrari Formula One thing. So I can't buy gas anywhere else, but I guess I would be able to in this case. In the same area, Sunoco and Parkland, what's the story with that deal?
You mentioned gas. This is an interesting one because there's also an activist investor in Parkland, which is in Canada, my home country. So this is a cross-border deal, and Parkland, because they had an activist, they had to explore options with investment banks, and as part of a strategic review, this is clearly the option that they took, and this will be, a big move for gas station consolidation.
What are the other, what's the update in terms of M&A in general? Because we were just talking with Ann Berry about the fact that we really haven't seen a wave of M&A, the likes of which we were expecting with Trump's deregulation.
So you mentioned it's a merger Monday, and we did see 3G doing their first deal in many years to buy Skechers, a brand that everyone knows. That's a cross-border deal. We also had the gas station deal you mentioned, Sunoco Parkland, cross-border, U.S., Canada. So we are seeing these spurts, these areas of M&A. If you know where to look, there is deal-making happening.
But it isn't to the level that maybe we would have expected. We're not going to best last year's level at this time.
A Shell BP deal would provide that jolt to the M&A markets. That would be a mega deal, and we're tracking to see if we could see other big moves like that, because in times of dislocation, that could be a time to pounce.
All right, Leanna, thanks so much for giving us an update. Leanna Baker runs our M&A coverage for us here at Bloomberg. I want to take a look at GLCO Go on the Bloomberg terminal again very quickly, just to show you where a lot of my focus is on the oil patch and why. So you can see here at the top, WTI crude coming down another 1.5% to 57.46 a barrel. So in the 50s there, and Brent crude isn't much further away, down on 1.25% today at $60.53. This the global benchmark, as OPEC Plus says it's going to raise production again in a Saturday meeting, and that is bringing oil down, and I think President Trump hopes as well gas prices down. The problem is that at these levels, you get to below the price it makes sense to produce at for a lot of Texas. The Dallas Fed came out with something that Torsten Slok highlighted in his daily Spark note. We also continue to see the dollar fall. So the U.S. dollar coming down again today, especially against the Taiwan dollars. Exporters there rush to swap currencies. But the U.S. dollar now back to levels we haven't seen since September. And here you see what we're looking at in terms of the cash trade. S&P 500 down 0.75% to 56.45 after a 9-day run, the longest run we've seen in 21 years. The U.S. 10-year yield right now at 432.97, so call it 433. There's the dollar, the Bloomberg Dollar Index, which I think is a much better trade-weighted way to look at the U.S. currency than the DXY that Wall Street has relied upon for decades. 12.19 on the BBDXY, and then NYMEX crude down 1.5% to $57.43. Coming up, we're going to head to Beverly Hills for the Milken Institute Global Conference. We're going to be spending a lot of time there over the next couple of days. We kick it off today with Apollo CEO and co-founder Mark Rowan. He joins our very own Shonali Bastick next out of Beverly Hills. This is Bloomberg Open Interest.
Wednesday, the Fed decides.
It is the central banker's dilemma. Downside risk to growth, upside risk to inflation.
They are wait. This is a serious moment. I do not think the Fed can just sit on the side.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
They're expecting stagflationary-like environment.
They are going to be on hold until they have hard evidence one way or another.
Bloomberg surveillance, the Fed decides, starting at 1:30 p.m. Eastern.
Let's cut right to it. This is Bloomberg's new show, Primer. Technology is $1 trillion game. Won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused on how can you elicit intelligence from brain cells in a dish.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on?
So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
And we welcome our TV and radio audiences. I'm Shonali Basak at the Milken Institute Global Conference in Beverly Hills. And joining me now, Apollo CEO and co-founder Mark Rowan. And what a time to be speaking with you.
Just a few things going on.
A few things going on, but a lot today alone. We have the Treasury Secretary speaking at 8 o'clock here Pacific time. We had Elon Musk speaking last night, and the President of the United States changing his tune on tariffs. Where do you think the end game is, given that the tariff talk is taking up so much of the discussion here?
Look, what the administration wants to do, in my opinion, is not wrong. We are the freest trading country in the world and have been since the end of World War II. It is not clear to me that we have to be, or that we should allow allies and strategic competitors to inhibit our access to their markets. We can take issue with how it's being done and the uncertainty it's creating, but the president and the administration start with a really strong hand. Low unemployment, good job growth, massive capital investment over the last 4 years and continuing in the U.S. So now is actually a good time, but we have uncertainty. And in the face of uncertainty, people do not make new investments, they do not hire, they do not make moves. We likely will cause 2 quarters of negative growth if we in fact don't resolve the uncertainty. So until we have resolution of what the rules of the game are, it's going to be slow.
A lot of people talk about the potential for a recession, but little are people talking about the severity that could exist in the potential for a recession.
Look, now we're talking about forecasts and projections. In our firm, when we were raising rates 300 and 400 basis points, we talked about a non-recession recession, which is a correction in asset prices, but not necessarily in labor. We kind of see the same thing happening again. It's not to say we won't have some fallout and some adjustment, but we're starting from a place of 4% unemployment, good job growth. We are building infrastructure, we're building semiconductor plants, we're absorbing massive amounts of foreign direct investment. Like it or not, we're building Inflation Reduction Act factories. And now the president is channeling capital from around the world to come back here. Some days I wake up and worry about capital. Most days I wake up and worry about where will we get all the people to do this.
Now, you mentioned that you agree with what he's doing, but maybe not how in all the ways. To the extent that you think that this should be done differently, to the extent that you don't like the method of the change, what needs to change?
Look, this is now the toughest job in the world is now Scott Bessent. As I said, we want this administration to succeed. Every American should want this administration to succeed. So how I would do it is not really relevant. I will point out the following. U.S. and Mexico together should be the driving economic force in the world for the next 50 years. We have not been able to get there, despite 2 or 3 rounds of massive free trade agreements, the issues that separate us from Mexico are not existential to Mexico. As one leading Mexican industrialist said to me, if it takes tariffs to make Mexico great again, so be it. Inside of Mexico, there's a need for change. Imagine coming to the world with Mexico and Canada resolved first, and then taking people piece by piece, or country by country. We would just be in a much stronger position to do what we need to do to reset the terms of trade.
But in the meantime, you had mentioned it as well, that people are on hold. Businesses are on hold. A lot of businesses are at risk of layoffs if this continues. How long can this uncertainty continue without causing much greater damage?
Look, we're going to have uncertainty. We have uncertainty already. Until we see critical mass of trading partners agree to ongoing new economic relationships, we're going to have uncertainty.
But that could take years, couldn't it?
That could take years. I don't think the administration will allow it to take years. Clearly, what they are trying to do is to create positive momentum by getting country after country to agree to new terms of trade. If that happens, this could be very short-lived. If it doesn't happen, uncertainty could continue for a period of time. But we also have to take into account short-term and long-term. Uncertainty will eventually resolve itself. Longer term, the way we've done this, we have done damage to the U.S. brand. The brand for stability, for predictability, for regularity. That will eventually have some cost to us. Right now, it does not. What I've said is I see us moving from what was hyper-exceptionalism to merely exceptional, because I don't think there are good alternatives to the U.S. today, but that can change over time.
Let's talk more about the U.S. brand for a moment, because you have businesses across the globe, from Europe to Japan. Now, what are they saying? What are your investors in different regions saying about their willingness to put money into U.S. capital markets? Your deputy, John Zito, had written a letter to investors talking about the risk to the U.S. brand as well, the risk to U.S. capital markets.
Right.
Are you seeing any of that?
We will see it, but we're not seeing it yet. But think about the U.S. is still 60+% of all the capital raised in the world. We are in the absolute best position from a capital formation point of view. No one has what we have. That does not mean they will not want it over time. Everything that we want to do here, build infrastructure, next generation manufacturing, add energy, defense, next generation data and power. Europe wants to do exactly the same thing, but lacks any real source of long-term capital. In the Draghi report, Mario Draghi lays out what Europe needs to do to be competitive. And most of the report is focused on revisions to capital formation. Will Europe do that? I don't know. I think what John Zito points out in his letter, that they have the best chance relative to the U.S. to create this kind of positive momentum.
So then there's the question of what you do in this uncertainty. Now, recently you told investors just last week that you're willing to sit things out, you're willing to reduce leverage. However, you believe that you are one of the largest active buyers of assets post-Liberation Day. That is $25 billion in April alone. What are you buying?
So let's start. I talk to investors and I ask 3 questions. Are prices low? No, I do not believe prices are low. They are lower, but we're still talking about an average PE as a reference in the mid-20s versus 16 over time. Are rates likely to plummet? I don't think so, and our firm does not think so. Most of what we're doing is inflationary. Third, do we have heightened geopolitical risk? Listen to our conversation. There's heightened geopolitical risk. What do you want to do if those 3 things are true? I think you want to reduce risk. In credit, we're going up the capital structure, senior secured, investment grade, trying to reduce risk. We're not trying to make money by being a good credit selector in a volatile market. And in the equity market, moving from things that are growthy and things that are venture-y to things that are cash flow based and more hybrid in their outcome. So what did we do in April? We bought mostly investment grade. Ironically, mostly in the public markets. I think we will see this interesting dynamic take place. We have a perception that what's public is safe and what's private is risky. But what if we're wrong? What if public is safe and risky and private is safe and risky? In private, most people are set up to hold things for the long term. In public, we have this belief that we can sell something every day. In equities, that is true. In fixed income, it is not true in the best of times. It is certainly not true under stress. It takes 5 days today to sell an investment-grade corporate bond. we should expect in every risk-off moment public credit to trade poorly.
So what about the future? If you think that we saw some moments of market, let's say, seizure, right? You did see full moments where there were weeks at a time where the new issuance market was closed. Do you worry about liquidity into the year, given the way things are going? And do you think that the Fed would need to step in?
So I worry about liquidity, but in a different way than you're asking. I think there's plenty of money in the world. If we use that as a proxy for liquidity, could we have tough treasury auctions around political events? Absolutely. I don't think that is actually fundamental. What I worry about, and the biggest buildup of risk I see in the world, is we are brought up with an expectation of being able to trade everything every day. Everything is daily liquid. Your ETFs, your open-ended mutual funds, and so on and so on. In the equity markets, it's actually liquid. In the credit markets, it's not actually liquid. We just don't know that yet. We've seen it in the UK in something called LDI, where people thought they could sell something, and it turned out they couldn't. We're going to see that. We saw it in the run-up to COVID. We saw a little blip in the market over the past few weeks, which is why we ended up buying. But again, this notion that everything that's daily liquid is somehow safe is just a notion. It's just not true.
So I want to go back to something you were saying before, that this environment that we're facing could be very inflationary, right? If you believe that we are facing an inflationary environment, what do you make of President Trump's bid to try to get the Fed to lower interest rates at this juncture? Do you think it's possible?
Good news. I don't have that job. It's not even in the realm of possibility for me to do. Look, we are moving things from low-cost labor countries to higher-cost labor countries, particularly to the U.S. There are strategic reasons to want to do that, but we can't deny that that is inflationary in some ways. We are not relying on a global trading system to the extent we have previously. That is inflationary in some ways. We have a tight labor supply, 4% unemployment. We had good job numbers. We have no legal immigration. That is inflationary in some ways. Yes, are there countervailing measures? Energy prices are lower at the moment. Technology will eventually introduce savings. The key word being eventually. At the moment, the policies we're following have a risk of being more inflationary than otherwise, which generally will lead to higher long-term rates, even if short-term rates come down.
Mark, we thank you.
Enough macro.
I know, it's the macro world that we're living in, and we will be watching you closely because we are waiting for that fat pitch investment. Mark Rowan of Apollo, of course, joining us here at the Milken Institute.
All right, Shanali, thanks very much. Fantastic interview there with Mark Rowan of Apollo. Really interesting summary at the end from Mark there, that they are moving their labor from low-cost countries to higher-cost countries, and that will be inflationary, even as oil prices come down, even as technology starts to introduce savings, or eventually introduces savings. Coming up in the next hour, we have a lot more from Milken. We have Pershing Square's Bill Ackman. Shanali wrangling interviews out there. She's got Mike Gitlin, I should say, of Capital Group, as well as Paul Taubman of PJT Partners. So she's been working on this very hard, and she's going to knock it out of the park. In terms of what we've got going on in the markets today, we had a 9-day rally. It was the longest winning streak since 2004. That couldn't continue, could it? Right now we're down 0.75% on the S&P 500, back at 56.44. Back at April 2nd levels, we could see a swing during this day. Stranger things have happened. I'm Matt Miller. This is Open Interest.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
All right, here we go. This is Bloomberg Intelligence. That was Tom Keene and Tim Stenovic, Bloomberg Surveillance. Now we're into Bloomberg Intelligence. Myself and Paul Sweeney are here for the next couple hours to take you through everything that you need to know. You have ISM services dropping right now. The index for prices rising to the highest level since January of 2023. Overall, you saw a little bit more strain than expected in the services number. We got Bill Ackman coming up from Pershing Square in just moments, but let's get it all caught up here with a data check. Here's John Tucker.
And this Bloomberg Business Flash being brought to you by IBKR, with a year-over-year change in the U.S. CPI exceed 2.6% in April 2025. At IBKR Forecast Trader, the yes was recently at 26%. Start predicting today at ibkr.com/forecast. Last trading day for this contract is May 12th. Following its longest winning streak in about 20 years, S&P 500 starting the new week lower. All 11 major industry groups in the S&P 500 are down right now. And Callie Cox at Ritholtz Wealth Management says, you know what, it's anybody's guess where stocks are headed. Well, Skechers USA, the third largest footwear company in the world, today announcing that it's agreed to be acquired by 3G Capital. 3G Capital will pay $63 per share in cash for Skechers. Skechers shares right now, they are up close to 25%. And Ford Motor reporting earnings after the close. Tariffs threatening to wipe out billions in overall industry profits. And shares in Taiwan Semiconductor Manufacturing dropping out fears the stronger currency in Taiwan is going to dent its export earnings. Investors also want to know Berkshire Hathaway stock still deserves the Buffett premium when Buffett retires at the end of the year. And following shares of Berkshire, these are the Class B shares, they're down 5.6%. Overall, the S&P 500 down 29 points. NASDAQ 193 points lower. That's down 0.5%. The Dow Jones Industrial Average 60 points lower. That's down 0.1%. We check the markets view all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Alex and Paul.
All right, JT. Alex Steele here alongside Paul Sweeney, who got to sleep in today. How's that? Are you all out of sorts right now?
Totally.
You don't know what time it is?
I rode the train in like a normal person, talking strike
was one of the conductors.
Oh, man.
I was in negotiations with the conductors.
Okay.
Yeah, it's
and how that's all going?
It's not really good, I don't think.
Oh, okay. That's not very good. All right. Maybe we'll see him Friday. Maybe we won't. We have a great show lined up for you. We have tons of great content coming for you from Milken from Los Angeles. Tons of newsmakers there. It's sort of like Wall Street descending on Los Angeles. And we're going to take you there now. Bill Ackman is Pershing Square Capital founder and CEO. He'll be speaking with Bloomberg television anchor Sonali Basak when there's lots to talk about. You got tariffs, you have the economic environment, and you have a lot more questions than answers when it comes to policy. Let's listen in.
Yeah, thank you, Matt. I am standing by now with Bill Ackman. Of course, he's the CEO of Pershing Square, but also the new executive chair of Howard Hughes. Came in this morning with a $900 million deal. Of course, that brings your stake to more than $1 billion when you include all of your affiliates as well. Why? You said you're going to turn this into a diversified holding company. You said this is the intent to create a modern-day Berkshire Hathaway. How do you plan to make that happen?
Sure. Actually, our stake in the company is much larger. We talk about $1.2 billion. That's a $900 million investment that's being made by Ryan Israel, my CIO, myself, and other Pershing Square team members. And on top of that, our funds own a substantial stake in the company. So we're on a look-through basis, we'll own $1.2 billion. And our plan is to take this great company, which has been a real estate development company over its 14-year history, and transform it into a diversified holding company. That's the business plan. We're going to do that by buying great, really high-quality, durable growth companies.
Now, it's interesting, to the extent that you want this to be kind of the next Berkshire Hathaway, you know, we had some amazing news over the weekend here, historic really for Berkshire, Buffett stepping down as the CEO. Have you had any plans to reach out to Buffett himself to figure out how to do this?
So, first of all, I don't want to say we want to be the next Berkshire Hathaway. Warren Buffett's been an incredible sort of hero for me. I've learned an enormous amount watching the creation of Berkshire Hathaway over my career, and he's an aspiration. But Howard Hughes will be something different. We're starting out differently. Buffett started out with a business with not particularly attractive long-term prospects, as he acknowledged. In our case, we're starting out with a business that has very attractive long-term prospects. It's a wonderful business, but it's not a business that I would say Wall Street is assigned a real value to. But it's a very valuable platform. It's a business that's going to generate an enormous amount of cash over many decades. And what we're going to do is we're going to take the $900 million, and then over time, when and if excess cash is created at the real estate subsidiary, then we'll have even more flexibility to use that cash over time. And we've got a good track record investing in the highest quality growth companies in the world. We're going to do that on a much smaller scale as a controlling shareholder at Howard Hughes.
Now, you've mentioned also that insurance might be part of the future in a bigger way for this company. How do you plan to expand on that insurance arm? And to the extent that you would be willing to do M&A, what would that entail?
Sure. So obviously, Berkshire's had the benefit. Buffett's an amazing investor, but the enhancement to his selection of great companies and securities is that he's financed that not just with equity, but very low-cost leverage in the form of insurance float. That's something, obviously, that you learn when you follow Berkshire Hathaway. And interestingly, most other insurance companies are standalone public companies. Here you have an insurance company that's a major part of a diversified holding company, and that's given Buffett and Berkshire significant advantages in terms of increasing the flexibility of how that float can be invested. So that's a model that we're going to pursue. We're going to likely pursue it by recruiting a great CEO and a team and building a company, maybe from scratch, maybe from a very small scale. That's sort of part of the the business plan.
Now, one big question I'm sure a lot of investors have for you is how are you going to ensure that the Howard Hughes business doesn't compete with Pershing Square, both in terms of investments as well as your time?
Sure. So Pershing Square's strategy, the strategy of the Pershing Square funds is to buy minority stakes in large cap and mega cap companies, in great businesses, in some cases that have lost their way, and we can be helpful in making them more successful, or in great businesses that for whatever reason the market is not assigning a proper value, or people responding to news unrelated to the business and those stocks get cheap. But it's a minority investment strategy in very large companies. Howard Hughes, we're going to use Howard Hughes to acquire controlling interests, 100% interest in private companies, maybe some small cap public companies, much smaller scale, and controlling interest.
Now, what about the rest of Pershing Square as well? A lot of people still have a lot of questions. Do you plan to still raise money for a closed-end fund?
Sure. SEC doesn't like us to talk about potential future offerings, so I have to defer on that one.
So what about for Pershing Square overall? What's the long-term plan? There has been an IPO floated around, but do you still see yourself getting there, and over what kind of timeline?
So the long-term plan for Pershing Square is to build, is one, to deliver great returns for our investors and our shareholders, and the shareholders of Howard Hughes. And of course, that benefits Pershing Square, the Pershing Square funds, because we have a major investment already in Howard Hughes that we look forward to making more valuable. So that's kind of our laser focus. I do want to make Pershing Square an entity that survives. We manage permanent capital, so it's important that the a manager that oversees that permanent capital becomes a perpetuity. And while Buffett is 94 and still incredibly active, if I want to compete with that track record over time, it's important that we set up an entity that can survive for the very long term. So I don't know exactly what form that will take. We did sell a minority interest in Pershing Square to a group of investors last year, and we set up an independent board of directors, and we really run Pershing Square, the management company today, almost as if it's a public company from a governance and other perspective.
Now, I want to talk about your portfolio as well here, because with this new company, you had mentioned small and medium-sized businesses. Of course, you're exposed to a large swath of the American economy through Pershing Square already. How are the tariffs impacting you today, and how do you think that impact will last 6 months, 12 months from now?
Sure. So first, we try to own businesses where no matter what's going on in the world, what we call extrinsic factors we can't control, whether those are commodity prices or tariffs, excuse me, or a pandemic, interest rate volatility, don't have a material effect on the business. So we look for what we call durable growth companies. And these are the kind of businesses we're going to try to find for Howard Hughes. They're very much insulated from things macro. Obviously, they do better. Every business does better in a positive growth environment, does worse in a weakening growth environment. But our companies today, other than Nike, I would say, have really not been directly affected by tariffs, although market prices move up and down based on uncertainty.
Does that not bother you, though?
No, it doesn't bother me. Look, the president has an objective here, right? It's critically important for the United States, strategically and defensively, for us to source certain key products in the United States, have them be manufactured here, whether those are pharmaceutical ingredients, or stuff we need to defend the country, to build weapons, AI, anything AI-related, semiconductors, and so creating the incentive for those important high-value manufacturing and other activities happening here, I think is critically important. For 80 years, beginning after World War II, the United States, helped save the world, and then helped save the world economically, and allowed for trade barriers to be built up over time. That's allowed Asia, excuse me, countries in Asia, Europe, to Marshall Plan, et cetera, to recover. And then over time, those tariff barriers have remained, even as those countries have become very aggressive competitors of the United States. Think the Japanese auto industry and how it, has really dominated U.S. Auto industry over time. And it's time for those trade barriers to come down. And the president is using tariffs in a tactical way to address those trade barriers, which are not just tariffs, but there are other things that make it difficult for U.S. goods. The other issue he's trying to address is balance of trade, right? We still have a balance of trade issue. Buffett actually talks about this long-term as a problem, and he wants to incentivize companies to do business in the United States. Now, the way he goes about things, as we've seen from the president, is a bit of I would call it shock and awe, which tends to scare people, but ultimately he's a deal maker. He likes to make deals. And I expect, he I think did the right thing in pausing tariffs, reciprocal tariffs for 90 days. And I think that gives time to negotiate with our 18 largest countries. And I think the next step probably should be, I call it a 180-day pause, take down the China tariffs. That will give U.S. businesses that are actually under pressure. There are a lot of businesses, unlike the ones we own, that a tariff of 145% on goods they source from China can decimate the businesses, particularly small businesses that don't have the wherewithal to manage through this period of time. So I think we want to be economically our strongest when we're negotiating, The president, pausing tariffs for 180 days on China sets up a very interesting dynamic where, puts us really in the driver's seat. Give me 1 second. It's an important point.
Of course.
So right now, because of the announcement, every business that sources in China, every U.S. company, et cetera, is relocating their supply chains out of China. That's not going to change, even if the tariffs go from 145% down to 10 or down to 20%. So once we pause, China's under enormous pressure to make China a good place to do business, to eliminate these kind of trade barriers, and I think enabling a very successful negotiation.
So you were among the first to advocate for that 90-day pause.
Yes.
Did you talk to anybody in the Trump administration or the president himself? And are you in talks with him about this 180-day pause? I saw you post about that online as well. So you are getting more vocal about this idea. Can it happen?
I think it can certainly happen. I heard Scott Bessent was here yesterday. He seemed very constructive on where negotiations are headed. We shall see.
But more specifically, is he receptive to your idea?
I don't think it's a good idea for me to discuss relationships or conversations I have with people in the administration.
Fair enough. Do you think that there could be exemptions made? You mentioned small businesses. This is a part of the economy that is getting hard hit. You've said it yourself. How is this a Main Street strategy if small businesses are getting hit harder than the larger ones?
Sometimes you have to have some short-term pain to get a much better long-term outlook. But I think the president has made his points clear. And I do think it's important to kind of pause the China tariffs. That will take the pressure immediately off of kind of the smaller businesses. And, it's not just affecting small business. Now, by the way, there are some positive effects from the China tariffs, which, a number of, U.S. manufacturers, many are doing very well because, of course, people are looking to source product in this country. To the extent something's made in China before and there's someone you can source from in America, you're banging down the door to do business with them here. So there is a big boost to a meaningful number of small, medium-sized, and large businesses that manufacture in the U.S. But there is a negative effect on companies that don't have that flexibility or the nimbleness to move their supply chains quickly. That's what I'd like to see avoided.
Do you think that this can be done while avoiding a recession? Do you think that a recession is a foregone conclusion at this point?
I don't. I think I don't think a recession is a foregone conclusion. And I think there are real reasons for optimism. I just don't want this turbulent period to carry on too long. I'd like to see deals get announced and progress made, and then I think people can start looking beyond the immediate 60 or 90 days.
You mentioned that even after that 60, 90, 180 days, that tariffs will still be higher, right?
I don't know what the ultimate outcome is, and it's not just tariffs. You got to look at the overall effect of the various trade barriers coming down. Right, there are countries with low tariffs but still have enormous barriers to U.S. goods in their market, and so it could absolutely be a lot of reasons for optimism about the economy. So, one, the tax bill. Yesterday, the Treasury Secretary said it could be signed on July 4th. That's a very pro-growth initiative. Really, the deregulation process could be very pro-growth. For the country. Inflation has really come down meaningfully. Energy prices, gas prices, egg prices, right? That's a very positive thing, for our economy and for the consumer. I think the only thing that we suffer from right now of substance economically is the inherent uncertainty about the tariff situation. I think the sooner that's resolved, the more the economy can move forward. And there's also reason for optimism kind of geopolitically. I think it's likely we'll have, I think the Ukraine-Russia war can get resolved this calendar year, and hopefully sooner rather than later. I think the Middle East the temperature can come way down once we resolve by negotiation or otherwise the Iranian situation. So I'm an optimist, and I've always been an optimist about our country.
So before I let you go also, I want to have you weigh in on what's happening between Harvard and the Trump administration as well, because this morning you had called for the resignation of Penny Pritzker from Harvard's board.
Yes.
Now, have you talked to her personally or any of the other board members?
So I spoke to her, very early on in the midst of the events on campus after October 7th. I've only spoken to her once. And by the way, I don't know her well. I'm sure she's a lovely person. But at some point, you have to have accountability for what's gone on at Harvard, and I've not seen any accountability at the governance level. The notion that she's still chairing the Harvard board and leading the charge here, I think is a big negative, and I think they've mismanaged the relationship with the administration in a way that's enormously economically costly to Harvard and funding at Harvard, and you need a new face at the top of the, just even to make a deal, right? And again, I go to the corporate, Harvard's the oldest corporation in America. Go to any other corporation, if they manage the last 18 months the way that they managed, there would be a new chair and there would be a new CEO in place. The new CEO is there, but he's more interim. But they've done nothing in terms of accountability at the board level.
Has the ship sailed for Harvard in terms of a potential negotiation with the administration?
No, and I would love to be helpful there. I care enormously about the institution. I want Harvard to succeed. I think the president has a number of very key issues that are critical. It's not just the issue of anti-Semitism and pro-Hamas issues on campus. He makes some very good points about bureaucratic waste at the institution. I believe that if taxpayers are funding a private institution like Harvard, particularly one that has a massive endowment, the university is a fiduciary for those funds, and if they're wasting money on overhead and bureaucracy that really is interfering or certainly not enhancing education, they should do something about it. Education is about being exposed to diverse views, and if university, as I've said, becomes a political advocacy organization, query whether it should be getting taxpayer support.
Bill, we thank you so much for joining us here on set. That is Bill Ackman, who, of course, is the CEO of Pershing Square, as well as the new executive chair of Howard Hughes, fresh off of a deal just this morning, Matt.
All right, that was Pershing Square Capital founder and CEO Bill Ackman, along with Shonali Bassett of Bloomberg Television, out there at the Milken Conference out there in Los Angeles. We'll have more conversations coming from the Milken Conference throughout the day, so stay tuned. Market Drivers today is brought to you by Commonwealth. Join over 2,000 independent financial advisors who are taking control of their growth with advisor-centric support and future-ready technologies. Grow on your own terms with a partner dedicated to your success. Go to Commonwealth.com to learn more. We got red on the screen here. S&P off 28 points and NASDAQ off 100 points. That's a 0.5%. Let's take a look at some of the stocks that are on the move today. We're joined by Bloomberg's Denitsa Sokova. Denitsa, what are you looking at?
Let's start with Netflix. Obviously, that was a big move over the weekend news we had that President Trump plans to impose 100% tariff on films produced overseas. This is something very new. There is still a lot of development. Something that's not clear is if he plans to tax TV shows that are made overseas for international audiences, which is like the majority of Netflix business model. Netflix is leading the losses today. It dropped as much as 4%. The way it works is a lot of the movies are exported, but services like Netflix, Disney, Amazon, they produce shows for global audiences. So potentially, they could be impacted more by this. We also have a headline from Bloomberg on today that Netflix has $2 billion of revenue economic impact from India. So clearly, there are a lot of important international markets. But yet, the stock is up here today, 27%. So we're yet to see if this will actually be a lot of pressure for the stock going forward.
There's so many questions. Like if it's filmed overseas but edited here,
yeah, I don't.
Does that count? Or no. Visual effects is here? But what if you need to film something in a desert and it doesn't really work in here? There's so many questions that
Netflix
I have.
opening a big studio at the old Fort Monmouth
in New Jersey.
Oh,
yeah, you can't tax New Jersey.
Yeah, no, you can't tax Jersey, obviously. Yeah.
That's where my dad served as a medic.
Really?
Fort Monmouth War. And met my mom, a nurse.
Oh, there you go.
And produced yours truly.
And we thank them for that. All right, let's move on after Netflix down 2%. What about Tyson Foods?
Let's look at Tyson Foods. They're having a really tough day. They're down about 8%. What's happening is that protein producer reported mixed quarterly results. What we're seeing is pressure in beef margins. We're seeing some strength in chicken. I love the headline on Terminal. It says, chicken gains outweigh beef losses, which I thought was quite great. The company has been heavily relying on those elevated chicken profits. But what we're hearing from analysts is that this space is getting very competitive, and the recent boom may have already run out its course. So clearly, the reaction is not great, despite the chicken margins And the stock is down about 2% year to date. Of course, we have consumer concerns. We have so many things playing out there. So it's an interesting stock to watch.
Tyson, I just think chicken, but I forgot they're in the beef business too. So there you go. Peabody Energy.
Peabody Energy jumped 5%, and it's coming after the company considers walking away from a deal we've talked a lot about. It's the deal about acquiring Anglo-American steelmaking coal. This comes after a fire of one of their mines in Australia. The mine has been shut since a gas ignition in March, and Peabody said that it may terminate the deal if the issue isn't resolved within the time frame. There has been a lot of back and forth on that deal, and actually the stock has reacted positive whenever there's been a delay. The company previously said the acquisition was expected to close in mid-2025, but we're yet to see if this will actually happen.
And also just broad strokes here. I mean, the revival that the administration wants to see in coal, or at least not necessarily closing any coal plants, always a good thing for the likes of Peabody Energy. All right, Denisa, thanks very much. Denisa Sakova joining us from Bloomberg News. All right, what was really interesting, if we just take a look broadly at the economic data, ISM services coming in not as bad as necessarily maybe expected, 50.8, so we're still in expansion territory. Services index, coming in 51.6. I was looking at the wrong services index. Prices paid, though. Prices paid soaring. New orders higher, and employment below 50. So take that with what you will.
Yeah, I mean, it's coming back. I mean, it's solid right here. I mean, it's okay.
It's okay, but look at those prices, man. That was intense. All right, let's get a Bloomberg Business Flash here, get you caught up on everything happening in the markets with John Tucker.
All right, pairing some of the earlier losses, the S&P 500 down 36 points. It's down 0.6%, 56.50 right now. After we got that report at the top of the hour that you just mentioned, bond yields also rising. The data showing service provider growth accelerating. In addition to that, the material prices also increased in response to the escalating tariffs. Some of the individual company news: investment firm 3G Capital acquiring footwear maker Skechers. $9.4 billion is the price tag there. Skechers shares up close to 25%. And the transaction expected to close in the third quarter of this year. And BP's ADRs rising after we reported Shell's evaluating a potential acquisition of BP. Oil slipping after OPEC Plus over the weekend agreeing to another bumper output increase. What's the cost of production, did you say, 50 a barrel?
It's a range.
It's a range.
It's a range, but 52 is what I said that Goldman now sees WTI for next year.
All right, 56.75 on American crude, NYMEX crude. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Paul and Alex.
All right, John, looking at this 3G Skechers deal, the first thing I do is I go MA Go, and I see which of my banker buddies are getting paid. JP Morgan for the acquirer. Mizuho comes in and representing Skechers, so they came out of nowhere. My friends at Paul Weiss are the legal for 3G, and Latham & Watkins for the seller. So big firms on the street getting paid. John Tucker, thank you so much. We appreciate that. Alex Steele, Paul Sweeney live here in our Bloomberg Interactive Brokers studio, streaming live on YouTube as well. On the trade front, President Trump suggests that some trade deals may come as soon as this week. How about that? Ender Curran, global economy reporter for Bloomberg News. He joins us. He's down there in D.C. And how do you think this thing is going to play out here? Is it country by country by country by country that we're going to have to wait for trade deals to be announced?
Well, it's something of a tease from President Trump. We're about a month now, since just over a month since Liberation Day, and the president was making the point that there may or may not be some agreements coming this week. You know, he wasn't being specific. He was quite vague, and he was being asked by reporters about this. But what we do know from administration officials is that talks are ongoing with several countries. They have identified at different times. Japan is near the top of that list. India could be near the top of that list. South Korea could be near the top of that list. So there could be some kind of agreement reached with one of those at some point soon. Now, the question then becomes the details of that agreement. That's where everybody would be parsing this. What sort of moves had to be made on non-tariff barriers to satisfy Washington, for example? What kind of concessions had to be made on maybe investment into the U.S.? Where will the actual U.S. tariffs settle? All of those will obviously offer nuggets for sure, but it also may offer a roadmap for other economies to say, hang on a sec, we can do that too, and come to the table to the US and try and work it out. So, you know, we don't have specifics yet. It's a little bit vague, but clearly something's coming down the pipes at some point soon.
I understand that the agreement versus like an MOU versus a deal, they all mean different things. But do we think anything that's on paper at this point, even if it's a memo of understanding, would that count as getting something done and tick that box?
And as a role of Congress and all of this, so skeptics say, look, negotiating a real meaningful trade deal takes months, if not years, of protracted trade talks. Okay, so clearly that can't be done in weeks. Nonetheless, I think what people are looking at for is, first of all, what is actually agreed, but most importantly, where will U.S. tariff rates settle in the near term? So remember all of those, what were described as reciprocal tariffs, remember those levels that were set pretty high for, many trading partners right around the world. If the tariff level is maybe back towards this 10% baseline level, then that might suggest that, that's where things might settle. If you cut deals with the US, and you settle for that baseline 10%, that's the way forward. But of course, if it's not and that tariff level is higher, that's what I think a lot of people are going to keep an eye out for.
Who's driving the bus here? Is it the president? Is it his trade advisors? Who's kind of, because there's a lot of balls in the air when you think about all the countries that are presumably in negotiations with the U.S.
Yeah, I think there must be at least a dozen or so in serious negotiations. And of course, they say they're talking to up to 70, I think it is, all governments altogether. It seems to be different personalities playing different roles. Treasury Secretary Scott Bessent is clearly front and center for the Asia trade talks. He's kind of made that clear. The trade representative, Greer, obviously is kind of the technical guy behind the scenes. He would be involved in all of this. And of course, Commerce Secretary Howard Lutnick, he seems to be more vocal maybe on the European side, but they're all playing their role, they're all part of this. But ultimately, as all the officials say, and as we can say to the outside looking in, ultimately President Trump will make that agreement. He will decide whatever will be decided. The market rally in recent weeks will of course give the administration a lot of confidence that what they're trying to do is the right thing. But at the same time, we all know that they got pretty nervous, a couple of weeks ago when they did pull back and put that pause on reciprocal tariff. So a lot of focus on what level of tariff will be agreed in the near term and what the roadmap will be from there on for all the countries involved in this.
All right, and super appreciate, thank you so much, Enda Curran, Bloomberg Global Economy reporter, joining us on those trade deals that may come as soon as this week. It was the bombshell news over the weekend. Even my husband talked to me about it, and that is Warren Buffett leaving the CEO head at Berkshire Hathaway. Matthew Palazzolo is Bloomberg Intelligence Senior Analyst for PNC Insurance. He was there on the ground. Matthew, what was it like when he said that in the last few minutes of his address?
So I was there, boots on the ground. So I have to admit, it's cold in there. It's dark. People are up since 4 o'clock in the morning.
You're really selling it right now.
Yeah. Well, the guy in front of me is slumped over asleep in his chair. And I looked at my watch and I said, oh, there's only 5 minutes left. And I said, it's kind of not that eventful of a meeting. I literally said 5 minutes left. And then Buffett looks up and he says, oh, I just got an alert. There's 5 minutes left. I have to say something before the meeting ends. And once he said that, I think everyone in the building knew what was coming. I was personally really sad. Like I was almost choked up. It was a sad moment. He talked about it. He got a big standing ovation. It was, you could definitely feel the emotion in the building.
What do we know about Greg Abel? He's been kind of the successor to Mr. Buffett. He's been kind of running things really for a number of years now, right?
Yeah, and I mean, a couple of things on Greg. So, number one, he's been with Berkshire since the early 90s. Okay. So he's been around for a long time. He was vice chairman 2018. We've talked about over the years how Buffett has talked about at these meetings that he's been ceding a lot of responsibilities and control to Greg and how he's been working on, kind of these bigger deals to go over time.
What do we think the premium is going to be worth now? No one can replicate Warren Buffett, period. The structure could still be there to run a very successful behemoth, right? But it's not going to be the same.
Yeah,
Alex, what's the premium there, do you think?
Certainly some of the magic is gone, right? And the Buffett premium. I would argue that, you see the stocks down, I think it was 6% when I left my desk. It kind of makes sense to me. You probably had people with large unrealized gain positions in it, and they're like, kind of, Buffett's out, now I'm out. Similar to why Berkshire itself sold their positions in Apple, Bank of America. But I would look forward to the future and say, maybe you're not getting these kind of home run deals, but maybe you're getting better capital allocation, maybe you're getting a dividend, so maybe those things offset each other to some degree.
That's where we got to go. What's it?
350 billion.
350 billion amongst friends. Got to put up a significant dividend yield, and you got to start buying back some stock.
Yeah, I mean, so
why can't that happen today?
I don't think it's happening today. I don't think it's going to happen this year, right? I think when Greg takes over, I think he will be very cognizant of making dramatic changes. But I also feel like Berkshire got away with a lot because Buffett, right? Yeah. So that will not hold water anymore, and I think it would behoove Abel to really do something with the capital, and the investor questions would carry more weight.
How is the company doing?
Fine. The first quarter, okay. I didn't love the first quarter results.
Fine is not a great. I don't love the word fine.
I mean, $10 billion a quarter is good, right? That's the kind of earnings power. There were just a couple of signals in the first quarter results that I didn't love, and I'm an insurance guy. They had adverse development, which means some claims from prior years were costing more than they expected. The wildfire losses were a little bit more than I thought they were going to be. The fire loss is that's not a go-forward thing, but the reserve issues are a little concerning. But the beauty of the company is such a behemoth, so many streams of differentiated earnings that they kind of offset each other. So their earnings have been better than expected the past couple of quarters. So I thought they were in line for a kind of slight disappointment.
30 seconds. Some of the parts valuation, where are we with this company?
So our Bloomberg Intelligence midpoint, some of the parts analysis comes up to like 1.1 trillion, which was kind of before the meeting. The stock was trading slightly above that. I don't know if it's below that now. And I mean, I don't claim to know what Buffett knows, but they haven't been buying back shares for a couple of quarters. So I think he's probably viewing it very much in the same way as fully valued. And the stock's at all-time highs.
I wonder what he does now. Like, if you're Warren, he's 94
I don't know.
years
He's still
old.
chairman, right? He's
still chairman.
Chairman.
Still be chairman
got
for a little
stuff
while.
He's got to do. You're 94. Like,
I know.
I don't know. Relax.
Yes, exactly.
I'd take that at my age.
I would too. Yeah. All right, Matthew Palazzolo, thank you so much. We appreciate that. Matt Palazzolo, he's a senior analyst who covers all the property and casualty insurance companies for Bloomberg Intelligence. Boots on the ground in Omaha over the weekend. Mr. Buffet, as Tom Keene refers to him, stepping down at the age of 94, and just obviously historic run there. S&P down 38 points, the Dow off 84 points, NASDAQ down 160 points, that's 0.9%. Yields a little bit higher here, 10-year Treasury 4.35%. We'll have more coming up. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And 10 of the 11 major industry groups in the S&P 500 lower right now. From the Bloomberg Newsroom, I'm John Tucker with this Bloomberg Business Flash. We have paired some of the earlier losses, though. The biggest drag right now coming from energy as crude oil continues its slump. OPEC Plus over the weekend agreeing to increase output. So that's raised concerns about a global glut and decreased demand because of the trade war. Then you have Berkshire Hathaway shares. These are the Class B shares, down 5.3%. For one of the market's biggest losses as Warren Buffett decides to retire. And as the Fed begins a two-day policy meeting this week, Chris Verone at Strategas Securities says economic growth does remain a big concern.
When I look at what the market's trying to tell us between machinery stocks weak, transports weak, we just talked about oil on the lows, that doesn't sound like a particularly robust economic picture despite Friday's payrolls.
And right now, the S&P 500, 25 points lower. That's down 0.5%. The NASDAQ 100 down 119 points. That's a decline of 0.6%. And the Dow Jones Industrial Average just turning positive, just about 3 points higher right now. Shares in U.S. media entertainment companies, that's falling after President Trump announced plans to impose a 100% tariff on films produced overseas. Netflix, one of those stocks that's lower right now, down about 2.2%. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Alex and Paul.
All right, John Tucker, thank you so much. We appreciate that. Alex Steele, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. In just moments, we're going to bring you some discussion with PJT Partners Chairman and CEO Paul Taubman, speaking with Bloomberg's Sonali Basak out there at the Milken Conference in Los Angeles. We'll bring that to you in just moments. Alex, WTI crude oil, 56 and change here. I mean,
it's not good.
Is this a supply thing, a demand thing?
It's totally a supply thing coming from OPEC Plus. If you take a look at the curve, for example, prices today are more expensive than prices, say, in a year from now, which indicates that demand is still holding up. This is purely OPEC pumping supply into the market. And to John's point earlier, Dallas Fed survey says that anywhere from 26 to 45 per barrel are how you cover operating expenses. So you got to keep the lights on. So we're not near that in any way whatsoever, but to profitably build a new well, forget it.
So, interestingly enough, still $3 a gallon, so it hasn't translated into lower retail prices for the refined product.
It will, though. Usually it's like a week or two or something.
I don't know, because refiner margins haven't been great and they're slowly getting better. So they're going to want that nice, juicy crack spread there. If prices get too weak, then they're going to stop refining, and then all of a sudden you have a different issue.
Interesting. All right,
I leave you nowhere with crack spread. There's literally nowhere to go from there. Yeah.
Yes,
You're welcome.
I love it when he talks about crack spread.
Oh, yeah.
Who doesn't?
Awesome.
Guy Johnson always used to love that when we would anchor together on TV. But it is definitely something to watch when we get the independents. And oilfield services guys are going to be hurt by this, too. At what point do you have to lay down rigs? Citi had a nice note out about that earlier today.
Eric writing in, entering summer travel season leaves gas prices elevated. So there you go. Well,
that's on the demand side. Thank you, Eric. We appreciate that reporting. Very good. Yeah, go ahead.
I was going to say, we're going to have that. That's coming up. So, I mean, we'll keep an eye on that. And Landman approved for a second season, so you got that coming. All right, right now, Los Angeles, Milken, that's where all the big hitters are, including our own Sonali Basak. She sits down with PJT Partners Chairman and CEO Paul Taubman, talking about the banking business, M&A in particular, one of the biggest M&A bankers out there, Paul Taubman. Let's listen in.
And we welcome our television and radio audience. I'm Sonali Basak at the Milken Institute in Beverly Hills, of course, a global conference here. Joining me now, PJT Partners CEO Paul Taubman, who is one of the greatest deal makers of all time. It's fair to say that you've worked on some of the world's largest deals over your career, but you're also quickly building an investment banking firm to have more than 1,000 employees now, I believe, more than 1,100.
Well, first of all, Sonali, thank you very much for having me, and it's great to be here today at Milken.
So you're here at Milken at a time where, of course, everyone is trying to navigate through volatility, as you've been talking to me throughout the commercial break. So how are they doing that? When you talk to your CEO clients around the world, are they on complete hold right now?
No, I don't think that's the case, but the risk premium has clearly gone up. And what that means is everything is still being evaluated. but it's done with a much higher hurdle rate, and you're seeing that everywhere. You're seeing it in credit spreads. Credit spreads have moved out considerably. You're seeing it in PE multiples, where earnings estimates really haven't moved, but the multiples come down because the risk premium is up. And you're seeing it in corporate boardrooms. So transactions continue to happen. We're on pace for the moment for similar transaction volumes to last year globally. The number of transactions is way down, and a lot of deals that otherwise would have been revealed and presented to the market are on hold because we have an environment where it's very difficult to understand where we're going to land in all of this.
Are they on hold, or are those deals dying to some degree? Because if you're a buyer and you're trying to acquire a company and you don't know how their goods are going to be taxed around the world, how do you buy a company without knowing that cost?
Well, first of all, very little has been completely abandoned. Things are just being slow-walked for the moment because every CEO has their to-do list. They have their want-to-haves, they have their must-haves. But it's difficult to land on a transaction and present it to the market in a period of maximum uncertainty. So when we look at our own firm, we're seeing mandates are at record highs, but getting those mandates to announcement, that's what's very difficult for the moment. And every day you're still seeing merger Mondays. You're just seeing merger Mondays with a small m, not a capital M right now.
And a takeover Tuesday here and there. You know, it's interesting. You not only have a massive M&A practice, you have a restructuring practice that's pretty historic, used to be back at Blackstone. What are you seeing now? When you look at the environment, are people looking at severe distress in some industries, or are they on the brink of it?
I think what you're seeing is, look, stress is building in the system. And if you look at the current posture on tariffs, it's really designed to create maximum uncertainty, maximum stress, to get to better aligned trade agreements for the U.S. But while we're in this period, as stress builds and uncertainty builds, you're seeing it with credit spreads. If you just look at beginning of the year till now, credit spreads on the weakest credits are up 180 basis points. That's a sense that stress is building. If you look at where investors want to move to, they want to be in the highest parts of the capital structure. They want to be more senior. They want to be invested in the higher quality, higher rated companies. So we're seeing as active a restructuring market today as we did last year, which was a record. But I see this really as the potential for a step function increase. And the stress is fundamentally in areas that are most affected by this tariff uncertainty, automotive probably being the leading edge of that.
Well, give us a little more color there. To the extent that you might see that step function higher, when? How long can this go on for between those companies dealing with some pain now to what could barrel into much larger pains, even bankruptcies?
Well, I think like anything else, what's the old saying, you know, you go broke slowly and then you go broke quickly. I think right now companies are feeling the stresses and strains. They still don't know what the full tariff regime is. They don't know their ability to move supply chains. They don't know their ability fully to pass on a lot of these costs to the end users. And until a lot of that sorts out, the business models are really in stasis, where the economic model hasn't changed very much, but the risk is meaningfully greater. And what that starts to do is it makes financing significantly more expensive. So the first place you see it, Shonali, is in availability and cost of funding, and that started to tick up appreciably. I think we're still in the early days. Nothing is imminent, but stress is building.
So you also said at the same time that M&A mandates are at a record high. And if you're watching from the sidelines, it's pretty incredible to know that, right? Because you have not seen that flood of deals. What kinds of deals are being talked about right now? Are these massive transformative deals that will allow companies to take advantage of lower valuations? Or are they actually the other way around? Are they spin-offs to allow people to start to shed some fat at a time where investors are going to be very scrupulous?
So, Shonali, the answer is all of the above, but let's go region, let's go type of transaction. So in Europe, we're quite bullish on Europe. I think the transaction levels in Europe are going to improve appreciably. Part of it is you have in certain industries, highly fragmented industries. You have financials, you have defense, you have communications. Those industries are going to see significantly more consolidation. So those dialogues are active. The next thing is, you've seen European valuations disconnect from the U.S., and even though they've outperformed year to date, there's still compelling value there. So take private opportunities, probably more of that in Europe than in the U.S. And then the third is in Europe, you have companies that have significant U.S. presence that want to get inside the trade barriers, inside the tariff barrier, and as a result, there's more desire to come to the U.S. In the U.S., a lot of this is driven by sponsors, and I think we've talked a lot about the fact that the flywheel of monetizations has come to a creeping halt. Every alternative asset manager is trying to create liquidity for their LPs, and they have companies that have held for longer than they typically do, and they're looking for ways to create public IPO alternatives and M&A alternatives. And with the public markets so broken right now, increasingly they're trying to find M&A takeouts.
It's incredible because we've seen that prolonged monetization process for years now. We've been sitting here waiting for private equity firms to sell. Their investors want their money back. I talked to the CEO of Oaktree last week. I asked if the chickens are going to come home to roost. Is this the moment where there could be bigger issues? He's saying he saw some secondary funds being sold for 50 cents on the dollar. That's a pretty incredible number. I'm wondering what you're seeing in terms of pain under the surface.
Well, typically we're seeing every LP is looking in this uncertain environment to reweight, and with the market declines and the lack of monetizations, they're finding that they're overweighted to the alt space. So number one is a lot of these institutions find themselves overweight and they want to reweight. The second is what's going on with universities and the like. They're trying to create more liquidity in their endowments and the like and move out of illiquids into liquids. So what we're seeing is a lot of desire and a lot of portfolios coming to market. The reality is when you're selling a portfolio of blue chip private equity sponsors, there are real discounts, but they're nowhere near the discounts you're suggesting.
Well, so are you saying much of this is a potential flood of selling that's going to come from endowments, given the pressure they're under? Is it almost an idiosyncratic thing going on?
I think what's going on is you need a release valve somewhere, and you can't continue to commit and fund monies to the asset class, without getting a return. And if the IPO markets are very difficult to attack, if it's very difficult to find M&A buyers in this market at premium values, the release valve is increasingly LPs selling portions of their stakes to create liquidity, and GPs trying to do continuation funds to create liquidity.
Now, if I know anything about PJT and you, it's at times of market turnover, tumult, whatever you want to call it, you lean in. Now, when you're talking to a lot of your rivals out there, do you think that this is a market where M&A has slowed down and there might be job cuts? There are going to be people looking to move to places that they're going to capture whatever activity there is. Is it going to get messy out there?
There's always the risk that it gets messy. I think the banks are better capitalized today than they've been in decades. I'm not really worried about systemic issues for the moment. What I do see, though, is with a slowdown in transaction velocity, it's easier for bankers to move from one firm to another. It's most difficult when you have a flood of mandates, and when you go on gardening leave, you're disappointing your client. The friction costs are low right now. We're leaning in. We're trying to take advantage of it. We're going to continue to grow.
We'll keep an eye on that. That is Paul Taubman of PJT Partners. Matt, back to you.
All right, that was Shonali Basak speaking with Paul Taubman, PJT Partners and Chairman and CEO. Really great interview there, wide-ranging, very fascinating to get that view on the markets right on the heels of Milken opening in Los Angeles. In the markets, of course, what I'm paying attention to, what's happening in the commodity market, in particular crude. You got WTI down almost 3%. We're now at 56. Brent crude down over 2%. We're now down at 59. Mike McGlone is Bloomberg Intelligence Senior Commodities Analyst, and he joins us now. Mike, obviously the latest downside was triggered by OPEC Plus pumping over 400,000 barrels of oil a day in June. Second month in a row, could be 3 months. It feels like at least some analysts are calling this the new standard now. What's the downside?
40. Yeah, if I, you know, the rule, if I keep saying the same thing, eventually be right. The key thing is for now, WTI crude oil, the low for the last couple, this year has been around $55 a barrel, and last night. That was basically the average price in 2019, and that's basically what Bloomberg New Energy Finance says is about the break-even cost. They said it could go down to 50. It's all it's done is gone back to its break-even costs and the world's largest producer and now net exporter. The question is, what does it take now to really shut it down? With the whole world tilting towards recession, I think we stick with that pattern since 2008. Every time it got above 100, it eventually did not bottom until around 40. I think that's where it's going most potentially this year. Right now, I don't see what's going to really make it stay above 65.
So what's the feeling out there, Mike? Is you know, Alex and I were talking about this, and she was mentioning the supply issue here, but you know, I'm sure it's also reflecting the fact that maybe demand's not going to be that great. So, I mean, are we seeing this across the commodity space?
Oh, exactly. Well, exactly. It's the high price cure, Paul. The significant development in crude oil starting last year when we saw declining demand for diesel in the U.S., Europe, and most notably China. Imports of crude oil from China have been rolling over. It looks just like the U.S. did about 2005. That's when our total imports and our total consumption of crude oil and liquid fuel started tilting downwards. And that was just efficiency. Now, 50% of sales of automobile sales in China are EVs, and that's all going to construction, to other trucks and industrial vehicles. So the trend is very bad. At the same time, we're facing these tariffs. The significance of what's happening is these were existing trends were in place before the U.S. election, which is the things I've been pointing out. And it's the way it works. It's the high price cure. Prices get high, like when Iraq invaded Kuwait, and then they get low. Like a couple years later, it bottomed at $10 a barrel after peaking at 10. To me, 40 is the new 10. I think it needs to get to near that level. The one thing that's different now, it seems like everybody's bearish versus everybody was bullish at 100, which now you have to be a little bit careful with the bearish stance. But I can't see it stopping, particularly if Gina Martin Adams is right and the U.S. stock market continues downward for a U.S. recession.
Yeah, but I always do this with Mike. It's always the fun part. One thing that is different this time, however, is that large oil producers are much more capital disciplined than they have been, in that they may not be as exposed immediately to those lower oil prices. So offshore projects, they're a much longer cycle, as long as the curve doesn't totally deteriorate, et cetera. The smaller guys are going to be hit. The private company is going to be hit for sure. But the big guys maybe have a little bit more flexibility than they might have had in the past. Is that worth anything to you, Mike?
Not really. That's longer term. People have been, well, Alex, you've seen it. The people who have been really bullish have been pointing this out a couple of years ago, and they were wrong. Because the key thing to remember is, number one, first of all, that curve. The curve has been in backwardation for a while. It means that further out future has been lower. Why? Because a lot of producers are selling ahead. That's normal backwardization. That's from the past. In the meantime, you can drill now one drill and do, I don't know how many horizontals that go up 4 miles. Rig counts in this country are the same as they were in 2010, yet production's doubled. So it's a new world. And that's the key thing to remember. Rapidly advancing technology is bad for both sides of crude oil. We're replacing the demand side from people like me who drive EVs, and we're adding more and more supply. Not only that, from people like me who live in the Corn Belt, we can get a lot more of our petroleum from biofuels and ethanol. It's just a bad trend. And now that the world's heading towards that recession, I think the low price cure is still going to be around 40.
How about gold here? Making, almost near its high here, just moving higher here?
The disparity between gold being up almost 30% in a year and crude oil down almost 20% a year is a 50% difference. That's only happened a few times in history. The most significant was 2008. Gold was about 6%. Crude oil is down 50%. You see the tilt there? That's the thing I've been writing about for commodities for almost two years now. The tilt from commodities is global recession, and now with these tariffs, it's got a good reason to accelerate that. So gold got a little expensive, about $3,500 an ounce. I'm really scared it's going to end the year higher, which means significant recession. And key force to make gold go higher is more deflation in the U.S. stock market.
If we don't get a global recession, Mike, what commodity is most dislocated from an economy that's going to hold up all right?
Well, it'd probably be crude oil, because I think to me, the nail that might be searching a hammer is copper. Copper's still up about 16% a year, and that's U.S.-based copper. In London, it's almost unchanged. It's down. It's up because of tariff reasons, but you and I know what happens in ARB. When you get a major dislocation like that, and global demand might be demanding because of recession, copper is the one I think will get hit if we do get the recession. But what won't, if we don't get a recession, is crude oil would be the one that kind of significantly bounce, because copper's already up. That's the thing. The risk is, to me, this crude oil trend dominoes, tilts towards more deflation, and the hammer keeps hitting next commodities. The next one to hit is copper.
All right, Mike, thanks so much for joining us. We'll get to pork bellies next time, of course. This is Mike McGlone. He covers all the commodities. He's a senior commodity strategist for Bloomberg Intelligence. He's not in the Corn Belt anymore, folks. He's down there in Miami Beach, and he's never coming back. Let's be honest about that. Looking at Bitcoin, it's off 1.9% today. I'll call that out for Tom Keene. I know he's listening. Right around $94,000 per token. The S&P's off 19 points. The Dow up 41. The Nasdaq off 90 here. You're listening to the Bloomberg Intelligence program here today. Alex Steele, Paul Sweeney. We are live here in our Bloomberg Interactive Brokers studio. We're streaming live on YouTube as well. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by ShipStation. Stay tuned for the latest market news and industry research. Let's go to John Tucker and get a Bloomberg Business Flash. John.
All right, guys, the major stock averages, they have turned mixed. The data this morning showing a pickup in growth at U.S. service providers, which is the biggest part of the economy. That lifted sentiment a little. Stocks came off the lows of the session. Right now, the S&P 500 down 18 points at 56.68. The NASDAQ Composite Index, 89 points lower. That's down about 0.5%. The Dow Jones Industrial Average up 57 points. That's a rise of about 0.1%. Among the leaders in the Dow, shares of United Healthcare right now up just about 1.5%. Energy, the biggest drag on the S&P 500 as OPEC Plus agrees to increase oil production. Meantime, Chris Harvey at Wells Fargo is hopeful investors are getting more clarity from the Trump administration.
I think we're past peak uncertainty, and what we do is we look at it this way. He went very hard very early. In order to get that pressure back, I think you'd have to put us into recession. I don't think this administration wants to go into a recession because what it would mean.
Was Donald Trump announced 100% tariffs on films made outside the U.S. Shares of companies like Netflix and Walt Disney are lower. Netflix right now down 1.8%. Another movie I'll never see, Thunderbolts.
So good. It was so good.
Oh, of course you saw it. The latest film in Disney's Marvel Cinematic Universe of superhero titles, #1 at the box office. $76 million in sales at U.S. and Canadian theater. How much was your ticket? How much was the ticket?
For the three of us, it was 60.
One. 60?
So it's 30 a person. Mm-hmm.
My little theater, the popcorn is more than the tickets.
Oh, well, that's for sure. We have the special truffle salt popcorn.
Of course you do.
Yeah.
Because you're Alex.
Exactly, because we're
Alex. We check
Alex.
the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and it's your Bloomberg Business Flash, Alex and Paul.
All right, it's so good. All right, I want to take you back now to Milken Conference. It's kicking off right now as we speak. Treasury Secretary Bessent was talking about solidifying the position as the home of global capital and leading U.S. resilience, and said that the U.S. markets are anti-fragile. Let's go right now to Milken.
Killed 1.3 million people last year, or that nearly 2 billion people still live without the internet, which in today's world means no access to basic education, telemedicine, or economic opportunity. These aren't just numbers, these are actual lives, and a sobering reminder that the distance between what we can do and what we are doing is still far too wide. We need to close this gap. But how? We know that innovation and opportunity must go hand in hand. Breakthroughs in biotech, AI, and fintech are moving at an exponential pace. But if those breakthroughs benefit only the few, then we're failing. Technology should not be a luxury, it should be a lever, expanding access to healthcare, to capital, and to opportunity in every corner of the world. And at the core of that effort is something we value deeply at the Institute: diversity, in perspective, in people, in problem solving. The future will not be built by living within our own echo chambers. It will be built by bold, inclusive coalitions that reflect the world we're trying to realize. And we have many past successes to
You've been
lead the
listening
way.
to the CEO of the Milken Institute opening up the Milken Conference when Wall Street really descends on Los Angeles. We're going to be taking Treasury Secretary Scott Bessent live as he starts his panel in just moments. We will get that to you. No doubt, everyone who's anyone is definitely in the halls of LA.
I'm not there.
Yeah, but
I'm not there.
I
John's
said
not
everyone who's anyone, guys. You just not pick up on that cue. In the markets, you're looking at a sell-off all across the Treasury curve, but nothing too dramatic. The 2 years only up by about at 2 basis points. We did get ISM services, which is confusing because prices paid was a lot higher, but the number overall was okay. So reading through those tea leaves was a little complicated. And equity markets are pretty mixed, but volume is terribly light, Paul, on this Monday. Yeah.
Well, I mean, is everybody working today? I don't know. I mean,
no, they're all at Milken.
I know.
That's what's happening.
Asia's, we'll see. But I don't know. We'll see. We're here. But yeah, you're looking at, on the S&P, about 25% lighter than usual volume on the S&P.
There you go. Today. Well, let's take a look at some of the stocks on the move today. We're now joined by Bloomberg's Lisa Mateo. All right, Lisa, what are you looking at?
Sorry, just running in here.
She literally ran back and forth.
She was in the
studio,
then we kicked her out, and then we said, no, come back.
It's good, it's good. But that's what we do. That's what we do. So we've been talking about movie companies, right?
Yes.
So they've been taking a hit. President Trump announced that 100% tariff on films produced overseas. In particular, Netflix, which produces shows for global audiences in dozens of markets, they've been down this morning as much as 5%. So it happened in a post on Truth Social. He was talking to asked the Commerce Department to begin the process. And here's something interesting. He said foreign productions are a national security threat, saying that other countries were using films as messaging and propaganda. So that kind of stood out. But then you have Disney and Warner Brothers also off, as well, as much as 3%. So it's not clear, right? What does this really mean? It's not clear if the president plans to tax movies that are shot overseas, finished in the U.S., if he wants to tax TV shows that are made overseas for international audiences, but is available in the U.S., which is a huge market for Netflix. That's what they do.
I spent a few hours and years and decades in the entertainment business. I have no idea.
It's confusing. It's really
confusing. Why you would even look to this part of the economy, I have no idea. But it makes for good headlines.
But it is true that Hollywood has been shrinking, right? I mean, there are just less jobs out there, et cetera. But whether or not that's for AI or whether that's...
The golden age of television arguably is now. I mean, there's more content being created now for all the streaming services.
The streaming, yeah.
Everybody's got a job that wants a job. All right, let's head out now.
Now we
to
go
Los Angeles, to the Milken Conference. Secretary of the Treasury, Mr. Scott Bessent.
Well, I work for President Donald J. Trump, so I feel right at home. Mike Milken, like President Trump, is a visionary. In the 1970s, he had the rare combination of guts and intellect to defy the Wall Street consensus. With his heterodox approach to junk bonds, he pioneered a new asset class known today as high-yield bonds. By staying true to his vision, Mike overturned decades of economic orthodoxy. He bootstrapped entirely new industries by redirecting billions of dollars in capital to non-investment grade companies. His colleagues on Wall Street told him he was delusional and a fool, but ultimately history proved him right. Sound familiar? Like Mike Milken, President Trump has no shortage of critics in establishment circles, but he proved them wrong in his first term, and he is proving them wrong again today. On President Trump's first day in office, he vowed to usher in a new golden age for our country. A golden age America deserves a golden age economy. So for the past 100 days, we've been preparing the soil. We have uprooted government waste and harmful regulations. We have planted the seeds of private investment, and we have fertilized the ground with fresh tax legislation. Next, we harvest, and we want you to harvest with us. America is the Schelling point of global finance. We have the world's reserve currency and the deepest and most liquid capital markets and the strongest property rights. For these reasons, the United States is the premier destination for international capital, and the administration's goal is to make it even more appealing for investors like you. This morning, I will explain how we plan to achieve that goal. The primary components of the Trump economic agenda, trade, tax cuts, and deregulation, are not standalone policies. They are interlocking parts of an engine designed to drive long-term investment in the American economy. Our goal with trade policy is to level the playing field for our great American workers and companies. With a level playing field, American industry can outcompete all challengers. Tariffs are engineered to encourage companies like yours to invest directly in the United States. Hire your workers here, build your factories here, make your products here. You'll be glad you did, not only because we have the most productive workforce in the world, but because we will soon have the most favorable tax and regulatory environment as well. This is where tax incentives and deregulation come into play. You may have heard one big, beautiful bill floating around Congress. This bill is big and beautiful for Main Street America and investors alike. The president's signature tax legislation will prevent an enormous tax hike on Main Street by making the small business deduction permanent. It will also provide tax credits and deductions for research and innovation to stimulate investment in high-tech operations. It will restore 100% expensing for equipment while expanding that incentive to new factory construction. The objective, to accelerate investment in American industry. To make that investment as seamless and rewarding as possible, President Trump has embraced an ambitious deregulation agenda. This includes expansive permitting reform. The president doesn't want to just drill, baby, drill. He wants to build, baby, build. To that end, he has signed executive orders to reduce the federal approval process for new energy and construction projects from several years to just a few months. This simple reform will unleash the creative potential of America's builders. It will empower business leaders like you to put your capital to work as quickly and efficiently as possible. The building renaissance will be fueled by the president's energy dominance agenda. Energy is the base layer of all economic activity. That's why the administration champions an all-of-the-above approach to energy development to drive down the cost of doing business. I hope you can see the bigger picture now. The Trump economic agenda is more than the sum of its parts. Trade, tax cuts, and deregulation may be three distinct policies, but each policy is mutually reinforcing, and acting in concert, they push toward the same goal, to solidify our position as the home of global capital. The result of the president's economic plan will be more jobs, more homes, more growth, more factories, more critical manufacturing plants, more semiconductors, more energy, more opportunity, more defense, more economic security, more innovation. In short, more of all things we need the most. The president believes we can achieve more together. This is the abundant vision he has for the future. He wants everyone to be a part of it. Thousands of businesses are now catching the president's vision. Since he assumed office in January, companies have pledged to invest trillions into the U.S. economy. President Trump has secured more investment for our country in 100 days than President Biden did during all 4 years. Entrepreneurs, too, are starting to understand what the president is trying to accomplish. March saw one of the highest levels ever recorded for new business applications. Many of these men and women, like many of you, are grasping that America First is a blueprint for a more abundant world. For now, a parting thought. When I entered public service, I spent more than 40 years in the asset management business. There, one mantra guides one of the world's most successful investors: never bet against America. Warren Buffett coined the phrase, and it's been his lodestar as long as he's been in the game. Never bet against America captures a time-tested truth. The American economy is unstoppable. Throw whatever you will at capital markets, the Great Depression, 2 world wars, 9/11, a COVID recession of the last few years, or sky-high inflation. Each time the American economy gets knocked down, it gets back up again. And it gets back up even stronger than it was before. U.S. markets are anti-fragile. Indeed, the entire history can be distilled into just 5 words: up and to the right. On a long-term horizon, It's never a bad time to invest in America, but especially now. The United States is entering a new golden age of economic prosperity for both Main Street and Wall Street, and we don't want anyone to get left behind. Come with us so we can build a more abundant America together. Thank you all.
Please welcome. That was Secretary of Treasury Scott Bessent speaking at the Milken Conference in Los Angeles, talking about the economic vision of the presidency of Donald Trump. And Mr. Bessent sitting down with Michael Milken right now for a little fireside chat, little Q&A on the stage of the Milken Conference. Let's listen in.
A leading university, an accomplished fund manager, former professor, and distinguished career in finance and academia. Your range of life options was unlimited. What inspired you to choose the field of public service, joining President Trump's administration in a very high-profile and, I should say, high-pressure role?
I would agree on all the above. So, Mike, there was a long arc desire for public service. I had tried or considered going to the Naval Academy. I was applying in 1979. I wanted to serve my country. Due to sexual orientation, I was unable to. So even since I was a teenager, I wanted to serve my country. And I'd had a great career, like many people in this room, in finance. The country had been good to me. And as a economic history scholar, I was shocked at what was happening with these budget deficits. So last year, 6.7% of GDP, highest ever when we weren't at war, weren't in a recession. And I wanted to come out from behind my desk and be part of the solution, because I was afraid that 4 more years of that, and it was kind of a deeply cynical plan, I thought, run up the debt and then have to raise taxes and really stymie the American engine of growth, innovation, and opportunity.
Well, once again, we're very happy you took up that mission, and I can't think of a better person at this time to be the Secretary of the Treasury. Let me try. Over the years, we've had a number of Secretaries of Treasuries that were not really into financial markets. And so you're the right person at the right time. But it's interesting when I think about it, how do you strike the balance between the administration's goal of reindustrialization in the U.S. and the risk of isolating the U.S. economy?
Well, I think that they're not mutually exclusive. And as I've said many times, that obviously in this trade puzzle, China's the biggest piece. Where do we end up with China? And I said during IMF week in Washington, said, it's possible that we could, as Ray Dalio might say, do a big, beautiful rebalancing. That if we want more manufacturing, everyone agrees except Chinese leadership that they need more consumption. We could actually do that together. And then, look, on the other side, that getting better terms of trade is not always a straight line. It's not always a pleasant process, but I think at the end, the trading relationships will be stronger. Our security and values ties will still be there. I look back and I think about the example of NATO and German fiscal spending. So I lived in London for a long time, ran the Soros office there, and since forever actually, whether it was the French president, the Italian prime minister, people in Brussels were trying to break open the German piggy bank. And President Trump, not in a straight line, not in what anyone would call a diplomatic manner, has gotten NATO countries to step up and meet their spending requirements. I think, these numbers are approximate, but I think only 25% when he came in 2017, only 25% of NATO countries were meeting their spending requirements. Now I think only 25% aren't. So the Germans, for the first time, are going to allegedly do a big fiscal spend, which will drive European growth. And so can we do the same thing on trade? I think so.
So let's talk maybe about a specific situation. You recently signed an historic economic partnership with Ukraine. And as you said, there was a few bumps along the way. Can you walk us through the role that the Treasury played and what is expected to come out of this agreement?
Let's walk backwards. That I was bemused, gratified to see that on Saturday, as I was coming out here, Friday, as I was coming out here, Washington Post lead headline was Russia now nervous after U.S.-Ukraine signed deal. And that I believe that this would happen in February. President Trump believed that it would happen in February. And this was President Trump's idea. He likes negotiating, as you know. A lot of people in this room probably know. And he likes creating negotiating leverage for himself. And the Ukraine investment partnership, the economic partnership, was his idea. And he believed that it would do several things. One, it would create more leverage for him with the Russian leadership when it was time to go to them. So the idea was start with Ukraine, sign a deal that shows that there is no daylight between the U.S. and the Ukrainian people. It would be a symbol to Ukrainian people that the U.S. is still there. It would be a symbol to a tired American public, skeptical of more financial commitments, that it was possible to have a shared prosperity with Ukraine. And then it would, in essence, be a tacit security guarantee because of the economic partnership. I went to, and just to give you the timeline, so he tasked me with drawing up the document, speaking with Ukrainians. I thought it was a good idea to actually go to Kyiv. For anyone who hasn't been, you fly to Poland, you take a 10-hour night train into Kyiv, and you do that to keep from getting shot down, and which is good. And everyone was saying, "Oh, like this isn't a good deal. This isn't a good deal." And I said, "Well, if it's not a good deal, why did the Russians bomb Kyiv for the first time?" So I went on February 10th. The Russians bombed Kyiv at 4 in the morning for an hour for the first time since November, because they knew the train arrived at 8. And so before I got there, so if the Russians, if we were pro-Russian and this was a terrible deal for the Ukrainians, why didn't the Russians want it signed? So then President Zelensky elected not to sign it that day. He elected not to sign it at the Munich Security Conference a few days later. There was a little incident at the White House some of you may have seen. President Trump called it great TV. And when the deal went south that day, and I actually think in terms of the final deal, and Mike, I'm sure you, everyone in this room has seen it, that sometimes the blow up, you end up with a better deal. So February 28th was the blow up in the Oval, and what was going to be signed that day was actually just a 4-page memorandum of understanding. After that blow up, we at Treasury made the decision to try to make the blow up into an opportunity, and my team, I instructed my team to go straight to writing the full agreement, which is 6 different agreements, varying lengths, but hundreds of pages. So we worked on that document, and then when there was the kind of recovery and trust between President Trump, President Zelensky, after the meeting at the Vatican, we signed the deal a few days later. And look, I think it's win-win. What it is not is one of these rapacious Chinese deals. sign here, it's loan to own. You're going to default on the debt. We're going to own all your minerals, and that's life. This is economic partnership. They put in assets. We put in capital from the DFC, American Best Practices and know-how, and it's 50-50. It's equity, not debt. And some of our European partners were criticizing me at the G7, and I said, you know, guys, if you want to do a debt for equity swap, why don't you write off your Ukraine debt and we'll let you into our partnership? No one's called me yet.
Well, you know, I think what struck me, Mr. Secretary, was this major oil find off Guyana. And Venezuela rattling the sabers and had sent a couple military ships. The U.S. then asked them what you're doing because that's Exxon, that's a U.S. company. And I think that, to me, underlined part of the strength of this agreement you struck. Let's talk about one element that many people have been concerned about, and that is, what are the key components of deregulation? I know it's part of your economic strategy to spur growth. Are there any specific regulations that are at the top of your list for reform?
Yes, as I said at one of the smaller group meetings last night, maybe a few people in the room interested in private credit. And Treasury is taking the lead on financial deregulation. And I think private credit is an incredible new bolt-on to the world's deepest, the breadth and depth of the world's deepest capital markets. But the growth of private credit tells me that the regulated banking system has been too tightly constrained. So we have set up at Treasury, I convened something called FSOC, Financial Stability Oversight Council, and President Trump tasked me with helping him choose the leaders for the financial regulators. So they have installed a new vice chair for supervision at the Fed, Mickey Bowen. We are going to have a new OCC head, FDIC. Paul Atkins has just taken over the SEC. Brian Quinn is at CFTC. So the regulators are aligned, and we're going to be like safe, sound, and smart in redoing regulated financial entities. And then, as I mentioned in my talk, energy, that's a pretty easy playbook, but the real impetus is going to be on permitting across all industries, and that's where the EPA comes in, putting pressure on state and the federal government's going to put pressure on state and local governments to speed up the process, the permitting process. So, what's the use in giving 1 year depreciation if it's 36 months to break ground? One CEO recently told me, he was talking about the difference between doing business in Texas and Illinois. He said, we started a project in Texas from the day we went to the city of Houston to talk about it to the day I cut the ribbon, took 2.5 years. In Chicago, we are still 7 years into the planning process. So we want to make everyone look more like Texas.
Well, you're in an area here called Malibu where maybe in 15 years you can build a house. So we are very accustomed to this. Let me talk about another issue. It was in 2017 that our theme of the global conference was building meaningful lives. Part of that was a reflection on the disruptions we saw emerging from advances in AI, robotics, digital assets. The world we felt was heading for significant change, and we scheduled dozens of sessions around that area. 8 years later, you're now the Treasury Secretary, navigating the nation through these various changes. Give us a broad view as to how you see these issues today.
Well, I said in my confirmation hearing that we have to win in AI and quantum, that if the United States doesn't take the lead, if we don't win, everything else doesn't matter. That if we lose the edge there, and I think China's catching up, which is natural, but I think we will maintain our leadership on that. And again, what we're trying to do is not pick winners and losers. We're just trying to set the environment for the best opportunity for our entrepreneurs to succeed, stop intellectual property theft, and in terms of making it accessible to all Americans, I think that's going to be very important. I was out on the campaign trail with President Trump, and I was struck by there had been a big migration by the venture capital community to President Trump. So on one side, you've got the VCs, the most innovative, the people in the world. You got Elon Musk, the richest person in the world. And the president's penultimate rally that I went to was in Pittsburgh, and these steel workers showed up, and they got their vest on, they've got their hard hats, they've got their families. And the real idea is to make sure that innovators can innovate and steel workers can have the same quality of life and opportunity, and that their kids could be the Silicon Valley entrepreneurs, or they can stay and have the same life or better that their folks had in Pittsburgh.
Well, that is a great goal, and we hope we achieve it from that standpoint. Interest rates. You've often talked how important that 10-year interest rate level is, and when I look at financial markets over a long period of times, I can sometimes identify when that individual had come into financial markets by what period of time and the interest rates. So in the 1970s, particularly, the volatility of financial markets, you saw over the next decade, many of the people that were CFOs became CEOs because how you financed your company allowed it to exist. In the last few years, we've lost 3 as independent companies, major financial institutions, due to the fact that they had bought $250 billion of U.S. government intermediate securities and borrowed overnight. So when you look at interest rates and the 10-year, and as I mentioned to you, I got this app on my phone that anytime the U.S. government's prices change by more than 2% in 2 hours, off my phone goes. So in the 1950s...
Please don't share that with the president. Please don't.
So in the 1950s, if you were trading governments, it was like watching paint dry. You could see an entire variation of maybe 2% in price in an entire decade. We now have seen a variation of more than 2% occur in more than one day. How do you see the importance of the level of interest rates in our economy and what you want to achieve?
I think that I'm not going to talk about the Fed. I've said I won't talk about their future mistakes. I'll only talk about their past mistakes. So I thought it was important to focus on the 10-year, and the 10-year has a lot of things wrapped in it. It's the short-term rates, it's the term premium, and we're focused on creating the best environment for stable rates. And I think a lot of what we saw in April was this periodic unwinding that I've experienced, you've experienced, most people in this room have experienced in their career. I'm a big believer in the Hyman-Minsky, stability leads to instability. So I think we probably had a very stable period. A lot of leverage players built up very large positions. There was an uncertainty shock. They're out. But what we're trying to do is to go back to the Trump 1.0 non-inflationary growth. So I think if we can put non-inflationary growth in place and take away, back to your initial question, why am I sitting here, is to take away the credit risk of the U.S. government, then I think rates will naturally come down. And as I've said before, there's an opportunity here that if we can do it, the goal on one side, I call it reprivatizing the government or reprivatizing the U.S. economy. On one side, we want to bring down government borrowing slowly, maybe decrease the deficit by 1% a year. So by the time President Trump leaves office, we're back at the long-term average of about 3.5% deficit to GDP, and the denominator grows faster than the numerator. Debt to GDP goes down. So we're decreasing the government in the economy. At the same time, we are right-sizing government spending and government employment. And then on the other side, through financial deregulation, we're re-leveraging the private sector. And then the excess employment that was shed in the government economy can go to the private sector. One thing, I've never lived in D.C. before, but one thing that really struck me was within a 10-mile radius of D.C., 25% of the nation's economy pulses through there. And that's too much. Traditionally, it's about 21%. And we've got to make sure, we have a stewardship obligation to make sure that that is spent wisely.
So we were making a decision where to have the Milken Institute School of Public Health. Besides the fact the executive office building is 1 block away from GW, but every major decision on medical was located within a mile or so. And so the decision ultimately with the talent we had there with Lynn Goldman and others was we would go to GW because the decisions were being made there. Now, as you know, we spent 12 years building this building across the street from your new home at the Treasury and the Center for the American Dream, and we thought it was a 4-year project. It turned out to be a 12-year project. But this passion for the ideal of American Dream, I believe, is something you truly believe in. We've been asking 10,000 individuals in more than 100 countries around the world that live there or have come here, how they interpret that phrase. What does that mean? What does the American dream that you're going to protect for so many of us, what does it mean to you?
It means a shared vision. We're going to approach the 250th anniversary next year, or we will have the 250th anniversary next year. And it's what does the next 250 look like? And to me, it's the equal opportunity for great outcomes. It's like I said, it's equal opportunity. If you're one of the children of the construction workers in the Duquesne Arena on November 4th, that you might be sitting here because you founded a financial services company, or because you're a medical researcher, or it's the opportunity for people in this room to continue to prosper. But to me, it's two things. It is the fact that the system works and that there is mobility, that we get rid of these discouraging surveys of families and children who don't think they're going to do as well as their parents. So we need a belief in the system, and we need to continue making sure that the system works. So to me, that's the American dream.
Well, you've wrapped that up in a bow for us here, and that what we have found in every survey for 12 years is the #1 essential ingredient condition that exists for the American dream was freedom to live your life, whether you want to be a steel worker or whether you wanted to work in finance or wherever you wanted to pursue, or whether you wanted to be the soccer coach of your daughter's soccer team. So, Mr. Secretary, we couldn't be happier that you took up the mantle of public service, and we look forward to your stewardship for the next few years. Thank you very much.
Thank you.
You've been listening to Treasury Secretary Scott Bessent at the Milken Institute, being interviewed by Mr. Milken himself. Just to update you on a couple of these headlines here, Scott Bessent saying that he is not going to talk about the Fed, but it's important to focus on the 10-year, has a lot of components, and he's trying to create the best environment for stable rates, and saying that really want to get back to that Trump 1.0 non-inflationary growth. All right, let's get an update on markets and stocks that we're watching here. And for that, we go to John Tucker. John?
And right now, the major indexes, they are lower, Alex. S&P 500 down, and I think its longest advance in about 20 years. Trade uncertainty still weighing on sentiment. So the S&P 500 still down about 7.8% from its peak. Robert Teeter at Silvercrest Asset Management says, you know what, investors looking for clarity, they're going to need patience.
For now, we're in day-to-day mode of, is the situation getting a little better or a little worse? But as we get through the end of the quarter, we think we'll have some announcements and the groundwork will be set a little better.
Well, the S&P 500, 28 points lower, down 0.5%, 56.58 on the index. The Dow Jones Industrial Average, 14 points lower, and the Nasdaq 100 down 110 points. That's a decline of about 0.5%. Oil slipping as OPEC agreed to bumper output increases. Worst performing industry group in the S&P 500 right now, energy. As a result, NYMEX crude falling below $60 a barrel. As shares of Berkshire Hathaway, the Class B shares, they were down 4.3%. Investors asking if the Warren Buffett premium will vanish as Buffett steps down. Finally, this was from the Journal this morning. Brides are buckling under the uncertainty of tariffs. These are threatening to push costs to new heights as wedding season kicks off. They're panic buying candles, speed ordering wedding dresses, and downgrading from roses to carnations, cutting back on party favors, ditching also the professional videographer for a guy with a smartphone, according to the Journal.
Wow. I like when he looks at me when he says this. Like, I didn't do that for my wedding.
Yeah, I guess it's sexist. I think it's a girl kind of thing.
Not for me, but okay.
All
we,
right.
we just did a cocktail party. I was low rent.
That was it?
It's very nice. Well, at the Carlisle, though.
We
so
ran out of liquor
fee, though.
at my
booze
and actually
That's,
somebody who owned the bar who was at the wedding went out and raided the bar and brought back cases and cases. We went
is
through that
amazing.
too.
Is that poor planning or just an awesome party?
No, it's just a bunch of drunks at the wedding, basically. So anyway,
sorry to miss that.
With apologies to everybody who did attend, but anyway, we check the markets and everything else right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg business. Mike wasn't there, so
exactly.
We didn't have to go out for a third time.
All right, John Tucker, thank you so much. Alex Steele, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube. Michael McKee joins us here. Mike, what do you think about some of the economic data? We got the ISM services came out, better than expected, but boy, the prices paid number kind of jumped out at you. How do you take that all in?
Well, I think you're seeing the beginning. I'd rather hear more about John Tucker.
Tucker's party, back in the day.
I think what you're seeing is the beginnings of the impacts of the tariffs. This is soft data, essentially, but it has sort of a hard component to it in that the ISM is asking what's happening in your business this month. And if you go under the hood, you see that imports have dropped a lot and prices paid went up a lot. And those two things are probably going to be connected. Also, inventories went up because people front-loaded ordering. The interesting thing about it, though, was that new orders were still rising. Yeah. So it may be that the businesses are retrenching, but the customers have not yet. Or it may be that the customers are looking to those who import to keep them going, which they may or may not be able to do.
Yeah, 11 industries reported growth last month, led by accommodation and food services. Only 6 industries contracted. When do you think we're going to get a clean read on all these numbers?
Well, it's going to probably be over a period of time, depending on the number and how businesses react to a specific data point. I would imagine that you're not going to get a full picture of it until either July or August, when we know what the tariffs are. Remember, the reciprocal tariffs are postponed until July, so that could hang out there for a long time. when we know what the tariffs are, that will help. And when we see how people react to it, both other countries, whether they're reciprocal tariffs or whether they come to some kind of a deal. So at this point, it's really hard to say when you'll know, but I suspect it's going to be one of those things that slowly becomes obvious.
How about to the Federal Reserve? Are they going to be slow to kind of recognize what may be happening out there in terms of inflation and growth?
Unless we get some sort of rapid movement in either one of those things, which nobody's really predicting at the moment, they're going to be slow because there's no benefit to them to moving quickly. If the economy is slowing down, then the question becomes how slow? And with inflation still above target, et cetera, then the Fed doesn't want to get into a situation where it's boosting inflation by cutting rates too quickly. So they'll just wait and see, and the economy's in pretty good shape right now, it appears, with the numbers still doing okay and inflation still slowly coming down, so no problem for them.
That's one of the arguments, too, for the OPEC Plus production increase, right? It's like, hey, listen, the hard data is actually okay. Like maybe there are lots of reasons why they decided to do it, but maybe the market can actually absorb it because we haven't seen demand necessarily fall off a cliff.
Well, it sets up an interesting question about how consumers will react if gasoline prices start going down, and then how the Fed reacts to that if headline inflation goes down because gasoline prices and energy prices go down. And I suspect they will try to look through that as much as possible because they know that could easily change.
Totally.
And because the real issue is going to be, is the economy slowing down? If the economy is slowing down, that's going to put a drag on inflation. It's also going to mean that that money that you would have spent somewhere else because you're not spending it on gas, you may not be spending it anyway because you're trying to cut back and save money.
We were paying attention here to a lot of the speakers out at the Milken conference today, and a lot of the, whether it's Bill Ackman, Paul Taubman, Mr. Rowan from Apollo, all saying, there's uncertainty out there, and there's some issues out there as it relates to their businesses. Yet, Secretary Bessent calls the U.S., quote, the premier destination for global capital. So I guess that's the argument of near-term pain, maybe long-term gain from the administration.
Well, it is still.
Sure.
We have the largest, deepest capital
Yep.
markets, especially on the Treasury side, on the bond side. So there are not a lot of alternatives if you want to move a lot of money around. But most of what Scott Bessent was saying today was a sales pitch to, highlight the administration's economic agenda. The one bit of news I thought, to the extent it's news, was his description of how he would see the 10-year yield dropping because he's made a big deal out of that being sort of the benchmark rate for business activity. And his argument was you lower the budget deficit because then takes some of the credit risk out of the bond market and rates can drop if you take out the risk premiums.
And he was talking about 1 percentage point per year ideally would be, as the deficit to, or the debt to GDP would be meaningful.
No, but obviously one, if you follow the budget process, has to laugh because the budget that they are working on this year, through reconciliation, raises the budget deficit. And that's even beyond just the machinations they're doing to avoid the reconciliation rules. They want to spend more money. And every day Donald Trump is talking about spending more money. Let's rebuild Alcatraz, kind of thing. So we're not going to get that 1% per year deficit decline, I don't think. And so it kind of makes his argument not relevant at this point.
And you are headed off to D.C. tonight or tomorrow? When are you going? Tomorrow. The Fed meeting. Any firework?
None.
Just one. I was like firework. I didn't say works. I said firework.
There's not even one firework. I don't think. We will get no move on rates. The Fed will be very circumspect about what it says in its statement because they can't they can tell us what's been happening, which is okay, but they have to emphasize we don't know what's going to happen going forward. And then there's no new economic forecast. There's no new dot plot. There is only Jay Powell. And I suspect we get a lot of questions that are answered by, I don't know.
Fair enough. That's a lot of the questions that we also ask and answer too. All right, Mike, thanks a lot. Mike McKee, Bloomberg International Economics and Policy Correspondent, and lots more coming up from Milken over the next 48 hours. So stay tuned with Bloomberg for that. You can also follow all the panels on T Live if you're following on your Bloomberg terminal. All right, coming up, going to Tyson here. That stock down about 7%. The why behind that: beef versus chicken. This is Bloomberg Intelligence.
listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, Paul Sweeney, Alex Steele. We're live here in our Bloomberg Interactive Broker Studio. We are streaming live on YouTube as well. It is earnings season, folks, and we got the Tyson's Foods reporting earnings. I don't know, maybe it's just me. I always just, when I think of Tyson's Food, I just think chicken, but they're also in the beef business as well. That's the extent of my knowledge. Stocks trading off today on some earnings. Jen Bartashis joins us. She's a senior retail staples and packaged foods analyst for Bloomberg Intelligence. Jen, the street doesn't like what they heard from Tyson Foods, Springdale, Arkansas. What happened there?
Well, it's really two things, Paul. The first thing is that the beef business did worse than people expected. But secondly, the company held their guidance for the fiscal year, which is generally a good thing, except that they're ahead of pace for the top of their guidance for adjusted operating income for both the chicken and the pork segment. So there were a lot of questions on why, given the strong first half performance they've had, that they didn't actually raise their guidance overall. And so between those two things, that's what's putting pressure on the stock today.
Do we get the sense that that's a demand concern, or is it an input concern?
Well, on the beef side, it's an input concern. And actually, there's a piece to that puzzle that Tyson touched on, but they didn't really go into detail. And that's that they talk about how consumers have really still had a lot of demand for beef, which is true, except that when you look at the consumer, they're trading down into like ground beef. Now, when you have a shortage of cows, the problem that Tyson has is that they have to put higher quality parts of the animal into grind in order to sell it, which means that their profit per animal is coming down. And that's a concern over the long term if those changes in behavior patterns don't alter in the near future.
All right. During our little egg shortage, my scientific analysis was basically just make more chickens. Tyson's are the chicken people, I think. What are they saying about the chicken population these days and eggs and all that kind of stuff? Because they're the folks that know.
Yeah, so the chicken supply is actually pretty healthy. From a standpoint of the chickens that are used for consumption, they really weren't impacted all that much by avian influenza, and so that was the good news. The bad news is that the mortality rates on the type of chicken that they're currently using is still pretty high. So that means that they're not getting as many chickens into the processing plants that they normally would given the number of eggs that are being laid. And so that is an inherent top or cap to supply. So supply is robust. It's going to grow about 1% this year, but there are some constraints there with how much more they could actually grow supply overall.
What's the tariff impact, if any, on Tyson, on both sides, the demand and supply?
For Tyson, actually, they have very limited exposure for tariffs. They said on their call today about 95% of their revenue comes from product that's sold in the United States. Their export is relatively small, and they've had some time to work on contingency plans. So finding different end markets that they can send some of the parts of animals that U.S. consumers just don't eat. So right now, it doesn't appear to be a very large risk for Tyson at all.
You mentioned maybe some issue with the cow herd. I mean, I watched Yosemite. I know all about the ranching business.
I see how this goes.
See it? Yeah. So, I mean, can't we make more cows? What's going on there?
Well, we can make more cows. The problem is that for ranchers, it's a tough environment to decide to actually build up herds. Interest rates are still relatively high. There's still high cost to expand operations. We've had drought that's only just reversing in a lot of the key areas where we raise cattle. And so that decision has been coming. But the problem is that once you even start, it takes 18 months to get a cattle from birth to market. So even if they start today, we're not going to see an influx of supply for quite some time.
I feel like just a few years ago, it was all about alternative protein. I remember particularly with Cargill, for example, they're making a really big push into that. Has that trend for these guys shifted now?
It has. When we look at the consumer consumption data, the luster around plant-based has really fallen off. And so, right now, there's a core demographic that will always be interested in that product. But at the moment, it's not growing. The sales are continuing to contract. Part of that is that the cost of regular meat has come down, and we had food inflation, which pushed the cost of special ingredients for alternative meat way up. So the price gap between alternative proteins and conventional proteins got a lot wider in the last couple of years, and it still hasn't completely collapsed again. And so until that gets a little bit closer, it's going to be harder to get consumers to get interested again in alternative proteins.
So what is it, the Tysons of the world, what are they saying about their consumer these days?
So, they're talking about the demand for protein. And this is something where at the Bloomberg Intelligence Farm Food Fuel Conference, we had a whole suite of panelists on protein. And the demand for protein is really strong, whether you're talking about animal protein, whether you're talking about dairy. Current diet trends are high protein based. And so that really bodes well for producers like Tyson. As the consumer is willing to still spend on protein, and it's in the majority of their purchases when they're going to the grocery store.
So true. I'm a big protein person.
Well, who isn't? Who doesn't?
I know, but like to actively search for protein, that feels different, doesn't it? Maybe
just eat chicken, eat it.
All right, fair enough. I guess
Burgers
it's
on
that
the grill
simple.
last night. Killed it.
Oh, yeah,
Yep.
burgers. But then you got cholesterol issues. Okay, anyway, Jen, thanks a lot. Jennifer Bartashis, she joins us from Bloomberg Intelligence, senior analyst, retail staples and packaged food. Calm day.
Yeah.
I really wonder what the next catalyst is going to be if it's not going to be the Fed.
Yep.
Do we just wait for NVIDIA and hang tight for 2 weeks? Like, is that what we're doing
could be
here?
it. We got some earnings this week. It's not as big as last week, though.
No, many out there saying that potentially we're going to see some volatility-controlled funds come in, some mechanical buying this week. So waiting for that real trend, but nonetheless, breaking that 9-day winning streak for the S&P, with the S&P a little bit softer today. That wraps it up for me and Paul and Milken day one. Coming up, Balance of Power with David Gura is up next after the Global News Update.
This is CBS News on the Hour, sponsored by Progressive Insurance.
I'm Steve Kathan. A new financial offer from the government for people in this country illegally. A $1,000 payment for those who self-deport. CBS's Nancy Cordes at the White House.
The White House is hoping that many of these individuals will just leave on their own, and that hopefully some cash in their pockets might be an enticement for them to do that.
President Trump is moving to reopen and expand Alcatraz, the notorious California prison that was closed more than 60 years ago. Just before it shut down, it was found costs to run it were 3 times what they were at the average U.S. prison. CBS Bay Area reporter Veronica Macias.
We know how difficult it was to operate this prison back in the day. I was reading on the FBI website, even water had to be brought in by boat to this prison because nothing really is available there.
Also in California, the San Diego Sheriff's Department's confirmed multiple people are dead after a small boat overturned at Torrey Pines State Beach this morning. It's expected the New York sex trafficking trial of Sean Diddy Combs will last 2 months or more. CBS's Katrina Kaufman says jury selection's now taking place.
When I was on the security line this morning, there was someone who was showing up for jury duty, and he was saying to me, I know the Diddy trial is happening today. I really don't want to be on it.
Dozens of flight cancellations and more than 100 delays at Newark Airport this morning. The FAA blames the weather and staffing issues. There have been problems with staffing since last week. Top Senate Democrat Chuck Schumer wants answers.
I have asked the Office of Inspector General to thoroughly investigate what's going on at Newark and in the East Coast, so these problems don't get worse.
Now to the Middle East, where Israel has a plan to capture all of Gaza and stay for an unspecified amount of time. CBS's Courtney Keeley.
The Israeli Security Cabinet made this unanimous decision to expand operations into Gaza, not just going in with troops and then leaving, but going in and staying. And their plan is to ramp it up over months. It's not happening immediately.
It's an important week for the Roman Catholic Church. A conclave of cardinals begins Wednesday.
The Vatican says all 133 cardinals with voting rights, that is, all those under the age of 80, are now in Rome. On Wednesday, they will file into the Sistine Chapel and there, under Michelangelo's luminous frescoes, begin voting until one of them wins the 2/3 majority. That means he is the successor to Pope Francis. Vicky Barker, CBS News, London.
Wall Street, right now the Dow is up 92 points. This is CBS News. Today is the anniversary of the Grateful Dead coming alive.
The Grateful Dead played their first show 60 years ago today at Magoo's Pizza in Menlo Park, California. They had originally formed as the Warlocks, but changed their name when they realized Warlocks was taken. The story goes that guitarist Jerry Garcia found a new name by throwing a finger down at random in a dictionary. The psychedelic band cut their teeth during Ken Kesey's acid tests and went on to play for legions of fans the world over. Christopher Cruz, CBS News.
NBC sportscaster Mike Tirico says he's feeling fine. He left Saturday's Kentucky Derby unexpectedly and suddenly. It was a strong reaction to a nut allergy that affected his breathing and speaking. He was treated by EMTs at Churchill Downs. Steve Kathan, CBS News.
From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
Good afternoon. David Gura in for Joe Matthew and Katie Lyons with Balance of Power on Bloomberg Radio and on YouTube. And a busy Monday it is with the President of the United States setting the table with a lot of news during a long interview with Kristen Welker of NBC News over the weekend on Meet the Press. The President talking about trade policy, pushing back on claims it's causing pain among Americans, once again invoking dolls, suggesting that strollers are the only item costing more to Americans across this country, weighing in on the Federal Reserve as well as we get ready for a meeting of the central bank this week here in Washington, D.C., and giving us an update on trade negotiations as well. Scott Bessent, his Treasury Secretary, speaking right now at the Milken Global Conference in Beverly Hills, California, echoing a lot of what the President had to say, indicating that we could see progress here in the coming weeks. Very close to some deals on trade, and the Treasury Secretary saying it may be as early as this week that we get some resolution to those trade deal negotiations. A lot to cover here in this hour, but first, let's get a check of the markets with Amy Morris here in Washington, D.C. with the Bloomberg Business Flash. Amy?
Thank you, David. Now, looking at the markets, Chris Harvey at Wells Fargo is hopeful that investors are getting more clarity now from the Trump administration.
I think we're past peak uncertainty. And what we do is we look at it this way. He went very hard very early. In order to get that pressure back, I think you'd have to put us into recession. I don't think this administration wants to go into recession because what it would mean.
Now, some of President Trump's latest tariff remarks did send some stocks lower. We check markets for you all day long here at Bloomberg. The S&P 500 down 0.2%, NASDAQ down 0.4%, but the Dow, that's up about 0.3%. The 10-year Treasury yield at 4.34%, the 2-year yield at 3.84%. Skechers is going private in a deal with 3G Capital. 3G will pay $63 per share. Shareholders do have an option to get $57 per share in cash and one LLC unit in a newly formed private company that will become Skechers' parent company. The transaction is expected to close in the third quarter of this year. Shares of Skechers now 25% higher. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Let's go back to Balance of Power with David Gura.
Amy, thank you very much. As I mentioned, the President of the United States flying back from West Palm Beach to Washington last night and taking questions from reporters in the back of that plane, talking about a host of subjects, including the economy and trade in specific, giving an update on the conversations he says are taking place between the United States and dozens of other countries. Let's take a listen to what he had to say.
At some point in the next 2 weeks or 3 weeks, I'm going to be setting the deal. We're negotiating with many countries, but at the end of this, I'll set my own deals. We're meeting with almost all of them, including China. And at the end, I'm setting the deal. You keep asking the same question. When will you agree? It's up to me. It's not up to them.
It is up to him. President Trump there on Air Force One. Laura Davison joins us now, Deputy Bureau Chief here in Washington, D.C. Laura, give us a sense of where you think things stand at this point from our reporting on this. Again, it's been, we saw the prospect of Howard Lutnick earlier on saying 90 deals in 90 days. We're not at 90 yet. Many days have elapsed and none has been announced as of yet. Where do things stand?
So where we are is there have been no concrete signs that any of these deals are progressing. They've indicated that India, South Korea, Japan maybe might be at the top of that list. And for, even last week, Kevin Hassett said maybe by the end of the week, there will be a deal. Now this week, they're saying again, perhaps a deal, but not committing to it. I'll recall 2 weeks ago, Trump said they'll have everything done in 3 to 4 weeks. We're now 2 weeks into that time period. Nothing. The other important thing to remember is that anything that comes out is likely to be sort of a symbolic nod to an agreement versus something that's fully hashed out of some sort of, memorandum of understanding or something that says, okay, we're going to keep talking, but here's at least some sort of top line agreement going forward. It's clear that the White House is very, very keen to show markets some signs that they're making progress. They just don't have anything on paper yet.
When you look at all of the countries who purportedly are talking with the White House, are they hoping that one of these comes together first before the others? Are they hoping that they become sort of signals or signs to other countries who haven't brokered deals yet? Is there any sort of hierarchy, I guess, to the way that they're approaching this?
There is some. I mean, they've clearly favored the countries who came first to the table and said, hey, look, we want to make a deal, getting those in the front of the queue. They're also looking at, which countries are the most important here. Of course, India, Vietnam, South Korea are all big trading partners. China remains the big exception there of, Trump is really eager to talk to China. The Chinese last week signaled that maybe talks could start, but this is going to be a very long, drawn-out process. They've been in this back and forth posture setting, really not even since April 2nd, since Liberation Day. This goes back even further to the fentanyl tariffs that came on in the early days of Trump's term.
You mentioned China. There was this very long, very newsy interview that Kristen Welker of NBC did on Meet the Press yesterday in which China came up. What did you hear from that about sort of the president's sense of where those conversations are going? You mentioned there was a bit of positive news as of last week as the White House sees it. Markets were grateful to see that as well. This, of course, is the one that they need to have happen, given how high tariffs are and how kind of much of a quagmire they're in here.
Trump's really of two minds in this. He acknowledged what Treasury Secretary Scott Bessent has been saying for days of the tariff levels as they are now are unsustainable. And that means that, trade has essentially shut down between those two countries. He said he'd be willing to take those tariff rates down at some point in the future. But you've also seen Trump really double down on this line that has gotten a lot of traction on, there may not, come Christmas time, may not be $30 on the shelf. There's only going to be $2. He repeated that again over the weekend. And this is really going to be the question of, how much pain is Trump willing to withstand if, retailers suddenly start not having all the things that consumers are used to. Xi has signaled that the Chinese are willing to withstand this a lot longer. Trump so far has signaled he's going to fold if he's really facing pain from markets or consumers.
I'm going to continue to draw from that interview that NBC News did. A lot of it had to do with the economy. And Kristen Welker asked the president about the Federal Reserve Chairman, Jerome Powell, what he's thinking about, sort of how safe he is in that position, would he consider removing him. Let's take a listen to what the president had to say in response to questions about Jay Powell and the Federal Reserve.
He should lower them, and at some point he will. He'd rather not, because he's not a fan of mine. He just doesn't like me because I think he's a total stiff. And, it's just one of those things. He should lower them. And I wish the people that are on that board would get him to lower, because we are at a perfect time. It's already late, but he should lower interest rates.
Laura, I'm curious sort of how you processed what you heard there. So no direct threat on Jerome Powell's position as the chairman of the Federal Reserve. The president sort of indicating that others on the Fed board might coalesce around him and push back on him. How does this advance the story about Fed independence, the sanctity and safeness of that here during this administration?
At least for now, it seems that Trump is going to let Powell serve out the rest of his term, which ends next May. You're hearing some of the more markets-focused people in his ears, Scott Bessent, Howard Lutnick, among those saying, hey, look, you're really going to disturb markets, freak out investors. Just keep Powell there. You get to pick a new guy here in 12 months anyways. They're going to start searching for the next Fed chair. Just let that play out. But he's still not willing to sort of give up, sort of his complaints and his criticisms of the Fed and of Powell specifically. Almost every day, multiple times a week, we're hearing him go on social media and say, that Powell is too weak, Powell is a stiff, Powell, he's going to make his displeasure known, even if he's not going to actually take any action there.
And it's funny, sort of, we talk about Fed independence maybe in the context of could the president or would the president remove the Fed chair, but this has an effect. The degree to which he talks about Fed policy, makes his opinions known. This is different than the way past presidents have approached that relationship between the president and the Fed chair. And I think a lot of people would say it might have an effect just sort of on the notion of independence of the Federal Reserve.
And we'll hear on Wednesday when Powell comes out and does his press conference he's been very critical of tariffs in the past and sort of suggesting that this is, could tip the economy into a recession. We'll see if does he pare back his language? Is he a little bit more moderated, or does he, kind of continue to make some of those more sharp comments? Fed chairs are notoriously the best at sort of figuring out how to signal different things with their language. And so that's what markets are going to be watching for here in 2 days.
I want to get your perspective as we start this week about what's happening on Capitol Hill, reconciliation. We've seen kind of many versions of what the timeline might be for getting a bill done here. Your sense of sort of where that stands and what the forcing mechanisms are going to be for this to move fast or slow going forward?
There are two key fault lines that they have not figured out. One is Medicaid. House Republicans, particularly some factions, want big cuts to Medicaid. The president has said absolutely no way. There was a big meeting last week that they walked out of that unresolved, but they have to come up with that because either they cut Medicaid, or they can do more tax cuts, or they don't cut Medicaid, fewer tax cuts. That means the president gets fewer of his no taxes on tips, no taxes on overtime, those campaign pledges. So the factions are still really far apart there. The other fault line, and this is more within Republicans in the House, is on SALT, the state and local tax deduction. You have a small but very vocal group of members from New York and California who want a big increase in that $10,000 deduction cap there. You have other members who this just isn't a political priority for them at all. They have to both run the numbers to make the math work, as well as come up with some political sell they can give to constituents.
A kind of theme over the weekend into this week has been, how is all of this playing among American consumers, among American business owners and executives, and around the world as well? And there's this question of, is American exceptionalism on the wane? Is it dead? Scott Bessent, the Treasury Secretary, is in Beverly Hills. He was speaking at the Milken Global Conference. He addressed some of this today. Let's take a listen to what he had to say.
America is the Schelling point of global finance. We have the world's reserve currency and the deepest and most liquid capital markets and the strongest property rights. For these reasons, the United States is the premier destination for international capital, and the administration's goal is to make it even more appealing for investors like you.
He addressing that group of investors in California, appearing in conversation with Michael Milken, who started this conference, of course. You mentioned Scott Bessent a moment ago. What's the role that he's playing now in the administration? Yes, as an advisor to President Trump, but also in communicating or projecting some sense of stability here to markets, both in the U.S. and around the world.
He is the key voice that folks on Wall Street are going to listen to see, kind of read the tea leaves here. There was an interesting just sort of shift in tone from Bessent, even from a month ago, when he made a comment that it was Main Street's moment. Wall Street has time, and now it's Main Street's time to shine. Today, he name-checked both Main Street and Wall Street and saying, look, that these priorities that the administration's priorities can have upside here for both. But he's, like the president, acknowledging that, he's softening the timeline here. Trump has been very clear, there's going to be a period of pain, but Bessent is saying, look, if you invest now, we can quickly, sort of rejigger and grow the American economy.
And wrapping up quickly here, just talking about trade and those talks, what role is he playing in those negotiations? This is a multifaceted economics team of advisors that the president has. What is Scott Bessent's role just on kind of the granular level of negotiating these trade deals?
He is specifically taking on Asia. Howard Lutnick is focusing on Europe, but of course, Treasury Secretary is also involved in the tax talks. He was involved in the Ukraine critical mineral thing, so he has a very, very busy plate.
Laura, great to speak with you. Thank you very much. That's Laura Davison, our Deputy Bureau Chief here in Washington, D.C., as we again draw from that conference that's taking place in Beverly Hills, California over these next few days. Bloomberg providing comprehensive coverage of all the panels that are taking place. There are interviews on the sidelines as well, and I should say Scott Bessent having a conversation there with Michael Milken, who founded that global conference many years ago. Again, talking a lot about trade, the trade deals that are being brokered, the White House's position in those deals, and trying to offer some assurance to the many investors who are gathered there at the Beverly Hilton in Beverly Hills, California. And coming up, we'll have interviews throughout the afternoon, including one with Jane Fraser, the CEO of Citigroup. She'll sit down with our Sonali Basak there, again, on the sidelines of the Milken Global Conference. Coming up here, a lot more on the president's weekend comments in interviews on Truth Social as well. The president floating ideas about Alcatraz, the shuttered prison off the coast of San Francisco. Also talking about new tariffs on movies made overseas, 100% tariffs on that. Dig into that soon here on Balance of Power on Bloomberg Radio and on YouTube. I'm David Guerrero.
It's 12:21 on Wall Street. I'm Amy Morris. The S&P 500 halted its longest advance in about 20 years after President Trump's latest tariff remarks, despite data showing a pickup in growth at U.S. service providers. That other report showing the U.S. economy entered the trade war on solid footing pushed stocks away from session lows. We do check markets for you all day long here at Bloomberg. The S&P 500 is down 0.25%. NASDAQ is down 0.4%. The Dow is up about 0.25%. The 10-year Treasury yield at 4.35% and the 2-year yield at 3.85%. The Institute for Supply Management reports its service industries index did rebound in April, led by orders. However, one measure of inflation tied to that report hit a more than 2-year high as the U.S. imposed those tariffs. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Let's go back now to Balance of Power with David Gura.
Amy, thank you very much. David Gura in for Joe Matthew and Kaylee Lyons on this Monday. And the President of the United States has movies on his mind, evidently. He spent the weekend with Jon Voight, the actor, and a few hours ago posted this on Truth Social. "We want movies made in America again." The President in that post suggesting that there be a 100% tariff on any and all movies coming into our country that are produced in foreign lands. He characterized this as a national security threat and said the movie industry in America is dying a very fast death. Lucas Shaw is an editor at Bloomberg News. He's the author of the Screen Time newsletter, a must-read, one you should definitely check out and subscribe to. And he joins us now from Los Angeles, where he keeps track on the movie industry in the U.S. And overseas. Lucas, let me start with a basic question here, and that is the pronouncement from the President that the movie industry in America is dying a very fast death. Is that something with which you and others would agree?
It's an exaggeration. There's been a lot of concern about the state of the movie business over the last several years, certainly exacerbated by the pandemic, a couple of big labor stoppages a couple of years ago. So the movie business isn't as strong as it once was. It is not as central to culture as it once was. It is not dying. We have 2 or 3 very popular movies in theaters right now. And perhaps more importantly, it is not dying relative to other countries. It's not as though you suddenly see movies from Europe or Asia or Latin America that are supplanting U.S. movies. The movie business is facing the same problem all over the world. U.S. movies continue to be the dominant type of movie. I think all 10 of the highest grossing movies of last year were released by U.S. studios.
When you read this post, I wonder sort of what questions it raised in your mind. I look at kind of that key line here, this proposition of 100% tariff on movies coming into our country that are produced in foreign lands. How much ambiguity is there about that language, what the President might be referring to here?
A lot. I think that, the first, frankly, my first response was like, what exactly is going on here? What, as with so many of the President's posts on social media, sort of what motivated it, which I think we answered, but also, why this is not I get wanting to address it for economic reasons. I would not describe this as a national security threat. But then it just raises a lot of questions, right? So the Hollywood studios produce a lot of their movies outside of the U.S. They'll film in the UK or Eastern Europe or wherever it may be. But there is still plenty of work on them done in the U.S., whether that is some post-production work, whether that's... There are many kind of steps in the process of making a movie. And it is true that more and more of them have left the country. But a lot is still done here. So how are you defining that, right? Are you trying to go after movies that other countries or companies from other countries are releasing, which would seem to be the implication, right? You're going after Japanese movies or Chinese movies or Indian movies. Those movies don't really make a lot of money here. Every once in a while, you'll have a breakout. Or are you trying to force U.S. companies like Disney, Warner Brothers, Universal to produce movies in the U.S. instead, which we've seen Trump attempt with some of his other policies to bring manufacturing back here, even if it's from American companies. And then there's like the added wrinkle of these global streaming services where, Netflix makes a lot of movies in English, some of which are made in the United States. But they also make a lot of shows in other countries because they exist everywhere and they make movies in dozens of languages. And so there's just a lot of questions to try to unpack here. And I don't really think that Trump has the answer to them at this point, but hopefully we'll have some clarity in the next few weeks.
Just lastly here, I wanted to ask you about the incentive system that's in place here domestically and how, say, a state like Georgia or Texas, California can compete with these foreign countries. In other words, is the competition a domestic competition mostly when Hollywood's looking to make films, or do we see it playing out kind of on a global scale?
Well, yeah, there's two levels of competition, right? There are a lot of people who want to bring more production back to California specifically, because we've seen a lot of production move to places like Georgia, New York, places that have offered generous incentives to lower production. And that's all within this country, so I don't see why Trump would really care about that. In fact, he might cheer because California is not exactly the most hospitable place for him politically. Then there's the second aspect of it, which is the global part, where again, there are very generous incentives to shoot elsewhere. There are different labor environments. One of the things that John Voight and Stephen Paul, his manager, and others have pushed for is maybe a federal incentive that could be on top of state incentives that would make it cheaper to shoot here. How much of an impact that would have, I'm not really sure. But I do think that studios and producers would welcome the U.S. trying to be more competitive and make it more compelling to shoot here, because most people would rather shoot here if they can.
Lucas, thank you very much. That's Lucas Shaw of Bloomberg News out in California, helping us to parse that post on Truth Social from the President of the United States. Something else the President talked about over the course of the weekend was gas prices and energy more broadly. He did that on comments that he made on Air Force One and also during an interview on Meet the Press with Kristen Welker. Let's take a listen to what he had to say about energy prices.
Prices are down for oil. Prices are down for all energy. Prices are down at tremendous numbers for gasoline. What really killed us with inflation was the price of energy. It went up to $3.90, even $4, and in California, $5 and $6, right? Okay. I have it down to $1.98 in many states right now.
The president's saying he has it down to $1.98 in many states. I took a cursory look at the AAA fuel tracker yesterday. Couldn't find one that had it below $2 a gallon. Mike McGlone is a strategist with Bloomberg Intelligence, senior commodity strategist at Bloomberg Intelligence. He joins us now from Miami. That's where I want to go with you, if I could here, Mike, and that is that the president has all of this rhetoric about drill, baby, drill. He's talking about gas prices being incredibly low. We see oil prices sinking today. Now we have OPEC Plus saying it's going to flood the market and boost production here in the month ahead. Help me see my way through all of this, both the president's desire for oil prices to go lower, and yet the very real pain that's being felt, I think, here in the U.S. and in some oil producers around the world.
Well, hello, David. In my view, he's going to get it partly because he has pre-existing trends in his favor. Before he was elected, we had an issue in the world of declining demand, most notably from China, crude oil, diesel, and things, and massive increase in supply and production, and excess of capacity out of OPEC. What's happening? They can only wait so long, and they're starting to bring that excess capacity on the scales. On the markets. The key thing to think about is gasoline. It's a significant thing for consumer sentiment. The average price on a national basis is about $3.16. That's up on the year, but from last year at this time, which is a way to measure because now we're in summer driving season, it's down from $3.60, so about 15 cents. Yeah. And I think it's eventually going to get down to $2 on average, but unfortunately, we've had three bottoms near there that started in 2008, 2016, 2020. They're almost always associated with recessions, but I think they're going there. It's just a matter of time, and crude oil is on that trajectory.
Mike, we see OPEC Plus, the cartel, boosting production by 411,000 barrels, and this is a cartel that's led by the likes of Saudi Arabia and Russia, and I understand there's an impulse here to punish some other producers, make them sweat, I think is the technical term. How effective are they in doing that by boosting production the way that they have here and look forward to doing in the month ahead?
Well, I'm enjoying that narrative, Dave, because it was a thing I've been predicting for 2 years. It's just, it can only hold off their production for so long. Exactly why they're saying they're doing it doesn't matter as much to me as the fact that we have a president who wants lower prices. We have pre-existing trends in their favor. The whole economic situation is turning that way. And by the way, I think President Trump's visiting Saudi Arabia soon. So this is something we've been waiting for 2 years in the oil market. Now it's happening. So it's a question of where it stops. So crude oil around $56 a barrel is a pretty good support area from the average price 2019. That's what prices always do. They asked about the average cost of production in the U.S. Commodities always go back to their average cost of production. But typically, in the past, the since 20 years, you've had to get below those levels, which has been around $40 a barrel. So I think it's going to happen, and OPEC's going to just help make it happen. And the thing is, they held off their production for so long, they need money, and it's all coming back on board. And the key thing, remember at OPEC, they're a diminishing significance of their cartel. Maybe they're less than almost 25% of global production. 20 years ago, they were 40%. It's becoming less important. The U.S. is the largest producer and a net exporter now.
Mike, I want to ask you about the degree to which uncertainty is affecting a number of these producers. So, of course, you acknowledge the fact President Trump heading to the region shortly, but we saw news out of Israel that they're vowing to step up their fighting in Gaza. We could see another incursion there. How much has that, and is that likely to affect prices broadly, that level of instability in the Middle East?
Any type of violence and wars and things and missiles flying in the Middle East are usually a bid for crude oil, but that was really the narrative from 2 years ago when the war started, and it's been diminishing over time, partly because the world shifted. U.S. doesn't import oil from that area, and if they do, we have a net export surplus going away from the U.S. We actually have a glut of crude oil and grains in this country. We have to export them. If we don't, the prices go down, and that's part of what's happening with the trade war. But when you hear about that kind of, anytime market bids up for kind of missiles flying in the Middle East, unless there's a definitive cut in production or supply, it usually is a short-term bounce and goes back down to the macro. And the macro is, particularly if the U.S. stock market's heading low for a U.S. recession and all the rest of the world faces tariffs from the U.S. recession, from the U.S., as their demand was declining from China, you see that tilt. It's just back to a normal downward cycle. That's the key thing. We haven't really got cheap yet. We're just heading towards that level. Right now, we're about break even.
Mike, lastly here, we got about a minute left. What have we heard from the heads of major U.S. energy companies? What are they watching? What are they paying closest attention to here? Again, we've had a number of interviews with them, spoken on earnings calls as well. If you were sort of to give us a sense of their message overall, what would it be?
Well, I can tell you what they're doing in futures. There's a backwardation of futures when the further out futures price has been lower, and I think partly because they're selling their production ahead. They're doing a prudent thing to hedge their production, which means they can still bring it on and sell it forward, and if prices drop right away, they're somewhat hedged. Now, most of those producers are usually hoping for higher prices, and they say it, but they realize the problem is they're going lower, and because of rapidly advancing technology, they can bring in more supply, and they have been, most notably the miners, the independents, and bringing it on, particularly in the U.S. and U.S. shale. So this might curtail U.S. shale, but you're probably going to have to get below $50 to really cut off that excess supply of the U.S.
Mike, it's always great to catch up with you. Thank you very much. That's Mike McGlone, Senior Commodity Strategist at Bloomberg Intelligence here, as oil is really in focus, given what we've heard from the president, the prospects of the trip that he is scheduled to take to the Middle East in just a few weeks' time, and of course, what we heard out of Israel about the prospects of there being perhaps a second incursion into Gaza. And we look at oil prices here really hovering around that $60 a barrel level, and a real concern for a lot of U.S. oil producers, given the fact that there is a threshold under which producing oil becomes increasingly difficult for those companies. Coming up here on Bloomberg, Balance of Power, much more about what the president said over the course of the weekend. We'll look ahead to the reconciliation process on Capitol Hill as well. And our analysts, our all-star panel, coming up too. This is Balance of Power on Bloomberg. David Gura in D.C.
It's 12:40 on Wall Street. I'm Amy Morris. We check markets for you all day long here at Bloomberg. The S&P 500 is now down 0.2%. NASDAQ down 0.4%, and the Dow is up about 0.25%. The 10-year Treasury yield at 4.34% and the 2-year yield at 3.84%. Trade uncertainty still hovers over the market. This morning, Treasury Secretary Scott Bessent is making a case for a long-term view.
America is the Schelling point of global finance. We have the world's reserve currency and the deepest and most liquid capital markets and the strongest property rights. For these reasons, the United States is the premier destination for international capital.
Treasury Secretary Scott Bessent speaking this morning at the Milken Institute Global Conference in Beverly Hills. Citigroup is increasing lending to private equity and private credit groups, aiming to catch up with peers like J.P. Morgan Chase and Goldman Sachs after years of reduced involvement. Citigroup CEO Jane Fraser is pushing to overhaul the bank and boost profits with the goal of lifting return on tangible common equity to 10 to 11% by the end of next year. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Let's go back now to Balance of Power with David Gura.
Amy, thank you very much. David Gura in for Joe Matthew and Kaylee Lyons on this Monday. We heard there from the Treasury Secretary talking about America's role in the world, pushing back on some criticism that the U.S. is losing its ground, losing some of that American exceptionalism. That's been happening on Wall Street. It's been happening on Main Street as well. It's something that came up during an interview over the weekend that Kristen Welker did with the President of the United States when she brought up the fact that there are Americans who are feeling some financial pain as the President's trade war continues. Here's what he had to say about how Americans should sort of comport their spending habits as those tariffs go into effect.
I don't think a beautiful baby girl that's 11 years old needs to have 30 dolls. I think they can have 3 dolls or 4 dolls because what we were doing with China was just unbelievable. They don't need to have 30 dolls. They can have 3. They don't need to have 250 pencils. They can have 5. We don't have to waste money on a trade deficit with China for things we don't need, for junk that we don't need.
The new mathematics of dolls and pencils from the president. Judy Cianzano joins us now. She's Senior Democracy Fellow with the Center for the Study of the Presidency and Congress. John Seaton is with us as well, founder and CEO of Echo Canyon Consulting and a Republican strategist. Judy, let me start with you and just get your reaction to the comments we heard there from the president. This is something I won't even say doubled down on, kept coming back to over the course of the weekend. He talked about this an awful lot, the way that consumers should recalibrate their expectations of what they should buy or be able to buy. What does that say to you about the effectiveness of the messaging that he is trying to do right now when it comes to presenting the case for these tariffs policies?
You know, it is not effective, and I think Scott Bessent's op-ed today, that is the effective way to go on this. You talk about holistically the plans for the economy, deregulation, the 217 tax cuts. All of these things are going to do, and if they all come together, the economy is going to be reset and there will be a boom time for the United States. What you don't do, David, is go out and tell people that we are limited to 5 pencils and 2 dolls. And so from a messaging standpoint, it is very problematic. And I think my favorite headline in the last week was Rupert Murdoch's New York Post, who had a headline after the first time he said this at the cabinet meeting where they said, skimp on the Barbie. And I think that pretty much said it all. This is breaking through and not in a good way for the Trump administration.
Skimp on the Barbie. John Seaton, let me bring you in here, and I wonder if you agree with Jeannie. You have a president who I'm sure would rather be talking about the prospect of those deals coming together, maybe progress being made on Capitol Hill. You could almost sense the displeasure he had having to talk about this once again on Air Force One last night. But it does seem reflective of the fact that this is a moment when Americans do have some real concerns about how these policies are coming into place.
There are concerns, and I don't disagree with my colleague. I think that it's challenging to ask the American people to kind of to sacrifice whether it's dolls or pencils or whatever else. And I do think that a broader message about why some of these steps are necessary and what it's going to look like down the road is going to be a lot more effective. And quite frankly, I think that this president has proven time and again that he's very good at communicating with the American people and kind of getting buy-in. And I think this is an opportunity for him and his administration to talk about how this will impact not just the kind of the global order of the economy, how this will affect families in a positive way going forward. And so I'd love to see more of that rhetoric coming from this White House and from this president.
John, I'm glad that you bring that up because something that's been a curiosity to me is why we haven't seen, say, an Oval Office speech, or we haven't had an address the likes of which that we got from Scott Bessent, the Treasury Secretary, just a few minutes ago when he was, yes, addressing investors out in California at this conference, but kind of speaking in broad terms and making the case for the policies that this administration is trying to get in place. Why do you think that we haven't seen a more direct explanation of them from this president to the American people? Is it reflective of the way that he sees the media environment? Does he not think it's necessary? How effective do you think it would be if he were to do that?
Yeah, I think that he's shown his preference really is more informal settings. He obviously takes a lot of questions from the media. He did meet the press yesterday. He often will do gaggles in the White House where he takes media questions. And I just think that he'd much rather speak in that kind of more informal, off-the-cuff way, answering questions, than in a more kind of staid approach from an Oval Office address. So I think it's how he feels he communicates more effectively, and that's his preference.
Jeannie, I want to turn to you here on sort of the other parts of his economic agenda, principally here taxes, and we've had a lot of conversations, you and I, about sequencing and the way that this administration has approached both of these issues, trade and taxes. Where do you see things going on Capitol Hill when it comes to trying to get the extension of those Trump-era tax cuts? Sort of, what role do you expect Democrats to play here? They can't play an active role here in the actual writing or passage of the bills themselves, but what does opposition look like as this process continues?
You know, I think we're going to see the Democrats sort of sit back and watch. I do think that the Republicans will ultimately get an extension of that 2017 tax cut. But I think one of the big missed stories about this is that for somebody who went out onto the stump throughout that entire election year and talked about lowering taxes, lowering prices, this is not a tax cut. It is a guarantee against a tax increase that is set to occur. So best case scenario, they extend that 2017 tax cuts. People are not going to feel much different in that regard. But I do think they get there. I do think the Democrats are going to be holding their fire and watching and making comments like we heard Hakeem Jeffries over the weekend say over and over again, where are the tax cuts and the lower costs that were promised? You know, in some ways, Donald Trump sounds a bit like Joe Biden. Joe Biden kept talking for a couple of years about people don't see how good the economy is. This is Donald Trump. You're not seeing it's excellent. But people know when they go shopping, and they're going to know when they go back to school shopping and Christmas shopping. If these shelves are empty, they are going to blame Donald Trump. They will not go back and blame Joe Biden.
John Seaton, Jeannie laying out the broad contours there of a problem as she sees it for the president. How does the Republican Party get around that? The kind of continuation of the status quo if they get it, but also just sort of matching the rhetoric of things are fine with what people on the ground might be feeling or seeing?
Right, and I think that was a huge challenge, as Jeannie points out, from the Biden administration when they were trying to tell people to kind of not believe their own lying eyes. I do think that this administration needs to continue to, press the case as to why these policies long-term are going to be effective, what impact it's going to have on families. But, yeah, I do expect that until people see a real change in prices and a real change in their own kind of economic situation, people are going to blame the party in power. It's very, very difficult, no matter how many times you say it, to point the finger at a previous administration. And I do think that the further we get into the Trump administration, more and more people are going to look at this administration as good or bad, the reason why that they're in the economic situation that they're in.
So here we are now, 100-plus days into this administration, into this term, and we've seen the administration take claim for some facets of the economy, not take claim for others. We saw that most recently with the jobs numbers that came out last week. This is something else that Kristen Welker asked the president about during that interview. Sort of, when does the Biden economy become the Trump economy as he sees it? Let's take a listen to what he had to say.
When does it become the Trump economy?
It partially is right now, and I really mean this. I think the good parts are the Trump economy and the bad parts are the Biden economy, because he's done a terrible job. He did a terrible job on everything. Ultimately, I take responsibility for everything, but I've only just been here for a little more than 3 months.
Jeannie, parse that for me if you would. Again, the president there is saying the good parts are the Trump economy, the bad parts are the Biden economy.
Yeah, it's a bit of wishful thinking, or a lot of wishful thinking. The reality is, you know, I sometimes liken it, you can't convince somebody to like you and date you. They look at the reality, and this is what Donald Trump over and over again wants to say. He wants to say, what I'm doing is great. Anything bad that we are experiencing, that goes to the previous administration. But people know, and the recent polls we've gotten, as much as the president wants to discount them, including the Fox News poll, say otherwise. You know, we had a Gallup poll, 9 out of 10 Americans said tariffs, Donald Trump's policy, has led to higher prices. 60% in the Marist poll said the economic conditions are a result of Trump policies. He's not going to be able to talk his way out of it. He's going to have concrete wins on the economy, or he's going to have to convince people that the pain that they're experiencing now and in the short term is going to be worth it in the long run. He can't get away from that as much as he tries to talk his way out of it.
John, when you look at this issue in particular, how much longer can he make this argument that not everything is his, that he doesn't own the whole of the economy?
Well, it's an interesting point, and I'm glad you brought up the polls, because I think the polling has really been a mixed bag specifically on this point. CNN had a survey out at the end of last week that shows that even though I think people are dissatisfied with their current economic situation, they still prefer President Trump to either a hypothetical Kamala Harris run, or not hypothetical, versus Kamala Harris, as well as the Trump approach versus congressional Democrats. And so I do think that while I would like to see the messaging more reflect the concerns of the American people, there is some degree of grace being given to this president. They still prefer him over the alternative.
John, I want to wrap up here with trade and the trade talks that are continuing between the U.S. and other nations. What are you watching for signs of progress? I imagine you're fielding calls and queries just about sort of what notional success looks like here, and how do you respond to that? Yes, there's a lot of kind of happy talk about conversations happening, prospects of a deal, memoranda of understanding, et cetera. What is actually going to make a difference here for those who are wondering how much progress is being made?
Well, my expectation is that things will go slowly until they go really quick, and I think at that point we will see, one or more deals made with our trading partners. Tariffs has been something that this president has talked about since well before he was president, so it shouldn't be a surprise to anyone that he's very concerned with kind of trade inequities, and I expect that deals will get done. Trade is fundamentally good for both parties, and I think once those deals start to occur, we'll see some improvements in the market, and the Trump kind of agenda will be borne out.
Jeannie, I'll put that question in variation to you. Sort of, what are you watching for here? What's going to be a sign of progress? Picking up on what John said there just a moment ago, this notion that trade is inherently good. It's a sign of cooperation and countries working together here. What's going to be an indication to you here that the administration is making progress in these conversations?
Number one, it's going to be the trade deals. Yesterday, he said there should be trade deals coming this week. Hopefully, that is the case, and we see those. Of course, on April 25th, he promised he had already made 200 deals. We haven't seen those yet. But trade deals are number one. And then, of course, watch what happens in Congress, because the tariffs is the difficult part of his policy. The better part that people are going to be more excited about is the deregulation, the tax end of things. So if he can put those all together, and again, I point to what Scott Bessent is saying together, that can be a win for the administration, but it's going to be threading a needle, because these are all hard things that he set himself out to achieve.
My thanks to both of you for joining me. We're going to talk to you a little bit later here in the next hour. But that's Jeannie Sheehan-Zaino, Senior Democracy Fellow with the Center for the Study of the Presidency and Congress. John Seaton's the founder and CEO of Echo Canyon Consulting, a Republican strategist. We pick apart the conversations that the president had over the course of the weekend on Meet the Press on NBC News, the post that he made on Truth Social, and remarks that we've heard from senior advisors of his over these last few days, most recently by Scott Bessent, the U.S. Treasury Secretary, who's speaking at the Milken Global Conference in Beverly Hills, California, where I should say Bloomberg has a significant presence, moderating many of those panels, convening interviews on the sidelines as well. Jane Fraser, the CEO of Citi, the big bank, is scheduled to speak with our Sonali Basak here in the next hour. We're going to bring that conversation to you live. Any number of panels and conversations coming up as well with leaders in business and investing, politics and policy as well. Just a huge gathering there of investors out in California. As Balance of Power continues here on Bloomberg Radio and YouTube, David Gura in for Kayleigh Lyons and Joe Matthew. Coming up here, we're supposed to hear from the President of the United States. He has a number of events in the Oval Office this afternoon. A sports announcement has been teased by the White House. He has another one. He's going to welcome a citizen home to the United States of America and sign some executive orders as well. We'll be tracking all of that. And again, the goings-on at the Milken Global Conference in California. This is Bloomberg.
From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
Good afternoon. David Gura in for Joe Matthew and Kayleigh Lyons on Balance of Power on Bloomberg Radio and Bloomberg Television. It's a busy 1 o'clock hour here in Washington and on Wall Street. Let me walk you through it. My colleague Carol Massar, of course, the co-host of Business Week Daily out in California. She is there for the Milken Global Conference and scheduled to sit down with some of the biggest names in commercial real estate, including Barry Sternlicht. We're going to get to that panel as soon as it begins, give you a sense of what the conversation is like among some of the biggest investors in this country and around the world about the prospects for real estate going forward here. And a busy afternoon for the President of the United States as well. The President is in the White House teasing an event, a sports announcement in the Oval Office. And we first heard from Axios this morning that has to do with the National Football League. He's expected to be there with the commissioner of the NFL, Roger Goodell. If past is prologue, often there's a Q&A that opens up after announcements like these, a wide-ranging Q&A, and we will bring you some of that as it gets underway, and given all the news the president made over the course of the weekend on Air Force One and on Meet the Press, likely that would touch on the economy as well. We're going to have the governor of the state of New Mexico with me here on set in Washington as well. But I want to start at the White House with my colleague Tyler Kendall, our Washington correspondent here at Bloomberg Television. We just heard from Scott Bessent, the Treasury Secretary at that Milken Global Conference, Tyler, talking about this notion of American exceptionalism. And I'm curious what stood out to you from his comments, what he had to say to that gathering of investors.
Yeah, hey, David. Well, it appeared that the Treasury Secretary was really trying to push forward what this White House is saying is their three-pronged approach when it comes to the economy, particularly when it comes to tariffs, taxes, and deregulation. We know that the administration would like to really focus more on that tax part as they push Congress to get through that reconciliation package. But as you're about to hear, he made the case that these three things combined really do make for a good environment when it comes to investing global capital.
America is the Schelling point of global finance. We have the world's reserve currency and the deepest and most liquid capital markets and the strongest property rights. For these reasons, the United States is the premier destination for international capital, and the administration's goal is to make it even more appealing for investors like you.
Concerns about the international appeal of dollar-based assets really did materialize, as you well know, last month amid the stock market turmoil, amid so much tariff uncertainty. And Bessent actually went on there to say that tariff negotiations often aren't a, quote, pleasant process, but that there is an end game in sight. We know this administration is perhaps suggesting that we could see some movement when it comes to framework agreements as soon as this week. Of course, we aren't expecting those full-fledged deals, which could take months to really hammer out, but perhaps more something like a letter of an intent to outline frameworks of some sort of agreements when it comes to these trading partners. And we are closely watching those countries that the administration says that they are prioritizing, those countries that are geographically close to China, like Japan, South Korea, and India. We know some of the terms perhaps that could be included, including that the U.S. would like to see these countries really boost their imports when it comes to some U.S. products, particularly U.S. LNG and U.S. agricultural products. And David, I will mention two quick updates from today already. People familiar are telling Bloomberg News that India is prepared to lower tariffs to zero on a reciprocal basis for steel, autos, and pharmaceuticals. And then we actually heard from Japan's finance minister, who confirmed that the sale of U.S. treasuries will not be involved in any deal. That was one development that we've been tracking.
Tyler, thank you very much. Tyler Kendall at the White House with that update on what was happening, what was being said at the Milken Global Conference, which is to where we return now as Carol Masser, my colleague at Bloomberg TV and Radio, presides over a panel on commercial real estate with Deborah Carafa, the CEO of Ventus, Justin Kennedy of 3650 Capital, Andrew Smith of Bayview Asset Management, David Steinbach of Hines, and Barry Sternlicht of Starwood Capital Group. Let's take a listen to what they're discussing there in Beverly Hills, California.
Orders, but they're no longer here either. So we shouldn't take it for granted where we are. And we have a $37 trillion deficit on its way to $50 trillion. And that's going to require funding from the rest of the world. So don't be so complacent on our position in the world. The British had a pretty good run, sort of the Holy Roman Empire. You know, we had 100 years. And honestly, I look back, and I talk about this sometimes, if we don't fix our education system, the destiny of the United States is not good. And I saw this morning Abu Dhabi's introduced AI into schools. We have to actually get with the program. We can't rely on historic innovations that also came from immigrants that run all our great tech countries that we want in the country today. So you got to look in the future, not in the past. And I think we have a lot of challenges. We should win.
You know, there's something, and I had promised these guys I wasn't going to start macro, but the one thing that I think is interesting, and forgive me, and I can't remember who's said this, but it's Donald Trump being the right question, he's just not the right answer. And Deborah, you're nodding.
Yes, I would point out and agree with a lot of what Barry's saying, but if you think about our global leadership position in biomedical research, for example, we're the envy of the world, there's almost $1 trillion in spend, and whatever the question is, cutting fundamental research that's going to cure Alzheimer's and deal with chronic conditions is essential and has a huge multiplier effect on the economy. So we have to take care not to destroy the advantages that we do have and also create new ones, as Barry's talking about with education.
Are tariffs? Oh, go ahead.
Yeah, I think part of what we're saying in agreeing with that is that there's just a lot of noise that we don't know how to cut through, that the communication globally on what we're doing is not really there. So I think we all believe that the ultimate goals are ones that get us to the right place, but how many people do we offend along the way, and can we kind of reel it in enough to make a difference?
Well, you live in a glass house. You have a $37 trillion deficit. The deficit will easily pass $2 trillion this year. So, I mean, you have to recognize that even in the Trump 2019 economy before the pandemic, you ran $1 trillion deficit with a 3.8% unemployment rate. We were basically, as one of the money managers said, we were on sugar highs. You know, we were not fiscally responsible. And somewhere in here, we're going to have to, we can have a 20-year plan. It doesn't have to be overnight, but we have to have a plan to have global confidence in what we're doing. And, you know, it's both the revenue and the expense side. We got to get the revenues. So it's not a foregone conclusion. We should win. I mean, we are by far the best at most everything we do here. And people envy this country. We have to continue to want them to envy. And the best and the brightest have to come here. They can't go to England. They can't go to Toronto. And we have to let them in. So we want all these fabulous people here.
Just one question on tariffs. So is tariffs then the right strategy? Is it right, this pushback? I'm not saying the back and forth, but in general of saying terms have to be fairer.
I thought we weren't doing politics.
Sorry.
I mean, I'm going to get myself in serious trouble.
Okay, so you be quiet for a second.
I agree with 100%. Everything.
I do think deals will get cut. It's going to be time. It's probably take more time than we probably appreciate. We're going to have to live with this in-between period of a lot of just uncertainties that businesses are pulling back to wait to see what plays out.
Right.
But I think even on the other side of this, it does feel like there will be more friction costs in the global business of trade. After you squeeze all the toothpaste out of the tube, it's really hard to put it all back in.
Mm-hmm.
And so I think we are going to be living in a world of more friction costs. And I think that, though, to me is a broader theme of deglobalization that we've been watching for several years now. This is simply deglobalization playing out. And this is going to be one of many things that investors are going to have to think about and navigate.
All right. Politics aside, I've heard. I got the message. Well, let me just ask you guys, are you optimistic in terms of when it comes to real estate investing? Show of hands. That's kind of, all right. Those who don't think it's so great, show of hands. All right, so a little bit more optimistic.
Undecided.
You're a credit guy.
What?
There's a reason I'm a credit guy.
You're a credit guy.
Yeah.
Are you?
Do we get to vote?
Yeah. Are you optimistic?
Yeah, actually.
Show of hands.
For real estate.
Yeah.
Yeah. You guys are pretty up. Are you optimistic?
I'll be the outlier here.
You're going to be the out. Well, that's opportunity for you.
Sorry?
Is that opportunity?
We think so, but it's at the same time a risk factor for the markets. We see a situation where real estate has really changed fundamentally across a number of very important, let's call it, hurdles that people have to think about in terms of their investment strategies in the current environment. The dispersion of returns, particularly looking at the commodity part of the asset class. And maybe people up here may be in a little bit different place relative to specialization in Deborah's book and let's call it A++ targeting at Hines. As we look at the market, these types of strategies have been very successful.
Mm-hmm.
At the same time, the commodity part of a market has suffered a huge shift in demand. And demand.
What asset class are you referring to? All?
Industrial has had a shift in demand to the positive side. Multifamily is kind of a more complex picture that's really regionally guided. But both retail was really both retail and office where we first saw, let's call it, the impacts of technology changing, let's call it the core utility of properties, that these are markets where we're been through 15 years of re-equilibration in retail, and we're just at the start of looking for equilibrium in the office markets on the commodity part of the asset class. You know, just a quarter mile away here on Avenue of the Stars, the highest rents, the highest occupancy ever seen. Same was true in Park Avenue in New York. Yet downtown Los Angeles is having essentially an existential moment in terms of, are tenants able to pay rents or are rents able to be achieved that are at all accretive at any price for those assets. 1 year of rent on Century City buys you a building in downtown Los Angeles. And this is a very new place for the markets, and this is what we're concerned about. And then, the questions that this poses for, let's call it traditional real estate strategies, we think are pretty significant.
So lots of dispersion. David, you want to?
Yeah, I was going to say, I also think, what's happening in the market is this dispersion, but what's compounding that, and I think investors need to be thinking about this in terms of the next couple of years, is new supply has really been cut off, right? Interest rates moved 500 basis points around the world, and the development does not pencil anymore. And so many projects around the world have been now stopped for now. And that, people forget how long it takes to build things. You just don't throw these things up. I mean, there's the planning, there's the consent, there's all the things that have to happen locally. Then you have to actually do the construction. And so I think that what we're gonna see in this environment is right now is certainly a time to buy, not build. And there's some great opportunities on the buy side. But what people are not watching is the fact that we're not building anything. And that will drive even more rent growth for the best in class and will become a big opportunity. So a thing I think investors miss, and this is a common, you just see this through cycles, is the market is now in a buy phase, and which is great. I think it's a great opportunity. But they're going to miss these early development signals that will start emerging because the best margins in development are early in the cycle, and they diminish as the cycle wears on. So that's this turning point. That we're not there yet, but I think it will be coming in the next 18 months. Say.
I mean, I think most investors know the supply picture for real estate. I mean, if you're sophisticated, you know the multi-stack is going to drop 60%, the industrial stack's down 70%. Nobody in the right mind would build an office building unless it's a build-to-suit for a tenant today. Hotels are still trying to build, but cost of capital is so enormous that they're struggling to make the numbers work. The lending markets, which Justin is in, and I think Andrew also, I mean, they'll lend us money for office buildings at 400 or 500 over. We'll say, no, thank you. It's higher than, it's massive negative leverage on the debt side. But it is one of the most important premises of opportunistic investing in real estate is replacement cost. And you can buy most everything pretty cheap here, and with the land at zero. And it's just a question of what it's going to cost to keep the building, whatever it is, tenanted. But it is interesting to me. I started this new hotel brand, One Hotels in Baccarat, and we're not a commodity. And because of that, we're like 150 to 170% of fair market share in every market we operate, and we're in like 15 or 20 markets now. It's happening in real estate too. People are running office buildings better. She's running her senior housing and assisted living and senior stuff better. Commoditization is leaving the table, and you have to do something better. And there's some crazy office building in New York that I haven't visited yet that is downtown, and it's like a theater. My kids go to this office building. I don't know what they're doing, but I actually know what they did. They went to get some kind of treatment, like massage or something. But it's in an office building, and the guys turn it into Disney World. So I think I'm on the board of Estee Lauder. They've had all these brands. They have 25 brands: Le Labo, Joe Malone, and Estee Lauder, Bobbi Brown, Aveda, and The Ordinary, which is now a multi-billion-dollar brand. They call these new entrants that you get on your Instagram phone piranhas, because I get the thing. Take my spots away, give me hair, I order it, doesn't work, but I order it anyway.
It's hard.
So
that business.
It is really, really interesting today how you take real estate and make it not a commodity. And it's upping the game on all of the operators in the business to figure out how to do in your asset class to steal market share. Because there's plenty of occupancy. You just have to be different and unique and appeal to I built an office building in Miami during the pandemic, at least without a leasing broker.
Yeah.
100% occupancy. I could sell everything, and the rents. The first lease I wrote was $55 a foot, and 8 months later, the last lease was $125 a foot. I didn't even know how to price it because we hit the market exactly right. We had the right product in a market, small floor plates for high net worth families. And it's a joke. So if you get it right, you can add a lot of value.
What
you can make a lot of money.
Barry, is that you're using.
That was Barry Sternlicht of the Starwood Capital Group there at a panel at the Milken Global Conference in California at the Beverly Hilton. Our Carol Masser moderating that panel on commercial real estate. If you want to continue following it, you can at Live Go on the terminal. We'll continue to bring you a lot more from that conference over the course of the day. Let's check in with Amy Morris here in Washington for Bloomberg Business Flash and check on the markets. Amy.
All right, thank you, David. Rite Aid intends to file bankruptcy less than a year after completing an earlier restructuring. The company is not able to secure additional capital from lenders and plans to cut jobs at its corporate offices in Pennsylvania. A Chapter 11 filing would mark Rite Aid's second bankruptcy in less than 3 years following its first filing in October of 2023. Skechers is going private in a deal with 3G Capital. 3G ready to pay $63 per share. Shareholders have the option to get $57 per share in cash and one LLC unit in a newly formed private company that will be Skechers' parent company. The transaction is expected to close in the third quarter of this year. Shares of Skechers now 25% higher. Now, as for the markets, Chris Harvey at Wells Fargo is hopeful investors are getting more clarity now from the Trump administration.
I think we're past peak uncertainty. And what we do is we look at it this way. He went very hard very early. In order to get that pressure back, I think you'd have to put us into recession. I don't think this administration wants to go into recession because what it would mean.
And we do check markets for you all day long here at Bloomberg. The S&P 500 down 0.3%, NASDAQ down 0.4%. The Dow is higher now, about 0.1%. The 10-year Treasury yield at 4.35% and the 2-year yield at 3.85%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Let's go back now to Balance of Power with David Gura.
Amy, thank you very much. David Gura in for Joe Matthew and Kaylee Lyons here on this Monday, and we were hearing a lot about immigration in the panel that just wrapped up there. Have an opportunity to talk a bit more about that now, some other major issues as well with Michelle Lujan Grisham, the 32nd governor of the state of New Mexico, who kind of joined me here in Washington, D.C. Let me start with healthcare, and I imagine you being here in Washington have it's an ear to the ground when it comes to the conversations that are taking place on Capitol Hill about proposed cuts to Medicaid, which I know is crucially important to a lot of folks in New Mexico. If that were to happen, and they're talking about cuts of $800 billion, close to $1 trillion, what would it mean for folks in your state?
Well, it's devastating. I mean, we're not talking enough about what it really does. There's been a lot of present company excluded platitudes about, oh, we're just trying to get at right-sizing a lot of these federal investments. More than 400 rural hospitals are already barely surviving. 46%, frankly, of all rural hospitals barely make it under the current system with Medicare, Medicaid, veterans payment investments in the private market. You take out $880 billion, those hospitals close. All of those outcomes, right? Maternal health, infant mortality, all the things that we need to do better as a country all fall apart. Less access to obstetrics. So in a state that's trying to build healthcare access, this is bad, terrible, the worst. Two more quick things.
Sure.
Every governor in the National Governors Association signed a resolution saying, you know, we'll negotiate with you individually about what we think is best for our states and Medicaid, and you can incentivize those negotiations, but don't just indiscriminately cut funds. So every governor, bipartisan, said this is exactly what our residents and our states don't want. And two, you know what this really is like? It's like having the federal firefighter folks come into your state, and I would know a thing or two about that, in a wildfire, bringing flamethrowers and wind machines. This is not helpful. How about if Congress works on reducing healthcare costs? And we could do that by restoring the ability to negotiate on drug prices.
Do you find that what you're saying is getting through on Capitol Hill, you and other Democratic governors, or is it?
Well, clearly not, because what we're seeing so far in the proposed resolution is that the only way to get where they want to go in budget cuts is to go after Medicaid indiscriminately. And frankly, they wouldn't have to do that if they had a health care plan. And Republicans in Congress have never had, as far as I know, a health care plan. And I think Americans should be really disappointed. And I think, quite frankly, they need to be weighing in with their governors and their elected members of Congress. costs will go up. Small businesses will not be able to afford to provide coverage to their employees. No access means you're out more sick days. Everything that really creates more instability, this is what we're doing. And of course, healthcare is a huge employer. That means fewer people with jobs. None of it makes sense to me.
I want to ask you about immigration. Of course, you preside over a border state, and we hear a lot from the president about the successes he sees in terms of boosting security on the border. I'm curious how that's reverberating across New Mexico. So if you look at people who are here legally, for instance, they look at the ICE raids that are taking place, the degree to which the kind of security mechanism of the United States has been brought to bear here. What's the effect of that had on kind of the zeitgeist in the state among immigrants in New Mexico?
Well, there's a lot of fear and uncertainty in New Mexico, and that even bore out many of the debates in my just ended legislative session. It's our policy session. We've got 48 folks who were sort of the subject of that national kind of coordinated set of raids by ICE trying to utilize local police and even some Border Patrol folks who shouldn't be in the interior. If you're looking at border security, here's an idea. Have them at the border. There's a lot of angst. New Mexicans, and I would add my own direct opinion and voice here. My job is to represent effectively my state and also solve problems. We agree that bad actors, frankly, whether you're from here or not, we would welcome the federal government to do more in drug interdiction, to do more about stopping guns, drugs, and human trafficking at the border and anywhere else. What doesn't help us at all is not focusing on bad actors, but going after children and their families indiscriminately at hospitals, schools, and at workplaces. That just creates fear and anger and animosity and doesn't make our country any safer, nor does it help us build an economy that works for everyone. Here's what we should do. How about after they fix healthcare with a real plan that doesn't indiscriminately cut Medicaid, maybe we should pass a border bill.
On the issue of incentives and the incentive structures that are being put in place here, Kristi Noem, the Secretary of Homeland Security, just announced if a person self-deports, uses this government app to self-deport, and it's confirmed by the country to which they go, they'll get $1,000. Does stuff like that work? I'm just curious, sort of your sense of the dialogue again around how this government is both incentivizing and kind of pushing people out of the country.
Well, I understand that I worked for governors, and now I am one. President set a pretty grand target for deportations that I don't think were based in fact in any context, and you got a cabinet secretaries trying to meet that. I think it is a ineffective and really gross tool to suggest that people were just here to quickly make a buck and that there's no real issue with asylum and refugee status and trying to build a safer future for your family. And it's pretty disrespectful. What we ought to be doing is stop separating families. No one in America, I don't think at least, wants to see another 3-year-old in a courtroom by themselves, or American children who are separated from their country because their parents are leaving, or the opposite, they are not going with their parents or parent, and there's very little information. New Mexicans, I think, reflect where a lot of the country really is. One, if you're a bad actor, help us. I don't want any bad actors. I want no more human trafficking. I want no more drugs moving through this country from anywhere. China, Russia, Mexico, anywhere. At the border or in the mail, in a truck or by plane or by boat, we don't want them. Two, I want us to leverage and coordinate our law enforcement so that we make every community, including my state, safer. And lastly, I want a better, fair investment about immigration policy so that you can get visas on the front end and that you can work here on the back end, and it's transparent and fair and meaningful. They have the opportunity to do that. Why don't they do that instead? I think that's what Americans are really, wanting. But this is an administration, I think, that wants to politicize this issue and try to divide America.
I have a unique opportunity to ask you what that level of engagement is like with this administration. I think a lot of us saw that moment in the White House when your colleague Janet Mills of Maine stood up effectively to the president, and it was icy, and there was blowback from him. There's been a settlement with Maine more recently. Do you feel like you can be heard, that there is any kind of dialogue between you as the head of a state and this administration, or is it simply kind of irreparably divided at this point under this president?
My hope is that it's not divided. I'm actually working to get into talk to as many secretaries. Did that today. Had some good news from the Veterans Administration on a request for a waiver so that we can keep building and investing in the ways that we have been for veterans long-term care, and we got that. We want to do drug interdiction and focused work with Homeland Security. We have a lot of emergency response issues. I need that relationship. I have a relationship with Secretary Noem from our time as governors and in Congress. And there are plenty of others, like the Secretary of Interior, Doug Burgum. And I'm working to develop a relationship in the White House. In my long career, I hope that most New Mexicans still think it's been an effective effort. I still love my state, and I'm working hard. And our economy is, I think, proof positive, and our cradle-to-career investments, bar none, best in the country. Every administration, irrespective of party, I have great support from and agreements with, and the opposite. And so it's navigating and doing what's right for your citizens. And I will tell you what my businesses are telling me. Can we land in a place that's predictable, that's fair, that doesn't feel like it's a roller coaster, because they don't expand, they don't invest when that's the situation. So my job is to create stability in every single relationship in the federal government. But I also don't tolerate, and shouldn't, anybody who goes after my state or tries to do something that hurts a New Mexican or their family. Any administration, including this one, should expect me to punch above my weight class.
Last question. We got about a minute left. You were recently in Japan and Singapore. What were those conversations like as you talked to government leaders there about the prospects for investment and economic opportunity in this country, given the uncertainty that you were just talking about?
I'm worried about tariffs. I mean, there wasn't a single meeting that didn't start with that. I was there with another governor, governor of Wyoming, and we were very clear we don't set that federal policy. We're certainly not in a position, and won't, to try to negotiate that. That's going to happen between you and the White House. But we have also, we signed saying that tariffs is, not the right for us, free trade, capitalistic set of policies that we think work best in our states. We were really clear about that. And where we really highlighted the opportunities in this administration is energy dominance, if you will, or production. The second largest oil and gas producer. We produce the cleanest barrel of oil and the cleanest liter of gas on the globe, because we set very, very clear carbon intensity, lack thereof, requirements. We have the strongest methane rules now that they've been rolled back at the federal government in the country. And guess where these countries want to go? They want to purchase the cleanest gas. Guess who has the largest gas reserve? New Mexico. So here's where I think I can find a really productive path. This administration wants to make sure that energy security around the globe runs right through the USA. I want New Mexico to be at the front of that. And frankly, Western states have been powering Western states forever, and Eastern states are going to need our energy. Solar, wind, geothermal, storage. Many states are working on small-scale nuclear fusion. That's happening in New Mexico as we speak. And absolutely, let us get LNG around the world.
Governor, nice to see you. Thank you very much. It's Michelle Lewin Grisham. Join me here in Washington, D.C. Appreciate her time on this Monday afternoon. I want to turn now to our political panel. Back with us once again, Jeannie Scienzano is with us, Senior Democracy Fellow with the Center for the Study of the Presidency and Congress. John Seaton, Republican strategist and founder and CEO of Echo Canyon Consulting, here with us as well. And Jeannie, I'll turn to you first. Just your reaction to that, particularly on the notion of trade and the way that the U.S. continues to sort of look for ways forward here in light of the uncertainty that's kind of overarching so many of the economic relationships.
Yeah, I mean, the governor just speaks so eloquently and really thoughtfully about the impact of this on people on the ground, and particularly, obviously, in her state. And I do think we need to hear more of that. It was one of the first things she said to you, David, when you started asking her, is we need to hear more, whether it's the Medicaid cuts, whether it's trade, or whether it's this new deportation policy, not necessarily new, which she described as gross.
when you listen to the stories of how this has impacted people on the ground, that is when people can make a real determination as to whether, in fact, the policy is one that the United States should be promoting.
John Seaton, on that same point here, you have her, of course, overseeing the government of New Mexico, other governors trying this as well. What do you make of that, the prospects for, I guess, the state level, trying to broker deals or kind of see through the maybe uncertainty that exists at the federal level, but might be clearer at the state level?
Well, I think to her point, you know, a lot of this is the purview of the federal government. And as I've said on this program and others, a lot of this really should not be a surprise. This is what President Trump campaigned on. And I do think that, you know, whether it's immigration and getting people who really should not be in this country out of this country, whether it is taking a tougher stance on trade and tariffs to make sure that we get fair deals, this is what the president campaigned on. So I don't think there should be a huge surprise here. And I do think, once again, as I said in the previous segment, that as long as the president continues to communicate how this will long-term affect and impact and benefit American families, I think that people will come around and be supportive of his efforts.
John, let me put a version of the question I put to the governor to you, and that is, how good is the relationship, do you think, between governors of both stripes, Republican and Democrat, and this White House? What more can be done here to have more constructive conversations in the interests in states that aren't Republican?
Right, and I'm not privy to those conversations, of course, but I do think that open lines of communication are always important, and governors really are kind of CEOs of their states, and so it's extremely important that there be open lines of communication and that they go both ways. Governors should continue to communicate to the White House and administration and the various agencies what it is that they need, what it is that they're seeing on the ground, and be supportive of the efforts, even if they happen to be of a different political party. At the end of the day, people are elected to serve all of their constituents, not just one party or the other. And so would like to see as much communication and transparency as possible between state governments and the White House administration, and I hope that that continues.
Jeannie, the governor and I didn't get to talk about 2026 or 2028. Her term is up in 2026, but something interesting is kind of happening in the state of New Mexico. She recently called in the National Guard to Albuquerque because of violence and crime there, got some pushback from that, but it's kind of sharpened this distinction between or among Democrats, that there are those who favor that kind of harder line approach and those who don't, and I think it's going to kind of set the foundation for the race for her successor, at least on the Democratic side here. What do you make of that? What does the New Mexico story tell you or tell us about the way the Democratic Party moves forward here to 2026 and indeed to 2028 as well?
Yeah, and there's nothing I like more than to talk about elections, David. So thank you. We don't get enough of them since 2024 in my book. But, you know, I think there is a real divide on the Democratic side. How do you handle issues regarding insecurity? And I think the governor is leading in the right way. There is no world in which any of us should be living insecure in our homes and worried about being victims of crime and violence. It is absolutely unacceptable. And so you have to deal with it as governor. That is her job as the executive of the state. And every other governor should follow suit. And Democrats who don't end up with a world of hurt, both politically, but more importantly, with their constituents, because none of us deserves to live in a place where we can't feel safe. So safety, economic security, those are number one and number two, or vice versa, however you want to count them, in terms of what an executive has to do. And as they look for the next executive in New Mexico, you can bet Democrats on the ground are going to keep that in mind. We want to be safe, secure, happy, and fulfilled in our lives.
Great to speak with both of you, and I thank you for listening through that interview as well to get your reaction to it. That's Jeannie Sheehan-Zaino, Senior Democracy Fellow with the Center for the Study of the Presidency and Congress. John Seaton joined as founder and CEO of Echo Canyon Consulting. He is a Republican strategist on the heels of that interview that I had with Michelle Lujan Grisham, the governor of New Mexico, here in Washington for a couple of days, and just invaluable to get her perspective on the issues of immigration and health care as well, and also the future of the Democratic Party, as we were just discussing. I want to set the table once again here for what's going to unfold here over the next few minutes. My colleague Shonali Vasic of Bloomberg Television getting ready to sit down with Jane Frazier, who's the CEO of Citi. She's at the Milken Global Conference in Beverly Hills, California. We are still waiting for an event at the White House as well. The President of the United States teasing a sporting-related announcement. We'll see if he takes questions afterward, and if he does, and they're wide-ranging, we will bring them to you here live. You can follow that and the goings-on at Milken at Live Go on the Bloomberg Terminal. This is Balance of Power. on Bloomberg Television and Radio.
This is Balance of Power with Joe Matthew and Kaylee Lines on Bloomberg Radio and Television.
This is David Gura in for Joe Matthew and Kaylee Lines here in Washington on a busy afternoon. We're waiting for the President of the United States to speak. A couple of engagements on his agenda for the course of the afternoon. He's teasing a sporting-related one. There are some executive orders in the offing as well. We'll bring you that as soon as it happens, and you can follow it on LiveGo as well. Without question, a huge event in California this week is the Milken Institute's Global Conference, a gathering of some of the biggest names on Wall Street, in banking, in finance, policymakers as well. The Treasury Secretary, Scott Bessent, was there, re-emphasizing the fact that he thinks the U.S. is the preeminent destination for global capital. Given all of that, no surprise that my friend and colleague Sonali Basak is there. She, of course, our lead Wall Street correspondent and the co-anchor of Open Interest on Bloomberg Television. I'm going to toss it to her with the CEO of Citi, Jane Fraser. Sonali?
David, thank you so much for that introduction. Of course, I am sitting by with Jane Fraser. She is the CEO of Citigroup. And a lot has happened, Jane, since we last spoke. So much has happened. And I've got to say, on the ground here, despite all the uncertainty we've seen for the last several weeks, there's a lot of optimism from investors out here. What do you make of that type of forward look? Do you think that there's a lot to hang on to, given that we just heard from the Treasury Secretary and the pitch he's made to investors about the future of the country and investment in it?
Yeah. Thank you so much for having me back again. It's great to be here and to be at Milken. Look, we're in a world where the difference between the hard data and the soft data is the greatest I've ever seen. And it's very hard for all of us to understand, to get our arms around this and what does it mean. And I think we just got to recognize that this will take some time to play out. On the one hand, we've got investors who had quite the round trip in the last few weeks. But when we look at our corporate clients or our consumer clients, sentiment is weaker, but spending is strong with the consumer still. It's holding up. Some of that is the pull forward of spending, the same from corporates ahead of tariffs. But we're keeping a very close eye on what will happen with unemployment. What's going to happen with inflation, obviously? What's going to happen with the actual tariffs? Will they be 10%? Will they be 25%? Will they be more? That uncertainty will get clarified. We will know more. We'll know more about the tax bill. We'll know more about deregulation. But it's going to take some time for the hard and soft data to converge and that we know which scenario we should be acting upon.
Well, to that end, you said earlier today on a panel that a lot of your clients are in this wait-and-see mode. So what is your advice? Bring us into the boardrooms.
Yeah.
What are they waiting to see, and what is your message?
So with clients, there's a couple of things that are going on. One more tactically, which is preparing for headwinds. And remember, we're serving multinational clients and multinational institutions and governments around the world. So they are strengthening balance sheets if they feel the need to take advantage of that. They're pulling forward inventory. They're pausing some of their investment spend, CapEx. There's still activity, but there's definitely the wait and see and preparation. Then you have all the work that is going on where we're having heavy client engagement on how should I be rethinking about my supply chains? What should I be thinking about my hedging and financing? And then on the top level, what does it mean from the strategic advice? So the level of engagement everywhere around the world is absolutely tremendous. It's about scenarios right now. It will turn into action further down the year.
Now, you're the most global of U.S. banks, so you see what's happening on the ground in the Middle East, in Asia, in Europe, in Latin America. What do you think international investors feel about their relationship to the United States today? Are they concerned that our status as a reliable trading partner is going to stick around, given all the change?
There is an immediate reaction to the speed, the pace, the nature of the changes that have been announced. And that causes a certain amount of emotion from people. But when you step back and you look at the economic advantages of America that we felt so positive about in January are still there today. Labor mobility, the breadth and depth of our capital market, never bet against the American entrepreneur. Those still remain strong. What I do hear more from our international clients is they expect a more multipolar world to get accelerated. So they're starting to think through what are some of the other relationships they need to be developing, what are some of the challenges that they're going to be facing. But at the end of the day, a multipolar world is a win-win. It's not a zero-sum game. And I think folk are beginning to understand there are not as many alternatives to the US as the initial thought would be. And the second piece is there's also opportunity and there's a win-win out there.
So one place you're not seeing the win-win in particular, and you said this on your earnings call with investors actually, that your client base is not as affected, but smaller and mid-sized companies could get pummeled, is the word you use in this kind of environment. What kind of risk is there to Main Street if these trade negotiations aren't sorted out faster?
I think it's not just the trade. We want to see the trade, we want to see the tax bill, and what that will be, and then also deregulation, because as Secretary Besson has pointed out, deregulation has really impeded Main Street as well. We've seen it with Basel III. The concern as a large bank was around what does it mean for the consumer? What did it mean for farmers? What did it mean for small businesses? Because they have quite a trickle-down impact of too much regulation. So some of that undoing of things that have been overdone is very important for Main Street because they don't have the same flexibility and diversity of business model that the larger corporates do.
But don't they have nearer term problems like inflation that could be on the heels of a lot of these tariff talks and access to capital being different than those larger firms have?
Yeah, as I talked about, I do think the small businesses and those involved in sectors affected by the price increases, by the tariffs, by supply chain disruption, just because of the magnitude of changes that could be coming, will have an impact on them. And that's I think where some of the disruption and the pain from this will be felt first. And we need to be very mindful of what are we going to do to help support them.
Very specifically also, you were recently in Mexico with Mexico's President Claudia Sheinbaum. How did that meeting go? What's her strategy to deal with the trade negotiations with the United States?
I do think that the Mexican presidency is doing a very, very good job. She's a very smart, thoughtful person. She's looking at stepping back, letting some of the noise die down. We're very clear on what are Mexico's priorities. The U.S. is very important to Mexico. She's very aware of that, but we'll also be looking at are there other places to put a few more eggs so not all the eggs are in the Mexican basket, and strengthening relationships in South America and the like as well.
So, all in all, let's take a big step back to look at the macro environment that's being created in the wake of what's going on. A lot of people have a lot of concerns around inflation and a weakening economy at the same time. Do you agree with President Trump that the Fed should cut interest rates, or do you believe that it would be imprudent to do it at this time when inflation expectations are higher?
It's very hard for the Fed right now because of this disconnect between hard data and soft data, and the hard data holding up while the sentiment data is clearly impacted. And until there is more clarity, it will be hard to know. If it's a 10% tariff, easier to absorb. If it's 25% or higher, then that will have more material ramifications. So getting clarity on the trade deals and agreements that will come through. We'll know more about taxes in the summer. We're starting to see some of the benefits of deregulation occurring. All of this will play in. But right now, the Fed's in a tough spot.
Now, I want to turn to Citigroup specifically. You're in, let's say, the later stages now of a historic turnaround. You had a lot of work on your plate in the first couple of years. Next year is year 5. Now, this year, you have clearly made progress in getting closer to your return on tangible equity target of 10 to 11% by next year. Do you stand firm in that target, or are there risks to achieving it? Or do you believe that it could actually be hit sooner than you initially expected?
No, we stand firm with the target. I am very glad that we have the strategy in place and it's working. The good progress there. The organization we did last year has also played benefits, making us more agile. We have a fantastic management team. I'm really proud of the leaders that we have at the firm. And I'm also glad that that's all in place so that we can be in the front foot and leaning into the different challenges and opportunities that this environment means for our clients. And we can be that port in the storm. Strong capital, strong balance sheet, well reserved. So I am pretty determined as I look to the future that we will play the role that Citi should be and lean into this environment to be there for our clients.
I think when you look across Wall Street, one major concern is that given the deals environment has not played out as anyone has expected, the commitment, not just Citigroup, but many large banks have to keeping all of those bankers on force. How do you feel about this? Do you believe that there's a point this year that you would have to make reductions given what the environment looks like?
I think we have a diversified business model, so that's very helpful. We saw that in the first quarter, real strength across the street in the markets businesses that help counter let's call it a tepid environment in the IPO, some of the leveraged finance market. So that those diversified business models are very helpful. For us, I do feel the environment does play to Citi's strengths. We are everywhere around the world, and all the clients are engaging us on what should they be thinking about doing on their supply chains. We're helping them in India, in Japan, in the Middle East, in Africa, and beginning to think through what changes that they need to be making and getting prepared for that. At the same time, the pipeline in deals is growing. It's been quite active. I'm surprised by how active it has been the last few weeks, but the pipeline has been growing pretty steadily. So clients will be ready to act once there is certainty. We don't know if it's a very bad economic environment, that would be more restructuring. If it's a good economic environment, it will be game on again.
Jane, one more question for you, because next year is year 5 in your tenure, and you could stay CEO for a long time. We know all of your rivals certainly have, but you've also added a lot of significant senior talent around you. How is Citigroup thinking about succession planning at this point in time?
First of all, we're really proud of the bench of talent that we have, both from within the firm and some of the people that we have brought to the firm. And we're a team that is focused on delivering the strategy that we put in place. We see such huge potential, and we can feel the momentum behind us. We can feel the clients wanting us to succeed. And that's what we're focused on right now. And I am looking forward to being CEO for a long time.
Jane, we thank you so much for joining us here on set. We're looking forward to seeing how the year plays out for you. Of course, that is Jane Fraser, the CEO of Citigroup. David, back to you.
Shonali, thank you very much. Very newsy interview there as the CEO spoke about this movement toward a multipolar world in her recent trip to Mexico, talked about the challenges facing the bank as well. Let's check in here on this Monday afternoon with Amy Morris for Bloomberg Business Flash. Amy?
All right, thank you, David. The air traffic controllers at Newark Liberty International Airport lost radar and radio communication for more than a minute on April 28th. That caused flight delays and cancellations. The incident was caused by a tech failure at the FAA operation in Philly, which guides flights into and out of Newark. It's experienced multiple failures. The FAA is facing a staffing crunch and aging infrastructure. Rite Aid intends to file bankruptcy less than a year after completing an earlier restructuring. A Chapter 11 filing would mark Rite Aid's second bankruptcy in less than 3 years, following its first filing in October of 2023. The S&P 500 halted its longest advance in about 20 years after President Trump's latest tariff remarks, despite data that show a pickup in growth at U.S. service providers. The Institute for Supply Management reports its Service Industries Index rebounded in April, led by orders, but a measure of inflation tied to the report hit a more than 2-year high as the U.S. imposed tariffs. And we do check markets for you all day long here at Bloomberg. The S&P 500 is down 0.2%. NASDAQ down about 0.25%. The Dow is about 0.25% higher. 10-year Treasury yield at 4.36%. The 2-year yield at 3.84%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Let's go back to Balance of Power with David Gura.
Amy, thank you very much for that update. As you can see on your screen there, the President of the United States is at a lectern in the Oval Office alongside Roger Goodell, the Commissioner of the National Football League, and the Mayor of this city of Washington, D.C., Muriel Bowser, and they're confirming news first reported by Axios this morning that the 2027 NFL draft is going to take place in Washington, D.C. It's going to take place on the National Mall, and the president now expounding on any number of other issues, talking about a post he put on Truth Social earlier today, indicating that the film industry needs to be protected because of a national security threat. He says he wants to put 100% tariff on foreign productions. More detail on that as he continues to speak. You can follow that on Live Go on the Bloomberg terminal. The president saying the film industry has abandoned, his words, the U.S. I'm David Gura, filling in for Joe Matthew and Kaylee Lyons on this Monday afternoon. Our coverage continues here on Bloomberg Television and Bloomberg Radio at Bloomberg.com and on the terminal.
multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg.
We're micro investors. So as micro investors looking to invest capital, whether it's in private equity or in direct lending, what we're looking for are opportunities to deploy capital at attractive risk return. When we wake up in the morning, we don't seek to avoid risk. We seek to price it correctly. And so in an environment like this, for sure, if you're looking at a portfolio company opportunity, when you think of the value creation plan, you're factoring in now the uncertainty, which undoubtedly will impact the extent to which you're willing to pay for that asset. Now, in our existing companies, in our existing portfolio, the vast majority are services company. And services companies don't have basically the input issues. But I will say that when we look and we roll up all this data for all of our portfolio companies, and it's quite rich. It's just down now below 1 million employees globally around the world. We're 2,300 at Carlyle itself. But in our portfolio companies, we roll up this data every month. For example, the inventory component of PMI was up about 4 points. I know that's not really news that anybody probably would have focused on, but we could see that happening months ago. So immediately when it looked like the new administration was going to come in and there was the possibility of tariffs, you could see purchasing managers immediately mobilizing to start bringing goods in faster because of the uncertainty factor.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lyons deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Our special coverage here at Bloomberg continues from the 28th Annual Milken Institute Global Conference. in beautiful Beverly Hills, California. I'm Romaine Bostic. Carol Massar will be joining me in just a bit. A mashup, once again, of two of your favorite programs, The Close and Bloomberg Business Week. We've got a lot to cover today with the biggest names in finance walking around the Beverly Hilton today. Over the next 3 hours, we're going to cover everything from private markets to public markets to venture capital and everything in between. Dana Settle, Graycroft co-founder and managing partner, will be here to talk about the future of AI and specifically where the investments are in the VC space. We're also going to get a read of what's going on in Washington from the director of the U.S. Congressional Budget Office, Philip Swagel. He'll discuss that latest skinny budget out of the president and, well, that huge debt servicing load that investors are wringing their hands about. And Andy Sullivan, the newly appointed CEO of Prudential Financial, he'll be joining us in just a little bit here on the program. A lot to talk about here as we get the intersection of the economy, of what's going on in Washington, and of course, what's going on in financial markets. Financial markets that in many ways have now blended together. A lot of people have mused that private markets to a certain extent have actually become the new public markets, and while that might be overstating it just a bit, the Venn diagram definitely shows a degree of increasing overlap. So who better to kick things off today than with Man Group, the world's largest listed hedge fund company with about $170 billion in assets spanning both public and private markets, a mix of long-only and alternative approaches across all major asset classes. And now that I've pumped you up, pleased to say that the person at the center of all that joins us right now, Robin Grew, who helps lead the Man Group. Great to see you here on the Milken stage in LA.
Thanks for having me.
Volatility in this market. If you're a broker dealer, probably good for you. If you're a hedge fund manager, not so much.
Well, listen, volatility is a place where we need to lean in to do more. We are in volatile markets. We're not going back to a benign market environment. And so in that space, we have to be prepared to create diversified content and capability that's able to navigate these markets to provide outsized returns or alpha returns to our investors.
How do you do that, though? Because when you look at the strategies that Man Group has, a lot of systematic strategies, a lot of trend-following strategies that we've seen over the last few weeks and months does not necessarily perform optimally when there is so much misdirection going on in the market.
Totally, and they're not supposed to. I think that's the thing that we need to be mindful of. In a diversified portfolio, you're going to have assets and capabilities and strategies that do perform, and we've seen that in credit, both public and private. We've seen it in great active equity management. We've seen it in multi-strat, but you don't see it in trend because that whipsawing, whiplashing behavior doesn't work for it. But that's why when clients are talking to us about how do they position their portfolios, they're looking at the things that will operate in markets as we're seeing today, and they're also thinking about defensive alpha. And what we do know, and what we've had history around, is that when you have decades of experience in momentum and trend strategies, they operate well when this volatility slows down, and then you can find the trends again.
Do you expect that volatility to slow down anytime soon?
I think that volatility is going to be here for some time. It's whether the volatility is accompanied by whiplash behavior. And that's what the markets are looking for. We're looking for that consistency, something that is predictable and capable of being predicted. But there's no doubt that the opportunity set across markets, across jurisdictions, are really interesting right now. 100 days ago, you might not have thought about Europe as a growth opportunity. Today, we sit here talking about that. We're looking at Asia with a very different set of lenses. We're seeing real opportunities for active and alternative investments. And it's about staying calm through this time as well. But volatility, will it be here for some time? I think so. Dispersion? Yep, I think so. But whiplash? Let's hope not forever.
I don't know if you got a chance to hear what Scott Besson had to say a little bit earlier at one of the Milken panels here. But there was a really interesting moment in that where he really turned to the audience and looked straight at them and said, we're trying to make everything more appealing for you, meaning for the investors out there that are in this room. Do you find any comfort in hearing those words out of Scott Besson?
Absolutely. You know, we want this biggest, deepest capital market to function really, really well. We just also are put to work by our clients to go and seek out alpha wherever that may be, that outperformance across all markets. That's why we trade 800 plus markets in the world. That's our job to do that. And we do that for real individuals who have saved all their lives, who have put into their pension pots, be it their 401ks or their IRAs or the equivalents elsewhere in the world. But yes, I think it's a tremendous statement that we have Scott Bessent talking to us about actually being supportive of markets. I think that's a great thing.
Is that too little too late? This is a room full of people from around the world. And you know there's been a reallocation of capital, or at least a rethink of whether to reallocate capital away from the U.S. to Europe, for example, or even to other parts of the world.
Too little, too late? I don't think so. I think we all look to the quality of the US as an investable space. And again, it's the opportunity set that's out there. Is it a bad thing that there's competition? Is this a bad thing that there's growth in Europe or an opportunity set in Asia that's opening up? I don't think so. In the same way as I don't think it's a bad thing that we're seeing the opportunities in private credit open up. So I think there's plenty for us to keep our very detailed focus on. But no, I don't think it's too little too late.
How do you keep your team, the folks who work under you, not just motivated, but to get them to understand what the long-term goal is in an environment where we are so focused on these minute-by-minute, short-term disruptions?
It's a great question. I think the reality is you have to have confidence in the strategies you're running. And you have to know that those strategies are performing the way they should do in the market environments you're in. So you keep that focus. At Man Group, if we have strategies that aren't working in a period of time, I don't have to go onto the floor and make people feel more unhappy. They're doing that themselves. So for what we do, it's about being sure that we're doing the best we can do. We continue to be at the cutting edge, entrepreneurially, of content and product and capability, that we deliver that to our clients, that we deliver more than just funds or products even to clients, that we're delivering the decades of experience we have in AI or technology, or we're delivering the nearly 20 years of experience we have in our partnership with the Oxford Mann Institute at Oxford University. It's about keeping people focused on the day job. It's about staying calm.
You mentioned AI, and of course, Man Group is probably one of the early adopters, at least in the finance space, of AI. And I think we spoke about this at Bloomberg Invest a few months ago. Does that become more critical in times like this, having those types of capabilities, or is it potentially a liability? Because you're effectively talking about, I don't know, something that's, I don't want to say it's predetermined, but certainly there's a roadmap that's put out when it comes to these models.
Listen, I think AI is a tool. We talked about it before. It is a great capability. When I think about generative AI, when I think about AI agents, it's about deploying those. It means we can be better, faster, smarter. It doesn't replace the human being, and it doesn't mean that you need to ignore the risks that are incumbent in these capabilities too. But I think that tech is part and parcel of what the future looks like. Undoubtedly. AI part of that? Undoubtedly. You don't have to look very far in this conference or the meetings we had with Elon Musk yesterday to see just the power and the capability of these future technologies.
And you think the investment in that writ large, not just at Man Group, investment in that AI tech, that hasn't been disrupted at all? There hasn't been a rethink on that longer term investment opportunity?
Not for us. We continue to think that AI, and we continue to think that this is both being consumed within Man Group and within the work that we do, but the broader reach out into other industries and other spaces is going to be, I think, transformational.
You've been on the job for a while now, so you're not new, you're more of a veteran now. And you're a veteran at a time where this has to be one of the more challenging times to be a corporate leader, certainly of a financial company. And I am curious as to what you want to do to grow Man Group, knowing that the world order that you came into, if not over, is certainly being reshaped.
I think listen, it's a privilege to sit in the seats we do, and I've been talking to clients non-stop really for the last 100 days or so, and that privilege is something we shouldn't forget. Mm-hmm. You get a front row seat into what's happening in the world doing the jobs we do, and so my job, How has it changed in the last 100 days? It hasn't really. It's still about doing the right thing by clients. It's still about sticking to the strategy we have. It's still about creating diversified, orthogonal, uncorrelated content so our clients can benefit and can return value to their underlying savers and pensions.
All right, Robin, well, we'll let you get to it. I know you got a busy couple of days here at Milken. It's Robin Grew, the CEO of the Man Group, live at the Milken stage right here in the lobby of the Beverly Hilton, the 28th annual Milken Global Conference. And it is already off to a great start. You heard Robin, guys, talk a little bit about that panel that Elon Musk did yesterday. That was on Sunday. Probably one of the most attended panels, probably only second to Scott Bessent this morning. These are the people everybody wants to hear from. They want to hear about the folks dominating in the AI space. They want to hear about the folks in Washington making those big investment decisions. And those folks, we're all going to be walking across the stage a little bit later today. Romain Bostic here. Carol Massar will be joining me in just a bit as we continue our coverage here from the Milken Global stage. Let's get a quick check of what's going on in financial markets here on this Monday afternoon. Financial markets that continue to look for a degree of direction coming off what had been a phenomenal 9-day rally in the S&P 500, the benchmark U.S. index, reclawing all of those losses from that big shock back at the beginning of April, that Liberation Day announcement when it comes to trade and tariffs. And that has really been all of the talk over the last few hours here this morning, whether it's what we heard out of Scott Bessent, whether what we heard out of Carlyle CEO Harvey Schwartz, or what we heard out of Prudential's Andy Sullivan a little bit earlier on the Milken stage. The idea that all of them are focused not just on what's coming out of Washington, but of course technology as well. The investments in that technology, whether it's for their own personal benefit or, of course, the benefit of their investors. And that is where we want to take the show next year and talk a little bit more about that global race for artificial intelligence dominance. Artificial intelligence dominance that has been compared to some degree to the Manhattan Project. And as China, of course, makes strides out there, the U.S. is really trying to seek ways to accelerate its progress with new initiatives to boost education, to boost workforce training, and to boost investment in AI and related technology fields. The President of the United States signing an executive order on that just a few days ago. And the point person behind implementing those initiatives is Michael Kratsius. He's the new director of the White House Office of Science and Technology Policy. And prior to that, prior to joining the government, Kratsios was a principal at Teal Capital and ran strategy for startup Scale AI. Great to see you, Michael.
Great to be here.
I think everybody wants to talk to you. You are, to a certain extent, at least for the folks in this room, the man driving a lot of potential investment opportunities. And what everybody wants to know, is the U.S. going to maintain its lead when it comes to being a technological leader?
Yes, it's something that the president is very focused on and something we as administration are committed to ensuring, as the president says, unquestioned and unchallenged global technological dominance. And that's going to require a lot of work from us, from R&D to dereg to adoption. So there's a ton we're working on. And as you just mentioned, the president signed an executive order just a couple weeks ago to make sure that our K-12 education system is geared to prepare our students for this AI future.
What's the runway for that? Because there's been a lot of talk about how much brain power, if you will, already exists, meaning so for the adults out there, and how many people we need to sort of train up, meaning the next generation of folks, to ensure that we have enough skilled people to take this forward.
Yeah, so I think the president realized that it's critically important that we prepare the next generation of Americans to wield and utilize these tools. So we began with this executive order on artificial intelligence in K-12, and essentially it's doing three things. I think the first thing and the most important thing is bringing together public-private partnerships to support AI education. It's something that we cannot do alone. We have great industry partners that care about helping here. We have great folks in philanthropy, great folks in government, and the K-12 system itself. So that's what the first thing the executive order does. The second, which is really exciting, is a presidential AI challenge. So we want to create in a sense, an Intel Science Fair or like a DOE Science Bowl, or premier competition for AI that was going to ultimately end up in a event at the White House next year.
Yeah.
And lastly, you said we have to train Americans, reskill them, and retrain them with the AI tools that they need to succeed in this economy. And we're working very closely with the Department of Labor to make that happen.
And just to be clear, so the president understands that and understands the importance of a government role in facilitating this, because when a lot of people talk about our leadership in the United States from a technological standpoint, they point back to a lot of those post-World War II programs that came out of the Defense Department and DARPA and other sort of government research facilities that fed into university research facilities and ultimately into the private sector. Is that the playbook?
Yeah, so what's very unique about the American innovation ecosystem is it's really three parts. It's one part academia, one part private sector, and one part government. And all of them kind of pass the torch from one another to drive innovation. So the federal government often funds early stage, basic, pre-competitive research. Universities make fundamental breakthroughs or discoveries. Those are ultimately taken up by the private sector and commercialized, and the government steps in to help create a regulatory environment for those new technologies to succeed and thrive. So we're going to continue to work on that effort and make sure that we have the best functioning innovation ecosystem in the world.
What needs to be changed when it comes to the regulatory environment? You've been on the record in the past saying that you thought that things were, there were too many barriers, if you will. What's on the agenda right now that this administration wants to do to lower or at least smooth out those regulations?
We really have to find and identify barriers which are inhibiting the proliferation of emerging technologies. We want to be flying supersonic again. We want commercial drone deliveries to be happening in the United States. We want self-driving vehicles on the road. We want AI-powered medical diagnostics. All of these things have been slowed down or hampered by a regulatory process which may be good intention, but it's just too slow. And we need to continue to lead the world on this, and doing this deregulation is a big piece of the Trump agenda.
Do you see us primarily in competition with China on that front?
Look, I mean, we're in competition with so many people around the world. Everyone wants to be a leader here, and obviously the PRC has made it very clear that they want to lead the world by 2030. The U.S. is in a very lucky position where we are the world leaders, so we need to continue to make sure we have an environment where we can maintain that leadership.
And university is going to be a critical part of that. Are they not? There's been a lot of discussions about the president's attacks on certain universities, about some of the brain drain that maybe we might see as a result of that. How do you reconcile that?
The most important thing about federally funded R&D we have to think about is it's not about spending a lot of money. If you spend a lot of money on the wrong things, it's worse than spending a little money on the right things. So we're making sure that the biggest priorities for the nation, things like leading in artificial intelligence, leading in quantum information science, that we continue to fund those areas and make sure that our universities are a big part of that agenda.
Tariffs. I have to ask you about tariffs. Your president has made it clear he's tariff man. They're here. They're coming. Does that have an impact, though, on what you're trying to do? Do you have to factor in maybe the extra costs to whether bring things in or reshore things?
What we're seeing is some of the greatest technology companies in America and around the world are coming and they're investing in the United States. As Secretary Besson said this morning, more investments coming to the United States in the last 100 days than it has in the 4 years under President Biden. So what we're doing is actually bringing these new technologies here in the U.S. You saw the TSMC announcements. It's happening in Arizona, where we're going to be building leading-edge fabs here in the United States, and so many more great investments. So I think we're in a pathway to really make sure that we have the tools that we need to keep driving this AI leadership position.
When you think about investments in the United States, can that be purely bilateral, meaning we come from this sort of multilateral world when it comes to trade and investment opportunities, and the president's clearly pushing us to much more of a bilateral type of deals. Do you think that can facilitate the same pace of innovation that we saw back in the 60s, 70s, and 80s?
I really do, and I think the proof is in the companies that have already made big announcements about coming here in the United States, and there's a lot more of it are probably going to be announced in the weeks ahead. So we've seen an environment where everyone wants to invest and work here in the United States, and predominantly in these cutting-edge emerging technologies that we're focused on. So I think the future is very bright, and we have an economic environment which is really going to be fostering breakthroughs here in America.
All right, Michael, really appreciate you being here. Obviously a busy guy. Michael Kratsios is the White House Office of Science and Technology Policy Director. Toss it back to you in New York, Bonnie.
Fantastic stuff, Romaine. I just want to update you on market action now. We are improving as we go out this session. We right now have the Dow Jones Industrial Average actually in the green, up by about 0.3%. The S&P, though, still down about 0.1%. The Nasdaq 100 down a little fraction more than that, just about 20,073 right now. So about half stocks higher, half the stocks are lower, and in the SOX index, you're looking at about 12 stocks that are still higher. But it's a very unsure session. We have the curve steepening a little bit as well, with the 10-year yield up more than 5 basis points at 4.36, and we have the 2-year yield up 2 basis points. So a little money flowing out of treasuries, flowing out of crude oil as well, down another $1 now at 57.27 after OPEC Plus decided on upping production levels at an emergency, basically, weekend meeting, or a meeting that was brought forward. Gold also continuing to rise now again at 33.18. That's up 2.4%, Romaine.
All right, thanks, Bonnie. And meanwhile, back here in Beverly Hills at the Hilton, the site of the Milken Global Institute Conference, pleased to say joining us right now is Kristen Roth to Clark to talk a little bit here about what's going on in M&A. Kristen, great to see you.
Nice to see you too.
We talk about this idea of, I think, some bullishness coming into 2025. And I know over the last few days, 100 days, if you will, maybe that got disrupted. Do you see hope that some of the most bullish outlooks that we saw for M&A coming into 2025 will still come to fruition?
I do. We have seen a return of mega cap M&A in tech. While the number of deals are down about 20% year to date, year over year, the volume is up 40%. And so we've seen multiple deals over $20 billion, multiple deals over $10 billion, driven by strategics, driven by divestitures. Private equity is playing a major part of that.
What pocket, though, of tech is that? Is that all just sort of weighted to AI, or is it a little bit more diversified?
It's been a lot in security, in payments, fraud, and some semis, as long as it's not they have risks around competition and regulatory. Those are the main sectors, and then obviously AI as well.
There's been a lot of talk, particularly when it comes to privately held companies, the path to an IPO or some type of exit to public markets. With regards to technology companies, do they have an advantage in this environment where people are so much more scrutinous of what they're willing to buy or what they're willing to bring to market? Is AI and technology, cybersecurity, do those things have an advantage over other sectors?
In terms of the IPO market, we still need to see some stability in the broader volatility in the VIX and in some of the messaging coming out around tariffs. I think just broader stability will help give us an opportunity to take some of these companies public. I would say what we are seeing more activity on is take privates. So some of the companies that went public in 2020 and 2021 in particular are pretty nice targets for a number of the private equity firms. And we're seeing reasonable valuations in some of these deals for really high-quality assets.
Where's that money coming from? Is that cash, or are they having to finance that?
Both, but primarily financing. And the financing environment still continues to be pretty strong, both on the broadly syndicated side and also from private credit.
Mm-hmm. Are you concerned about where interest rates are now and where they might potentially go?
I think, if anything, it just creates some volatility in the market, which makes it harder to do as many, deals. But I think that, especially on the IPO side, but less. I think it's day by day at this point.
In your world, though, when we see this volatility, does that create sort of stasis, or is it more just maybe a bit of a retrenchment, let's rethink, and then the activity increases?
Yeah, well, actually, we saw the market kind of trade off for some of the companies in tech that are more likely to be impacted by tariffs, like the semiconductor stocks, for example, in April, come off 20-25%, and those have mostly rebounded now down kind of 2 to 5%. So I think it does create some opportunity. It also creates opportunity for take privates from private equity. If we do have blips for people to focus more on that. And we're active. We're third in M&A league tables year to date on announced volume.
Yeah.
And so this is where we're spending a ton of time.
What is that ecosystem like right now? Because when I look at these deals now, you still have the big institutional players still involved, but you'll also have private credit. You'll maybe even have private equity involved in there, and then you sprinkle in a little bit else from the investment world. Is that kind of the, I don't want to say a template, but is that kind of the norm now, that you have to have all of these players involved to get a deal done?
I don't think you have to have all of those players involved. I think the reality is there are options, and you can have a little bit of financing from the banks, and then also couple that with private credit. And I do believe we'll continue to see that persist.
What's the outlook for cross-border deals, given the political environment here in the U.S.? Are there opportunities there?
There are opportunities, but they're on the sidelines right now, waiting for some more clarity around some of these geopolitical issues and tariffs. But there's great opportunities from a synergy standpoint, and it just all hinges on the ability to do them from regulatory.
And the regulatory environment, is that supportive of those types of strategic and synergistic transactions?
Not currently, as much as, that is a huge opportunity once we have a little bit more certainty, but it is not where we're seeing a bulk of the volume currently.
I'm curious, Kristen, just about the environment here in this room. And there's a lot of optimism. I've only been here for a day and a half, but there's a lot of optimism, which is a kind of a switch from what we saw last year and certainly the year before. Are you seeing that as well?
Well, Q1 was a great quarter, right? So that was helpful. I think the question and what we're spending most of the time with our clients is, what does it mean for the rest of the year? Some of our companies are diversifying supply chains or moving their supply chains, and actually, in some cases, consolidating vendors for a short period of time to expand in areas that may have an easier tariff policy going forward. So we're spending time with companies on that. We're spending time with companies on what is the outlook for enterprise software and our sales cycles elongating at all. We haven't seen that yet. So we're seeing still pretty positive consumer sentiment, enterprise sentiment, and the ability to pivot for some of the companies that are impacted by tariffs or could be impacted by tariffs.
All right, Kristen, I think we have to leave it there. Kristen Roth-Clark, great to see you here.
Great to see you too.
Over at Barclays, who of course runs the global head of tech investment banking at Barclays. A lot more coverage coming up right here on the Milken stage from the Beverly Hilton. A discussion on the current geopolitical climate as the trade wars heat up. John Clifton, the CEO of Gallup, is going to be joining the big program in just a second. And so too, I'm told, is Carol Massar. We got her out of bed. She'll be on stage with me in just a bit. Don't go anywhere. Our special coverage from the Milken Global Investment Conference continues in just a moment.
All right, let's cut right to it. This is Bloomberg's new show, Primer. Technology is $1 trillion game. Won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused on how can you elicit intelligence from brain cells in a dish.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on?
So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
In case you missed it on the opening trade.
How big a headwind is that going to be to my performance over the next 6 months, next 12 months? That dollar story, that dollar factor, that FX overlay.
Yeah, I don't think you can overstate the importance of this dollar shift. As we start to see a convergence of relative economic and profit growth rates, you are starting to see some of that overvaluation unwind, and it's shifting portfolio flows as well.
Don't miss the opening trade live every weekday.
You have had a number of games overseas in recent years, and in fact, you opened the season going to the opening game in Brazil. So do you expect to do more overseas games, and is that a part of your strategy?
It is. We had 5 last year. We expect to have 8 this year, which will be the highest we've ever had.
Our hope would be at some stage to get to 16 games in the next few years. We think we could do that. I think it's an indication of the popularity of our game. Every time we take our game to a new market, Brazil's a great example of it, the fans go crazy for it. They sold out the tickets in less than 90 minutes. People had a wonderful time. It was the talk of the town. And I think it will be the basis and the sort of the match that lights the excitement and the popularity of the game in that market, as well as what we're doing around the world. So we're very excited by it. It's just one element of that strategy. You need to have television. You need to have activity and participation in the sport, and flag football is a big part of that. So all of those factors, I think, are going to be what we think will be a very successful formula to be a global sport. Do you ever envision having a team that's based overseas in Mexico City or in London? Listen, we've talked an awful lot about it, and I think there are markets that could, without question, support an NFL franchise.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Your line, Carol Massar.
Hello.
Hello.
I decided to show up. It's been super busy, as you know.
Let's restart the show from the top, because Carol missed it here. We are live right here at the Milken Global Investment Conference. You're familiar with this, Carol, right here in the lobby of the Beverly Hills.
The energy is unbelievable. I am Carol Massar along with Romaine Bostic, and there's a lot going on. We're going to have 3 great conversations. And first of all, we want to start with a little bit about some of what America and how they feel about different things. So let me lay it out for you. 3 months into President Trump's second term, more Americans attribute current U.S. economic conditions to him rather than his predecessor, Joe Biden, while a considerable portion think responsibility is still shared between the two. Meantime, one more stat I want to throw out at you. Americans are widely skeptical about the benefits of the recent tariffs that the Trump administration has imposed on the United States trading partners, with majorities believing they will ultimately cost the U.S. more money than they generate in the short term as well as the long run. So joining us to talk about this, because this is their data, we're talking about the Gallup organization. We want to get into a lot about geopolitics, impact to markets, and really the workforce as well. Is the CEO of the global analytics and advisory firm Gallup. We're talking about John Clifton. He's also the author of Blind Spot, The Global Rise of Unhappiness and How Leaders Missed It, which I love because I think it plays into so much that is going on. John, how are you?
I'm great. Thank you for having me here today.
Well, tell us about the environment, because you guys are constantly getting checks on how Americans feel about a lot of important issues. How would you describe some of the data flow that's been coming in?
Yeah, well, I think what you opened with is there are a lot of Americans right now that are concerned about things like increases in tariffs. And there is one thing for sure, they're really concerned about the economy. And so we've even looked over the past 6 months, there's been a reversal among Americans in terms of where they think things are going with the stock market, with the economy, a lot of those indicators. But I think one of the things that's most important to watch for all politicians is how people feel about their own lives. And that's been a real challenge for many years now that we've been looking at in our data.
You know, it's really interesting. Before U.S. Treasury Secretary Bessent spoke this morning, I can't remember whether it was Michael Milken or somebody else, but basically talked about people are so angry. They're not happy. And I think a lot of it has to be that they feel left out of the economy or any success. That sounds like this is a part of it.
100%. Now, it also turns on what's the definition of happiness, because we measure a number of those different sentiments. But one that's really concerning is when we ask people about the satisfaction with their lives, the percent that say that they are very satisfied has been declining for many years now. And so I think this sort of pent-up frustration that now we see that's being expressed against, you know, almost every single institution in the United States comes with good reason, because people don't feel like their lives are progressing in the right direction.
Well, it's interesting you say that, because a lot of people say that some recent elections, not only here in the U.S., but globally, have been decided to a certain extent off of that sentiment. But you guys also have put out a State of the Workplace report, which kind of addresses this idea of lower worker engagement, lower productivity, and I wonder if that's connected to that as well.
Well, before we get to that, because your point about how does this track with elections, I mean, we've all heard the famous quote that comes from James Carville originally when he says, well, it's the economy, stupid. I would adjust it just a little bit. It's how people's lives are going, stupid. And so I think it's one of the reasons that a lot of times politicians aren't necessarily tracking to see how do people feel about their own lives and what are the drivers of that.
Well, you brought that up. So I covered the campaign, the most recent presidential campaign. One of the candidates, who was not Donald Trump, so you can do process of elimination, was criticized pretty heavily for not necessarily understanding what people were going through. She had great proposals, she was talking to these people, but there was this perception that she, and not just her, other politicians, did not really have a fundamental understanding. How do they get that understanding when a lot of them don't live those lives that those people live?
Well, one is to ask people and listen.
Yeah.
And so one of the things that we ask every single year, and actually we do it very regularly, is what is the single biggest issue that's facing Americans today, that's facing the country? And the two issues that Americans were most concerned about in the lead up to the election was illegal immigration and, of course, inflation / the economy. Now, here's what's most interesting. And of course, when we wrote about this, we kind of buried it halfway through. Maybe that's natural Gallup style. But that item, when you ask people what's the biggest issue and what actual party do you think is best at resolving it, it has never been wrong except for one time in predicting the outcome of the elections. So to your point, being in touch with what it is that's concerning Americans is something that actually is a leading indicator for how the election will turn out.
How do we figure that out? Especially since I think many would argue there's so much money in politics that mostly our leaders, all they care about is getting reelected. And so are they really listening to their constituents, or are they just thinking about what gets them back in office?
Well, when you said, how do we figure that out? I mean, one of the things, as I mentioned earlier, is to ask them. Now, again, George Gallup, I think this is something really profound that came from him. He one time said, look, when we're doing surveys, what we're suggesting is not do what the polls say. What we're suggesting is you need to know what people are thinking, because leadership is also about doing what's right. And it's not necessarily doing what's most popular. But again, no matter what it is that you're doing, you must be in touch with whatever the sentiment is among Americans or whatever your electorate is.
John, it seems so basic. And I also want to bring in that I think we went through an election where the polls were wrong. So are we polling? Like, how do we make sure we poll correctly? I mean, we all laugh about it. It's maybe not funny, but I don't know that I've ever been polled. I don't know if you've ever been polled.
No, I hang up on those people.
No surprise. No surprise. But I do wonder, how do we make sure we're doing it correctly in terms of the methodology?
It's very difficult. But, you know, George Gallup was actually asked this question once, and a woman stood up and asked and said, you know, if you call so many people, why is it that I've never been called? And he said back to her, well, actually, the statistical chance of you being called is the same as you being struck by lightning. And she said back to him, well, that's funny because I have been struck by lightning. But the point is that, you know, when you're doing probability-based sampling, and we have 330 million Americans in this particular country, and, you know, just roughly 2/3 of them are adults, the statistical chances of being selected are very rare. But it doesn't change the fact that as long as you're using probability-based sampling, you will get a representative sample of Americans.
I'm curious, though. I mean, obviously a lot of your polling, at least the polling most people know about, is the stuff that you do with regular Joes, if you will, Joes and Jills. What about in the corporate world and business leaders and how they're feeling right now?
So we do a study in 140 countries every single year to ask people about their well-being at life. We ask them about their engagement at work. And we're uncovering really concerning trends where we see that there is a 2-point decline globally in people who have this emotional attachment to work. And here in the United States, we saw for a while, over a decade, there was a 6-point increase in engagement. But most recently, all of those gains have been eviscerated. And so why should this concern executives? Because when people don't have that same kind of emotional attachment or energy at work, what does it do? It changes productivity. It also changes the work product. And so we can see that that 2-point decline globally has wiped off $500 billion off organizations' balance sheets in lost productivity. In fact, if you fully optimized workplaces based on this concept of employee engagement, you would actually see a $9 trillion increase in the world's GDP.
It's super interesting. Just coming off a real estate panel on the importance of community, and I think that's also true in the workplace, that people need to feel like they're engaged. John Clifton, thank you so much. Really appreciate it.
Thank you for having me.
Of Gallup. All right, folks, let's send it back to our New York studios and Bonnie Quinn for a quick check on the trade.
Carol, thank you so much. Well, we are green in the Dow Jones Industrial Average. We have been for most of the day and improving for the other major averages. So if you look at the S&P 500 right now, we are just down fractionally, less than 0.1%. We may even make it into the green by the close. The Dow, again, up 0.25%. This after we got some services data this morning, which showed a pickup in services growth at services providers, and that's helping some stocks higher, including EQT, which is the best performer in the Dow, also the likes of Ralph Lauren. If you look at the NASDAQ 100 and the NASDAQ, they're both lower as we await any more news on trade deals, but again, fractionally lower. We started the day much worse off than we are now. Some of the outlying movers you see in things like crude oil, for example, WTI crude, down now to $57.11 a barrel after the OPEC Plus news over the weekend. We also have the dollar much weaker against the Japanese yen, the yen trading at 144.12 per dollar. And then some of the other assets that we like to keep an eye on, gold, for example, it's at 33.20 now, up about 2.5%. So sentiment a little bit all over the place. Now let's get back to the Milken Institute Global Conference and Carolyn Romaine. Carol.
All right, Bonnie, thank you so much. Well, Perplexity, it's a company that's been getting so much attention, some good, some not so good in the past year.
I use it, by the way.
You do?
I do, yeah.
Then it must be interesting and good. All right, so the company was started, just a little bit of background, by a scientist at OpenAI, a quant trader, a co-founder of Databricks, and also a Facebook AI researcher. That was back in 2022. They built the platform as an AI-powered search tool designed to compete with Google. Now, the startup, I should point out, attracted a lot of early investments from NVIDIA, also a Meta chief scientist, AI scientist. And then in March, Bloomberg included the company and its founders in a story on the new, basically, AI boom billionaire. So we're delighted to have with us Dmitry Shevelenko. He is the Chief Business Officer of Perplexity, the AI-powered search engine and startup. How are you?
I'm doing great. Thanks so much for having us, and thank you for being a user of Perplexity. We hope it saved you a lot of time and let you ask some really fun questions.
It has. I'm still going to ask you tough questions.
Okay, all right. Well, I'll use Perplexity to answer it, so we're good.
How many people are using it?
So every day we answer around 25 million questions. So it is incredible just to think about all the impact, and that's growing, you know, every week, every quarter, and that's our simple goal: answer more questions tomorrow than we did today, and have that go on forever.
Wait, so say the number again. How much?
25 million questions a day.
Okay, what's the pace of growth?
Yeah, we don't disclose it publicly, but we're very excited with the growth.
And do you hold on to people like Romaine once you get them?
We see, actually, compared to other generative AI products, industry-leading retention. You know, Perplexity, it engenders a very loyal use. It is for people that value their time, that want to get the best answer, that want answers grounded in high-quality sources. And so,
just plain to you, you know that. Just plain to Romaine.
Well, how do you, though, ensure that? I mean, we've gotten to this point where, you know, sort of the first phase of wherever this is going has already occurred. What's next? It's not just about collecting more data, is it?
I think we want to turn these really useful tools into the best executive personal assistant you've ever had. And so a big part of where Perplexity is going is becoming more personalized, linking up to the other services you use. So we don't only answer your questions, we anticipate the questions you're going to have, the problems you're going to have, and solve them for you. In some ways, we want to be answering fewer questions in the future because we want to solve the problem before you even need to ask us to do it.
So this gets to a point where we talk about what AI becomes, at least the consumer-facing part of it, whether it becomes search, whether it becomes something deeper to that. I bring that up because this is at the core of that antitrust case with Google. You testified in that case, and there was a lot of discussion from you as well as other folks in this industry that there was a roadblock put up by Google when they saw Perplexities and others coming down the pike. Do you think that threat is going to be removed as a result of this case?
I think consumers benefit from choice, and particularly when it comes to the Android ecosystem and our mobile phones, Google has abused their monopoly and restricted consumer choice. We know that when people get access to Perplexity's Assistant on Android devices, they prefer it to the Gemini and Google Assistant. And that's not, we want to compete with Google on the merits of who builds the best product for the users, not who already has the locked-in distribution. And I think just the fact that this case has been brought has already opened up the ecosystem. We're able to work with OEMs like Motorola. We announced a partnership with them. That would not have been possible if Google were already not under a lot of pressure. But ultimately, we're advocating for choice for consumers.
So does the outcome of this case matter that much to you? If you're getting business as a result of this antitrust case, if the remedy is just, spin off the Chrome browser or something of that nature, does that actually help you in any way?
The reality is the industry we're in is accelerating at such a fast pace and moving at such a pace that we can't wait for these remedies, right? We need to, it's helpful because it's putting pressure on Google. It's making carriers and OEMs feel like there's less retaliatory risk to partnering with a company like Perplexity. Right. But our plan does not assume something's going to happen with this case.
Are you a search engine? Do you consider that? Because that's been the crux of this case, defining what Google really is, defining what Perplexity really is.
We are an answer machine, which you could consider a type of search engine. We think it's a lot better than a search engine because we take it a step further and we save you even more time. But we're definitely competing against Google. That is without a doubt.
So you're competing. I think it was The Verge who kind of said, well, based on your testimony, that you would maybe be interested in buying Chrome. Is that real? Is that valid?
I think it is really important that Chromium, which is the open source part of Chrome, continues to have a good steward because all the other browser competitors are based on Chromium too. And so a really bad scenario is that Google sells Chrome to a company that does not support Chromium, and then you have even less choice in the market.
Because you're building a browser based on Chromium?
On Chromium,
okay.
Yeah. So we selfishly want Chromium to exist, but Edge, other browsers are also Chromium based, and so it is important that that the core technology persists.
So what happens if Chrome does end up with the owner who doesn't have the same commitment? Do you just completely retool Comet into something else, or?
Yeah, I mean,
are you starting from scratch?
Yeah, I mean, we're competent. We're fortunate to have one of the most competent engineering teams assembled in the world, so we can adjust to any changing technology landscape. But it would generally be better if Chromium continues to be a strong open source alternative. All
right, Chrome, you've also tossed your hat maybe in for TikTok. I know there's a lot of folks out there. Is there something you are looking to purchase, to do as an add-on, a major purchase?
I mean, we are seriously still in the fight for TikTok. Obviously, that process is subservient to the larger U.S.-China trade relationship, and I don't think there's going to be any forward progress until the larger tariff and trade situation is resolved. But we're very excited about the role we can play in making TikTok more transparent and more useful to Americans. So that's very much in flight. Otherwise, we just want to keep adding to our all-star engineering team. And so the type of acquisitions we like to do are small acqui-hires of 5 to 10 person engineering teams.
Okay. We'll be watching. Dimitri, thank you so much. Really
thank you. This is fun. And thanks for using.
You don't use TikTok, do you?
I do.
Oh, okay.
Yeah.
All right. Do you do traditional search?
Sometimes for navigational queries.
Okay.
Yeah.
Google?
Yeah.
Okay, all right.
Yeah.
He's all in.
That was a speed round of questions, by the way. Thanks
you
for
gotta
playing
use
along.
everything. Yeah.
You do. You gotta check out the competition too. All right, Dmitry, thank you so much. Dmitry Shevelenko, he's the Chief Business Officer over at Perplexity, joining us here at Milken. I do want to send it back to our New York offices and bureau and to Bonnie Quinn for a quick check on what's going on with the markets. Hey, Bonnie.
Hey, Carol, thank you so much. Yes, we are crawling ever more into the green for these indices. We have the S&P now down less than 0.1%. If you look at the NASDAQ 100, we're down just 8 points, and that's thanks to the likes of MongoDB, CrowdStrike, some of the gaming companies doing really well today too, including Take-Two and Electronic Arts. They're helping the S&P 500 as well. That index is lower, but as I say, down less than 5 points. So it's really a market that's trading a little bit on the economic data that we got this morning, which showed solid services data in the U.S. economy, a reading of higher than 51, so a pickup at service providers. And that said, a market's also waiting for more trade headlines. One interesting one is Berkshire Hathaway down 4.5%. Of course, Warren Buffett recommending that Greg Abel takes over at the end of the year. But he did also say that shares were, if not overvalued, at least valued higher than he would like to increase any share buybacks at, albeit with an extra tax on buybacks by Berkshire itself. But that is an interesting mover today. The VIX index there, as you see, is still showing calm below 23. So let's get it back now to the Milken Institute conference in Beverly Hills, California. Carol.
All right, Bonnie, thank you so much. Well, last Thursday, Ventas shares fell as much as 7.2%. That was the most intraday since June of 2020 after the Senior Housing Real Estate Investment Trust left its full-year funds from operations guidance unchanged. I will point out, though, analysts, they pretty much noted the first quarter earnings beat. That's what they stressed. And the $30 billion market cap REIT, I should point out, is still up around 13% year-to-date. So let's get into it. Deborah Cafaro is with us. Of course, she is the chairman and CEO of Ventas, and she joins us here at Milken. How are you?
Doing great, thank you.
We just came off of, we did a panel on global real estate. It was kind of fun and spirited. I am curious from your vantage point, what struck you, what surprised you in that discussion? Because I felt like there was a fair amount of optimism, but some reality checks.
Well, the thing that really struck out to me in the panel was about the convergence around thinking about real estate differently as we go forward. And there was a lot of convergence on that, as you know. Some of the historically core asset classes are really not going to be core going forward. And some of the asset classes, like where there is secular demand, are going to explode in terms of the size of the market, but also the returns. And that was, I think, came through loud and clear. From a macro standpoint, there was mixed optimism, I would say. We all agree that the U.S. is the best, largest, most diverse, most powerful economy in the world. And our job is to take care of it and make sure we're winning for the right reasons. And we adopt the right policies to continue that growth.
What are the structural changes in our economy that ends up fueling Ventas's growth?
Well, the biggest change that fuels Ventas's growth, and we've delivered 19% annual returns for 25 years based on the mega trend of the longevity economy. So we serve a large and growing aging population, whether it's the over 80 or the over 65. And that is an inexorable demand trend that is necessary but not sufficient for success. So what we try to do is operate these assets, whether they're outpatient medical, senior living, in a way with data and operational insights so that we are outperforming even the beta on those long tailwinds that we have in our business. So that's the big structural driver.
Deborah, I'm curious about any policies from the administration, whether it's on Medicare, whether it's on R&D that impacts the healthcare industry. This is all your world.
Yes.
How are you watching it, and what, could possibly impact your business?
Yes. Well, one good thing is we are very insulated from the tariff discussion. We're primarily North American. We don't have a lot of cost of goods in our business that would be negatively affected by tariffs. And so that's a really good thing. Our biggest business is a consumer-driven model that is a value for seniors and their families to live with us in independence as long as they can, and so that is less affected by federal policy. The areas that we do watch are Medicare, where We have some outpatient medical and other healthcare facilities. And there's been a policy statement that the government is really supportive of continuing Medicare. I mean, 11,000 people a day turn 65.
Do you believe it?
I believe that Medicare will be supported. It is one of the most ubiquitous policies that we have. It cuts across all socioeconomic boundaries, and I think we will continue to support Medicare. And then in biomedical research, where we do have a lab business, I would say we are the global leader in biomedical research. It is the envy of the world and is going to long-term reduce healthcare costs. Half our country will have chronic conditions by 2030. And in order to treat those in the most cost-effective way and allow people to live healthier lives with less reliance on the healthcare system, we have to continue to develop and discover drugs that cure disease and treat chronic illness. And that is where we are best in the world. And I strongly encourage the administration to continue those policies, which, P.S., have a big multiplier effect on our economy.
Have you had a chance to talk to the administration directly about this?
I hope to do so right here at this conference.
All right, well, a lot of them are walking around. I saw them. Deborah, we'll let you chase them down. Deborah Caparo is the chairman and CEO of Ventas. All right, coming up here on the big program, and thanks for joining us.
You're welcome.
We're going to talk venture capital.
Hey,
We've
you're
talked
here, I'm
private
here.
capital. We've talked
Yes.
public markets. Let's talk about the venture space. Dana Settle, she's a co-founder over at Graycroft, the managing partner there. She's going to be joining us in just a second. Of course, AI really dominating the VC space as it's dominating the public space. The question is, how do you get those private companies into the public markets? She might have some answers to that.
I can't wait to talk with her. Hey, folks, we're not only a lot going on here at Milken, we do want to take a live look at a panel with the founders of KKR, legends when it comes to private equity. Henry Kravis and George Roberts up on stage, moderated by Bloomberg's very own Jason Kelly. Take a listen, take a watch. We'll be right back with our special coverage right here at Milken. This is Bloomberg.
We're the stewards of people that have entrusted us with their money. And getting them the kind of returns, a fair kind of return with performance is how we're going to be able to grow that. And then obviously technology is going to enable this to become even more efficient than what it is today.
And so, Henry, what are the mechanics of getting that done, this retail piece especially? Because I think it's fair to say that's been a holy grail for the alternatives business for a long time. It now seems really on the verge of happening. What does it look like in practice for, there are a lot of very more successful people than I, but like I have a 401k, I'd love some KKR on my 401k, no conflicts.
Well,
but,
actually, we were going to ask you on stage if you'd sign up here, and you could be an investor with us. We'd like that. Look, we have four product categories where people can invest. You have the private markets, which is private equity, it's growth equity, et cetera. We have infrastructure, we have real estate, and we have credit. And we distribute the product on platforms, very much like Capital Group, and a few others. And a year ago, at this time, we had about $8 billion of assets under management from this group. Today it's $21 billion.
And of course, that is Henry Kravis and George Roberts talking with our own Jason Kelly up on stage here at Milken. I'm Carol Massar along with Romaine Bostic, and this is Bloomberg.
Bringing you up-to-the-minute financial and geopolitical news whenever and wherever it happens. I'm Francine Lacroix in Davos, Switzerland, and this is Bloomberg.
The names that move markets are on Bloomberg.
We do not project recession in our assessment of where the world is headed. If we have this cloud of uncertainty coming lower and lower, making it difficult for the business community and for households to take decisions, we could have a self-inflicted injury that I guarantee you we would regret.
Nobody covers business like Bloomberg.
We're micro investors. So as micro investors looking to invest capital, whether it's in private equity or in direct lending, what we're looking for are opportunities to deploy capital at attractive risk return. When we wake up in the morning, we don't seek to avoid risk. We seek to price it correctly. And so in an environment like this, for sure, if you're looking at a portfolio company opportunity, when you think of the value creation plan, you're factoring in now the uncertainty, which undoubtedly will impact the extent to which you're willing to pay for that asset. Now, in our existing companies, in our existing portfolio, the vast majority are services company. And services companies don't have basically the input issues. But I will say that when we look and we roll up all this data for all of our portfolio companies, and it's quite rich, it's just down now below 1 million employees globally around the world. We're 2,300 at Carlyle itself. But in our portfolio companies, we roll up this data every month. For example, the inventory component of PMI was up about 4 points. I know that's not really news that anybody probably would have focused on, but we could see that happening months ago. So immediately when it looked like the new administration was going to come in and there was the possibility of tariffs, you could see purchasing managers immediately mobilizing to start bringing goods in faster because of the uncertainty factor.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
The dollar as a reserve currency, there's no alternative right now, but that doesn't mean there can't be. I think also when you look at tariffs, one aspect of how to get a better trade balance would be to have a weaker dollar.
Get myself in trouble. Welcome back to our special coverage of the first day of the 28th Annual Milken Institute Global Conference here in beautiful Beverly Hills, California. It's actually not that beautiful. It was raining earlier today.
Actually,
what happened? I thought it never rained in Southern California. Tony lied to me.
Yes.
Welcome back. A mashup of your two favorite programs, your number one favorite program, The Close, and your number two, Bloomberg Business Week. I'm Romaine Bostic. That's Carol Massar. Please don't talk, Carol.
Wow, favorite program, Bloomberg Business Week. Hey, listen, venture capitalists wrote really large checks at record speed between 2020 and 2021, leading to sky-high valuations and unprecedented deal activity. Now, the tide turned in 2022 as central banks raised interest rates to combat inflation, and the IPO market pretty much slammed shut. Now, the amount raised in IPOs worldwide tumbled to $146 billion last year from a peak of $641 billion in 2025. This is our own data here at Bloomberg. VCs have been forced to really prolong their investment timescales beyond the 10 years that were once typical in the industry. It's been quite a cycle. Well, joining us is someone who knows the cycle so well. She's Dana Settle. She's Greg Croft, co-founder and partner. And lucky for us, she's here at Milken. Great to have you back with us. Where are we in the VC cycle?
Yeah,
it's great to have you here.
I do know the cycles. I've been around for a little while. Yeah. But where are we? Look, I mean, I think that there was a lot of hope that the IPO markets were going to open back up this year. We did just have eToro go out today, price today, right? So, I mean, maybe that's a glimmer. But, the reality is the venture capital business is a long-term business. We invest into 10, 20-year cycles. And so that IPO markets do ebb and flow, and our expectation is that they will come back.
So, Dana, do you feel like what we've seen, I mean, just in the first quarter was quite a cycle?
Yeah.
Do you feel like that is just an ebb and flow, or is there something more structural or fundamental going on because of policies that are coming out of Washington that will impact the VC market going forward?
Look, I mean, I think that the VC market is healthy and, largely driven by such incredible, just massive technological trends. And these are real. I mean, if you sort of think about the last big, huge shift was around really the commercial internet and cloud computing and open source software. And this is an entirely new replatforming with AI. And that's on top of, it's really sort of enabling all kinds of other waves around things like reindustrialization of America, which is happening, largely due to a lot of the geopolitical sort of macro issues. And so there's such huge technological shifts that we're investing into that there needs to be venture capital dollars. And I think that those dollars find a way.
Are U.S. companies going to lead that in terms of the actual companies making the AI products?
Yeah, I believe so. I mean, certainly as it relates, I mean, it's a critical industry for the United States to be playing a significant role in. And I think that, the government recognizes that. And so I do think that the United States will lead the way. I mean, there are obviously other countries that are playing significant roles as well, but we certainly will play a very significant role.
Obviously, private money is a big part of facilitating that. Some people have advocated for a more public involvement, meaning of public money, of government involvement, kind of similar to what we saw with the DARPA projects that kind of helped to birth Silicon Valley and really just the broader tech ecosystem out here on the West Coast. Do we need that?
I mean, I think that there are some rumors of a broader U.S. sovereign fund, and you know, I mean, I think that maybe we do need that. But there are also, I mean, the United States has access to more private capital, whether it's families, pension plans, endowments. You know, I mean, there's a lot of capital that does flow into the private markets in the United States, more than anywhere else in the world. So I think that we do have that sort of structural advantage. But others are getting into the game, so we need to continue to accelerate that.
That's fascinating. So you think a sovereign wealth fund in the United States is probably a good idea? And do you also think the government, just to kind of follow on what Romain said, we do need to be more supportive of our industries? We certainly see it in a place like China, very supportive of industries.
I mean, I think we have to be. I mean, again, if you think about the venture capital business, entrepreneurship, the innovation economy, that has been that has been like the crown jewel of the United States. And so I think we need to continue to support it.
Does tariffs, is that an important part of it as well? How do you roll that into it?
I mean, you know, you wake up every day to a new surprise.
Does it support our industries or protect some of our industries, do you think, essentially, or not necessarily?
You know, honestly, I mean, I think long term we'll see. I feel like there are these shocks to the system right now, and you know, I think some of the things that we've seen have maybe been lesser shocks than we would have anticipated, but it's gonna, you know, we're gonna sort of roll through it. But bottom line, I sort of see the innovation economy as this big, huge wave behind it, and we always have these things that you know are little shocks, and then we keep going. But the tailwinds really are stronger than the headwinds.
So what's the conversation you have with your portfolio companies, the companies that you're invested in? Because I'm sure they have to be asking 100%. As well, right? And that's partly why you're there, not just for the money, but for the guidance.
Yes, absolutely. Yeah. And it's a role that, you know, we take very seriously, and we take corporate governance very seriously, and we spend a lot of time with our portfolio companies. We're on the boards of most of our companies, so we really do dig in on these issues. And I think we have 3 strategies at Greycroft. So we have a consumer brand strategy, we have an AI strategy, and we have sustainability. And it's really amazing how all 3 really work together. And so it's been incredible to get the feedback. We actually had a consumer brand summit last week up in Montecito. And so hearing them, and it's fascinating. I mean, so many of those companies went through COVID, so they kind of learned how to manage their supply chain in a much more resilient, flexible manner, and I think they're seeing the benefits of that now. But we're constantly. I mean, a lot of it is just being able to provide information flow to each other.
So you're not seeing any material weakness in those companies, financially speaking?
So far, we're not. And again, I mean, I think that the tailwinds from so much of what's happening in AI and the innovation is really stronger than the headwinds.
Dana, I'm curious about the pipeline of like startups that are being presented before you. Give us an idea of volume flow. Have things slowed down because of the volatility? No.
Oh my gosh. I mean, it is, like I said, I mean, I've been doing this for a long time as we started, and 25 years. And
that's valuable because I love people who have seen different cycles to kind of put this one in context.
It really does feel, it feels almost like no other because it's wave upon wave upon wave that's happening right now.
Because it's so funny if I think about the volatility that we've had in the last month where it felt like big publicly held companies are like screeching to a halt, maybe in terms of they can't even put out an earnings forecast or they give you a couple scenarios. And yet what you're seeing sounds very optimistic.
I mean, we're seeing the growth continuing, and I think what's happening is people for sure are sort of pausing and saying, okay, what does our cost structure look like? Make sure that we understand that, but also realizing if they're not investing into the technologies of the future, and AI and, you know, intelligent applications and infrastructure are really dominating that they will be left behind. And so I just think that is the narrative that we're seeing, and really, I mean, we've never seen growth like commercial growth at the rate that we're seeing inside of these companies.
I have to ask you just about Greycroft overall, and you kind of mentioned coming out here. You've been out, I don't know exactly when you came out, early 2000s, right? Yeah. There was a lot of talk about Greycroft being out here in LA, New York, not in Palo Alto, Silicon Valley. Did that work to your advantage to a certain extent?
Yeah. When we started Greycroft, really, if you think about it, we were investing sort of at the application layer of things because the internet had been built. So we were building on top of embedded infrastructure. And so I think being in markets that are more commercial, that really worked to our advantage. Now that we're back in the building blocks, building the infrastructure, we actually opened an office in Silicon Valley.
Well, that's what I was getting at, because when you talk about AI, that's different than beauty products and some other things.
Yes.
And when you talk about potential investments, talent, and things like that, you have to have a presence, I should say.
Absolutely, absolutely.
Yeah.
And we've hired an incredible team in Silicon Valley. I mean, I'm spending more time there than I ever have. Yeah.
How do you? But just real quickly about the environment in Los Angeles. Do you feel like you're getting enough support from the government in terms of whatever incentives or support they're giving to foster entrepreneurship?
I mean, I always think that there are more opportunities, of course. Taxes, one opportunity. But in LA specifically, and the broader sort of Southern California area, as far as this kind of rebuilding of the sort of American infrastructure, a lot of it is happening here in LA and Hawthorne and El Segundo, and so I think that there's still huge opportunities here. So,
Good stuff. Dana, thank you.
Thank you.
Thanks for stopping by. Really appreciate it.
Great.
Dana Settle, she's Greycroft, co-founder and partner. All right, we've got just under an hour to go until we wrap up the trade on Wall Street. Hard to believe.
It's kind of been a mixed day. I mean, this is a market that's still, coming off of that phenomenal 9-day rally. A bit of a reset, maybe trying to figure out where things go next. Don't forget,
meeting this week.
We have a big Fed meeting, starts tomorrow, the big decision on Wednesday. No change in rates. But
not this time
a lot of people want to hear what he has to say. And then we've heard from Scott Bessent. He has been making the rounds. He spoke at an event last night. He spoke at an event here earlier today. He has another event on Capitol Hill over the next 2 days. So he's kind of been out in front.
Kind of carrying the message in a big way. All right, hey, folks, let's give you an update on trading. For that, we head back to Bonnie Prince. She's there in our New York headquarters. Hey, Bonnie.
Hey, Carol, thank you so much. Well, the worst performing sector in the S&P 500, as you might anticipate today, it is energy. We have crude oil down in the $57 range, down $1.13 today, or almost 2%. And that has the S&P 500 with a drag on it, down again now by 0.3%. So disimproving in the final hour of trade. The Nasdaq 100 also down 0.3%. The Dow is still holding on to a fractional gain, but it's very fractional at this point. We're talking about just 38 points higher. The dollar index is a bit weaker today versus a stronger yen, for example. The yen trading at 143.80 now. And then yields-wise, we have the curve steepening, mainly thanks to a higher back end. The 10-year yield up just 3 basis points now. It was up about 6 basis points earlier in the session. The 2-year yield up about 1 basis point as we speak. And of course, we're waiting on earnings after the close as well. We do get the likes of Diamondback Energy. We have Vertex Pharmaceuticals coming. Some more companies like Clorox as well, which should give us some idea of how the consumer is faring. And then the likes of Diamondback Energy, Palantir, Vertex Pharmaceuticals. So a real grab bag, if you like, of earnings coming after the close. In terms of other assets on the move, we also have Bitcoin, which is lower today. So as we await more trade headlines, this market a little bit lost, it would seem. Romaine, sending it back to you at the Milken Conference in Beverly Hills.
All right, thanks, Bonnie. Here, of course, looking at some of those U.S. markets in the red, only fractionally on the day. But what is interesting, we did see green on the screen when it comes to European public equities here, and that's kind of been a theme.
Everybody's talking about Europe here.
Absolutely.
I feel like in terms of opportunities, even if there's some enthusiasm about U.S., everybody's talking about Europe.
And we've seen significant outperformance of European public assets. We've seen, including stocks and bonds, but we've also seen that outperformance in private assets as well, particularly over the past couple of months, as a lot of those U.S. government policies, if you will, are spurring a bit of a rethink of geographic allocations of capital. You have asset management firms, including Takeo, Advent, CVC. They've been looking to benefit from this rotation, which is being egged on by a historic switch in European fiscal policy. policy. Who would have thought?
Change.
Mathieu Chabran is at the center of it all as the co-founder of French asset management firm Tikeo Capital, which has grown to roughly $50 billion in assets, primarily focused on direct lending and real assets. And he straddles both sides of the Atlantic Ocean with investments and clients in Europe and the U.S. And he joins us here on the Milka stage. Great to see you, Mathieu.
Thanks for having me, Roman.
I want to start talking about this, I guess, potential reallocation. We've heard a lot about it. Is that real? Are we really seeing money flow into European assets at the expense of U.S. assets?
I think it's happening, regardless of what Secretary Treasury said, earlier on. I mean, we're seeing that right now. I mean, you saw that on the public equities. That was the fastest to move already. And now on the private side, not because people don't want to be in the U.S., but they were overweight in the U.S. I mean, think about that. I mean, out of every dollar invested for the past 5 years, 80 cents were coming into the U.S., and that has driven, obviously, valuation up. Europe was an uninvestable place, and if President Trump, succeeded in one thing, was to unlock the value investment and value proposal for Europe, definitely.
And a big part of that value proposal is this idea of additional fiscal spending, particularly when it comes to military and defense projects. Tikeo has been a big investor in the European defense space for some time now. How are you positioned?
No, that's one aspect of that, and the public spending needs to be an enabler. I truly believe that it's all about enabling this massive investment requirement. And if you look at defense specifically, roughly 2% of GDP has been allocated to defense in Europe, which is 380 billion euros. There is a consensus by 2030 will be to 3%. So just think about that, the amount of capital it will require to effectively fund the defense project. So out of that, only, if you think about that, only 18% of the spending was bought from European countries. The rest was part of NATO, and US was benefiting, from a large part of that. If you think between 2014 to 2024, Romain, we went from 13% to 31%, of spending for equipment. So you got all the large majors, are benefiting from that. You saw that on the public equity side, because obviously, they're the easiest asset you can buy. But think about the supply chain, all the mid-market companies, entrepreneurs who are fueling, the whole industry, and that's where the opportunity lies for asset managers.
Mathieu, I'm curious, former European ECB bank head, European Central Bank President Mario Draghi laying out a report in terms of what his vision is for European competitiveness. I am curious if Europe, in order to think about their next 10, 20, 100 years, means aligning more closely with China.
That's a big one. I mean, the one thing I can tell you is that the United States of America are not going anywhere. China is not going anywhere, and Europe is not going anywhere. What we're seeing right now is a rebalancing of the dialogues, of the flows. I don't think of the alliances, to be fair, Carol, I don't see, a shift in the alliances for the next 100 years. Now, to be very specific about China, from where we sit, what we've been seeing over the past few weeks, few months now, is an increased interest from Asian money and China in particular to invest in Europe. We've been seeing that, at a rapid pace, and any blind spots that have been left because of this dynamic between US and Europe right now. I mean, China, they're not taking advantage of, they want to be positioned because there is a value proposal for investors. So in this environment, it's not about choosing one camp versus the other, is that there is a reallocation of the capital flows, and there is no shortage of money in many parts of the world. So that's where, we're trying to focus on.
Like with the current, it can be hard to fight. And when you talk about reallocation of capital flows, it's very easy for them to shift back if there's better opportunities for investors, China or others. Do you think this is a longer-term shift that's going to stay?
I think, Carol, it's a rebalancing. Once again, there's been way too many flows for good reasons, but people had become a little bit complacent, in terms of valuation, in terms that, every single dollar coming into the system was effectively revaluing the previous dollar. And now you've got this pure supply-demand rebalancing, And I think that's what we are, going through right now. And you saw on the private equity side some big statement, obviously from the large university in the US for other reasons, but you had CIC last week out of China saying that they were reducing their private equity allocation, into the US. We all know fundamentally that private capital remains the key driver to invest and finance these mega trends, defense being one of them, but there are so many others. Cybersecurity, energy transition, which is not going anywhere. And so that's this rebalancing after maybe, as I said, maybe a very complacent period that asset managers like us, are trying to take advantage of.
Do you think the European government will follow through on this? Because they've said they want to take advantage of this. The question is, what's the follow through?
Yeah, well, it all comes down to leadership, Romain. And, after the past few years where there was so much debate around, leadership in Europe, what we're seeing right now, obviously, the change of leadership in the UK, taking office today or tomorrow in Germany, leadership of President Macron and, the whole administration, they got their act together the same way they managed, on the back of the Ukraine war to be extremely responsive. And what I think is that it's about leadership, it's about impulsion, and then public spendings need to be an enabler to attract private capital and to allocate where it is required and where it makes sense. So I'm extremely optimistic about the moment we have. There are some elections coming up, and we all know what election can bring. But let's not miss this opportunity, this window. We may talk about regulation as well. That has been slowing down a lot of the European initiative, and I think they're getting it right now. And there is a moment in history that we should be taking advantage of.
All right. Well, that's a great place to end it. We'll let you get back to work. Matthew Chabran is the co-founder of TKO Capital. Let's toss it back to Bonnie Quinn in New York.
Thanks, Romain. Well, with about 42 minutes left in the session, we are seeing a little bit of a deterioration again, although this is clearly a market waiting on more headlines on trade in order to pick a direction. We have the S&P 500 down just about 0.25% or 15 points. We have the NASDAQ 100 down almost 0.3% now. And the Dow still in the green, thanks to the likes of United Health, for example, which is higher but barely in the green. We have a curve steepening move today with the 10-year yield up more than 3 basis points now. The 2-year yield higher as well, but by just more than 1 basis point. So steepening thanks to the 10-year end of the spectrum. In terms of what's moving within the S&P 500, we're seeing energy companies lose out the most. They're down 1.8% as a group. That's obviously after the OPEC Plus decision to increase production and output, and that is putting a little bit of pressure on oil prices today. We're seeing them trade in New York just about $57 a barrel. Consumer discretionary down about 1% as a group as well, and information technology down 0.4%. We are seeing a bit of improvement for industrials and communication services. And I should mention that we did get solid services data this morning from ISM, the headline reading there of 51.6. So a pickup in growth at service providers, and that is helping to underpin this market just a little bit despite all of the ongoing trade war uncertainty. We're waiting on earnings after the bell as well. Those will include the likes of Ford, which should be fascinating, and Diamondback Energy. So another read on how the energy industry is taking a look at what tariffs might come down the pike and regulation as well. We'll also hear from Palantir and companies such as Clorox and AECOM for a read on the consumer. Now let's get back to the Milken Institute conference in Beverly Hills, California, and Carol Masser.
All right, Bonnie, thank you so much. Well, the Commodity Futures Trading Commission recently asked for public comment on allowing round-the-clock trading in derivatives markets. The FTC also wants input on offering perpetual futures. It's a type of contract popular outside the U.S. It's also getting traction in digital asset trading. Recently, the acting chair of the CFTC, Caroline Pham, joined Bloomberg TV and Radio. She told us that 24/7 derivatives trading is appropriate only when there's enough liquidity. So we're going to maybe dig a little bit deeper into that. Here with more on that and to talk about crypto's wild ride, it's a discussion she's having here at Milken, is the acting chair of the CFTC, Caroline Pham. Nice to be talking with you. When we talked last time, it was just coming off the crazy month that was April. We talked about volatility and trends and flows. Here we are a couple of weeks out. Have things settled down even more?
Well, thank you so much for having me back on the show. It's great to see you both and to be here at the Milken Global Conference. Markets have been performing strong. You heard President Trump and you heard Secretary Bessent say this morning, never bet against America because our capital markets are the deepest and most liquid in the world. And so I think it's a great time to be in the markets.
What's the strategy right now when it comes to crypto? This is a president that ran on being more crypto friendly. I know he's made a couple of overtures so far with executive orders, but the CFTC, in theory, is going to have to play a big role in that.
So I think what you've seen in this administration is that this is an administration built on optimism. There is an optimism about our economy, there's an optimism about growth and prosperity for all Americans, and there's an optimism about new opportunities in markets like crypto assets. Unified with that optimism is under the president's executive order that we're going to bring regulatory clarity. And I think when you think about digital assets, right, you can separate into two things. You can think about digital assets having tokenization as a new format for traditional financial instruments, and then you can think about unbacked crypto assets as a new asset class. And so particularly with the introduction today of a discussion draft for the market structure legislation, this is an attempt to bring that regulatory clarity that is needed to provide growth and opportunities for investors, for Americans. But with all of that, it's critically important that we have guardrails in place, and that legislation provides for guardrails as well.
Chair Pham, I want to say guardrails also include independence, and we have definitely seen the president remove some officials at several independent agencies, the NLRB, FTC. Any concerns about him potentially dismissing the two Democratic commissioners of the CFTC? I mean, if it isn't an independent body, what impact might it have on the regulator and the ability to make sure that there is respect in terms of the markets and the function by investors?
Our statutory mandate is so clear that we're here to ensure market integrity and that we're to prevent fraud, manipulation, and abuse in our markets. We're here to make sure that our markets are well functioning, and they're well functioning for everybody, for end users, for financial market participants, for banks, for dealers. And so no matter what, that mission never changes. And the president's executive orders for accountability for independent agencies actually just requires us to engage in cost-benefit analysis, which is already mandated by our statute. And so this cost-benefit analysis will make sure that we have regulations that are appropriately tailored so that the benefits are there without unnecessary costs and drag on the economy. And we have to submit that to OMB. That might add a little bit more time to our rulemaking process, but again, we already engage in cost-benefit analysis.
So you're not worried about losing the independence of the CFTC by the president removing anyone?
The CFTC is going to follow its statutory mandate no matter what.
Will you be the leader of the CFTC? Have there been any discussions about removing your acting title?
No. No. Have there been any discussions with you?
Not with me. I can make a phone call for you. I don't think I have any clout to get you.
A little closer.
To get you that. But I mean, have you had discussions, in all seriousness, with the White House about extending your tenure or making your tenure permanent?
So I've been so proud to support Brian Quintenz in his nomination to be the chairman of the CFTC. I look forward to hearing about his confirmation hearing when that gets scheduled and for him to be voted in. In fact, I've been so supportive of him even when he was a commissioner. That's how long I've known Brian. He's going to be a great leader for the CFTC, and I'm very much looking forward to going back to the private sector.
You don't think you would have a role in this White House going forward?
In the White House?
In the administration.
I'm looking forward to going back to the private sector. My daughter is starting freshman year of high school.
Caroline Pham.
Thank you.
CFTC trading acting chairman of the CFTC.
I think that was a no.
I know.
Just saying.
I mean, gotta ask.
No, absolutely.
All right, our thanks to Caroline for playing ball there. Of course, we're going to let her get back to it. When we come back here, our special coverage from the Milken stage continues. I'm really looking forward to this. Jeff Aronson going to be joining us. Of course, you know him as the co-founder of Centerbridge. If anybody knows anything that's going on right now with regards to market conditions, it would be him.
Yeah, and I'm thinking about alternative investments and so on and so forth, really seeing such a broad landscape. I'm curious because I feel like there's a lot of optimism that I'm hearing here and hope in terms of the markets. It's really crowded. We've got folks lining up next to us, getting ready for one of the next big panels. So we'll see what he says. I'm curious if he says uncertain or something else.
I think that might come up here, but certainly a big change in tone from what we saw last year and certainly the year before that. Our special coverage here from Milken continues. Romaine Bostic alongside Carol Nasser. You're watching Bloomberg.
When you're talking about retirement, It doesn't matter if you are in rural America, urban, suburban. It's not a blue state, it's not a red state issue. It absolutely is an American issue that we can all relate to. And so I am optimistic. And the reason why I'm optimistic is that the policy that we have been able to achieve over many years as an industry have been bipartisan. It did not matter who was in office. We're looking forward to engaging with the new administration and talking about how do we continue to make sure that more Americans can have access to a secure retirement, and how do we make sure that by doing that, that can put less burden on Social Security. By doing that, that puts more money to work so that the caregivers, children are not having to carry that burden. And so I do think that it will continue to be a bipartisan issue, and it is so important. We cannot close this retirement gap without private-public partnership.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
You have had a number of games overseas in recent years, and in fact, you opened the season going to the opening game in Brazil. So do you expect to do more overseas games, and is that a part of your strategy?
It is. We had 5 last year. We expect to have 8 this year, which will be the highest we've ever had. Our hope would be at some stage to get to 16 games in the next few years. We think we could do that. I think it's an indication of the popularity of our game. Every time we take our game to a new market, Brazil's a great example of it, the fans go crazy for it. They sold out the tickets in less than 90 minutes. People had a wonderful time. It was the talk of the town. And I think it will be the basis and the sort of the match that lights the excitement and the popularity of the game in that market, as well as what we're doing around the world. So we're very excited by it. It's just one element of that strategy. You need to have television. You need to have activity and participation in the sport, and flag football is a big part of that. So all of those factors, I think, are going to be what we think will be a very successful formula to be a global sport.
Do you ever envision having a team that's based overseas in Mexico City or in London?
Listen, we've talked an awful lot about it, and I think there are markets that could, without question, support an NFL franchise.
Earnings season begins. Is corporate America in a good place?
Wall Street is bracing.
Bloomberg is first to break the numbers.
We got Delta, Constellation Brands.
The wave of big tech earnings. We've seen a re-rating of earnings estimates.
I got to pay special attention to all this.
With the smartest insights.
Given the degree of uncertainty, you haven't really cut earnings estimates that much.
Anyone who says they have certainty on where the growth outlook is going, where earnings are going, is probably exaggerating.
Continuing coverage on Bloomberg.
Welcome back to our live coverage of the Milken Global Investment Conference here in the lobby of the Beverly Hilton in
a crowded, very crowded lobby. Yes, you are in Beverly Hills.
I try. And this is Bloomberg. I'm Romaine Bostic. That is Carol Masser. I am. And it's going quite a thing. You had a panel earlier today, and you had a chance to kind of get really a real vibe of kind of what people want to talk about, and more importantly, I guess what they're actually doing.
Yeah, I thought there was a lot of enthusiasm. I kind of asked about Scott Benson and talking about, you know, America, this is where investors are going to come. Many of them agreed, but they also said there's going to be some dramatic shifts in terms of global real estate. Something like ports, maybe the LA port, because of what we're seeing in terms of tariffs and trade, that might not be such a valuable asset going forward.
Yeah, well, most of the people walking around here are, of course, looking for investment opportunities of some or another, whether it's private credit, whether it's venture capital, whether it's even public market. And we came into this year, and there was a lot of optimism, particularly when it came to alternative asset managers. They saw plenty of opportunity for new investment, including big bets on the consumer, big bets on the U.S. economy, whether it's personal loans, bonds, home equity, data center financing.
American exceptionalism was really rampant everywhere.
And of course, a lot of that now has been, I guess, I won't say disrupted, but certainly rethought a little bit, coming off a lot of the chaos that we've seen in Washington. And now we sort of move forward to sort of where the next deals are going to be, where the opportunities are. Centerbridge is really at the center of that. We're talking about a firm that really has their fingers on the pulse based on the amount of money it manages, kind of split evenly between private credit as well as equity itself. And I'm pleased to say that the co-founder of Centerbridge Partners joins us right now, Jeff Aronson. Jeff, great to have you here. Let's start off with the demand for alternatives overall, how people are allocating to that portfolios, and whether there's been any shift given what's transpired over the last 3.5, 4 months.
I think allocations to alternatives, they take time because alternatives often are less liquid than publicly traded instruments. So I don't think you see immediate shifts in relation to the environment. Perhaps the exception is, some of the discussion regarding university endowments, for example, where there have been news stories that some large endowments are considering pairing less liquid holdings like private equity. But that's the only thing that I've seen that perhaps could be related to the current environment.
Is there a sense here that when we talk about allocations, having assets that act to a certain extent as a buffer for other things going on in the world, private assets, alternative assets, do they provide a buffer in this environment?
I think they do, and it really depends upon the type of alternative investment you're looking for. If you're looking for something that has an equity component, looking for capital appreciation, that's one thing. The other alternative is looking for an alternative that has a yield component to it. And I think these days, particularly with the volatility in markets, that investors are more prone to looking for something with a yield component, some money they can actually put into their pocket as opposed to waiting for long-term appreciation of something.
So talk to us about the yield component and the pricing of deals right now. Is it a little bit higher? Investors looking for more? Talk to us about how it kind of compares to what we've seen as of late.
A couple things are happening in what I'll call the yield-oriented or even the private credit world. First, there's a lot of capital that has come into this space. A lot of capital looking to be deployed. Usually when that happens, spreads, the premium over a risk-free rate, tend to contract. And that had been happening literally from January through the beginning of last month. And following the administration's announcement on tariffs, we started to see spreads in the private credit lending world started to widen. Whether that will hold, we don't know. But at least for the last month or so, there has been a shift there.
Okay, so and I'm curious, in terms of deal flow in that world, tell us about a deal that kind of got you excited as of late.
A deal that got us excited. Our lending business is different than I think many other private credit lenders. Most private credit lending activity is focused on financing sponsored buyouts. And as we all know, and as you've heard here today, as you're going to hear tomorrow, private equity activity largely is a little quieter than people had hoped. That means that private credit activity to finance those buyouts is also somewhat a little slower than people had hoped. Our private credit lending business is focused on middle market businesses that are not owned by sponsors, which if you think about it, that's the vast majority of companies in the United States have nothing to do with the private equity world. Nothing to do. And those companies are still borrowing. They're being cautious because they also read the headlines. They're aware of what's happening in the world. But to the extent that one of those companies wants to build a new plant or buy a competitor perhaps, they're still open for business. And those are the type of businesses that we're lending to.
Are they being more selective in that process though?
You have to be careful. You have to be mindful. So, for example, we have no retail exposure by design. And so as we speak to our borrowers and we want to work as partners with them, like, are you being impacted by tariffs on a direct basis? And if so, unfortunately, we're not in that position, but I'm sure many lenders are, you have to work with your customer. You have to work with your borrower and help them almost as a partner in addition to a lender. Okay, how are we going to figure this out? How are we going to navigate around this? And that takes time.
But it's not just about the tariffs themselves, meaning the dollar value of the tariffs. It's also just about overall trade policy as well. So I'm sure there are companies that would have no exposure, direct exposure to tariffs, that might have exposure to certain types of technology controls and export controls. How do you navigate that?
Well, I think about it even in a more broader fashion. There are some companies that if there are widespread tariffs and they stick, that companies are going to be directly impacted. Beyond that, if there is, for example, a global tariff war, a trade war, that's going to affect all companies in the United States. If there's a downturn in the economy or worse, a recession, all businesses are going to be impacted, even though they don't have direct impact because they're not importing perhaps from China. We're focused more on the latter and to make sure that our companies that we're lending to have lots of liquidity to be able to manage through that, number one. And number two, that make sure that they don't borrow too much money. They're not over-leveraged.
So it's not a case of extend and pretend kind of thing. I mean, you're doing it because they're solid businesses and you're not worried that by extending them, you're supporting something that maybe shouldn't be supported.
Correct. Yeah. I mean, you obviously always want to lend to a good business, and businesses have ups and downs. I mean, you don't lend to a business based upon what you think is going to happen over the next 3 months. You're thinking about what's going to happen over the next 3 years. And you have to take a long-term outlook with all of these borrowers.
Yeah. Just curious. Jeff, thank you so much. Jeff Aronson. He is good to have you, co-founder and managing principal over at Centerbridge Partners. All right, everybody, let's get another check on markets. We're counting down about 20 minutes to go until we wrap up trading. Back to Bonnie Quinn in New York.
Exactly, Carol. We are into the final stretches here, and we gave up all our gains on the Dow, but we are back in the green again, up 27 points now. That's thanks to United Healthcare and a couple of others that saw steep declines last week, like, for example, some of the gamers. The S&P 500 down 0.3%. The Nasdaq 100 also 0.3% lower, so not much improvement there. There are earnings out after the bell that could change things. Big companies like Ford, for example, surely there will be comments about tariffs there. We also have some electronics companies and some AI companies. Palantir will also be reporting, Vertex Pharmaceuticals and so on. Gold higher as well today, which should tell you something about sentiment. It's above 3,337 an ounce, now up 3%. Bitcoin off its lows. It's trading at 94,600, give or take a few dollars. And we have the yield curve steepening as well. The 10-year yield is up more than 3 basis points. Now, that's lower than where it was just earlier in the session, but it's still showing a little steepening with the 2-year yield up just more than a basis point. We're also seeing a lot of weight on oil, and that is also not helping oil companies in the S&P 500, for example. It's one of the worst performers in terms of sectors. Oil, after the OPEC Plus meeting, of course, meant that there's going to be more production, more output. WTI trading in the $57 a barrel range. Back to the Milken Institute conference in Beverly Hills, California, and Romaine Bostick.
All right, a great conversation right now live on the Milken stage where we focus on government policy and, more importantly, budgets. We talk about tax collection here in the USA. Those projections are down. Refunds, they're up, and that's a formula that could dampen government revenue and portend an earlier deadline for Congress to raise the debt ceiling or risk a federal payments default. Philip Swagel is the director of the U.S. Congressional Budget Office, and he joins us now here on the Milken stage. Philip, great to have you here.
Yeah, thanks so much.
Let's get right to it. Everyone's talking about this so-called X date. I know it's a squishy date, but when people look at tax receipts, they look at the current situation in Congress right now. Is that date going to move up?
We still have it as late in the summer, into August, into September. Of course, it's possible that it can come forward depending on the continued revenue, especially in June. But for now, we're comfortable with our later date that Congress has time to act on it.
The revenue you're seeing coming in, at least in the most recent month, you're encouraged by that?
It was tracking reasonably well with our expectation. And this is the projections that we made back in January and February, that the revenues are still in line with that.
One thing I want to ask you, in terms of real deficit reduction, because one of the things, I just did a global real estate panel, and the thing that they are most concerned about seemed to be the growing U.S. deficit. What real constructive work are we doing to really reduce the deficit, and what kind of pain might it impose on U.S. citizens?
Yeah, it's, you know, I've seen the Treasury Secretary talk about that. He was here at the Milken conference this morning talking about it. He is writing in the Wall Street Journal about it. And so I know he's focused on it. I know the administration is focused on it. And that's, it's important, it's necessary. It doesn't have to be done immediately, but that, since this should be reassuring to the American people.
Why do you say it doesn't have to be done immediately? Many would have said 10 years ago, 15 years ago, we would have had this conversation and talked about kicking the can down the road, and here we are again. Why is it not an immediate problem?
No, it's, you're exactly right, that in the past, there's been an urgency and then the lack of follow-through, the lack of action, and that's part of my message, is that we do, as a country, have time because the rest of the world still sees us as a country that's stable, that's secure, that's growing. There's lots of volatility in the U.S. and the policy environment now, and that's a negative. We still have the trust of global investors, and that's what gives us time.
How confident, though, are you right now in your economic projections? The Treasury Secretary was here earlier today. He specifically called out the CBO's GDP projections of 2%-ish or so. He's saying, in his view, that number should be closer to 3%. What's the gap? Why does that gap exist?
Okay, the gap is understandable because what CBO is doing is projecting the economy under current law. And what the Treasury Secretary is doing is completely appropriate. He's saying, with the president's agenda, he says, we, the administration, have a pro-growth agenda. He thinks that will be successful, and of course, all Americans hope it will be, and that will boost economic growth. And if it does, well, then that will be good for everyone. We're just looking at different things. So we're looking at what was the economic trajectory before the president's agenda.
There's a balance, though, as well. So we don't quite know which policies will become law or become real. I know that's going to take some time. But we do know the contours of this administration. A crackdown on immigration, which immigration, of course, to a certain extent, has been a net positive, at least on aggregate GDP growth in this country. There's also a lot of issues when it comes to the IRA, which the Trump administration is trying to scale back. When do you factor those impacts in and the potential drag on growth?
Okay, you're putting your finger exactly in the important question, is that all of the changes happening, both the executive actions and then the legislation being considered by the Congress, how will those impact the economy? And so the executive action you mentioned on immigration, that affects the labor force, that affects the economy, it affects the federal budget. We are tracking that. It's still a little bit too soon to know what is the long-term impact of that. Is the decline in immigration temporary, or is it a long-term factor? And that's the kind of thing we are tracking. Our next update will be late spring, early summer, and we will build in that, the IRA, all the other changes into that next update.
Many economists, though, in terms of immigration, the importance in terms of feeding the labor market, providing a younger population, they point to Japan, they point to places like South Korea where folks are not having babies anymore, and even in America, in terms of the small families that people are having. So I understand what you're saying, but a lot of economists have done the research for years about the importance of immigration in terms of the health of economic growth for a nation.
It's what makes immigration a difficult issue, is that it's both an economic issue, and you pointed to the key economic factors, but it's a social issue, it's a political issue. People worry about, crime and safety and local communities, and it builds together all of those things. And then there's high-skilled immigration and low-skilled immigration, and those are connected as well in the policy space. So that's what makes it a difficult thing, is because it brings together so many cross-currents in our society.
I am curious when you guys think about the outlook. We're in earnings season, and we've been reporting on it, and you do have companies come out with two scenarios because they see it as one, potentially, where we are no growth or in a recession, and so it doesn't look so good. We have another where things look pretty normal, and we're back to American exceptionalism. Tell us about the scenarios that you are planning for, because that's very different in terms of the U.S. government and what the fiscal picture looks like.
No, you're right. And we at CBO have the same dilemma as the companies to try to figure out which trajectory are we going on. And of course, there's a spectrum between them. we suspect the volatility of the last month will lead to slower business investment, reduced capital inflows, reduced foreign investment in the U.S. That will tend to have a negative effect on growth. On the other hand, if there are trade deals, if there's changes in regulation that are pro-growth, that will go in the other direction. And that's what we're looking at, is to try to figure out the balance between the sort of the downward pressures, the volatility especially, and the upward of the president's agenda.
Is there a balance, or are you leaning one way or the other based on what we've seen so far?
It's just too soon, because there's a sense in which we have all the volatility, we have all the negative parts, and now we're waiting on the positive. And that, I'll just say, today, CBO, we posted our first cost estimate for the reconciliation bill of the House Armed Services Committee. So there's lots more to come as the different committees in the House do their work, and we will analyze it. But it just gives you an indication there's a lot more coming. There's a lot of legislative activity, and that's the part that's still to be written.
CBO, independent, nonpartisan. Is there political pressure on you to make sure that numbers look a certain way or point in a certain direction?
So I have benefited from 50 years of CBO being independent, being nonpartisan, my predecessors doing a good job. And that's what members expect from us, from me. They expect honest analysis, whatever the numbers are. They just want to hear it, And I don't want to disappoint people, but if the numbers are not what they hope for, it's just another day, and that's just, we're doing our job.
So that means no pressure?
The pressure is really internal. Okay. We're trying to do a good job. We want to be as complete as we can, as comprehensive as we can, as transparent as we can, and that's really the pressure.
All right. Well, I really appreciate. There's a lot going on your end, so we really appreciate you finding some time for
thank you.
And Bloomberg.
Pleasure.
Philip Swagel, he's the U.S. Congressional Budget Office Director, joining us here at Milken. All right, back to New York we go, and to Bonnie Quinn. Hey, Bonnie.
Hey, Carol. With just 13 minutes left in the trading session, an interesting development. We are seeing selling into the close, and that's before a wide swath of earnings after the closing bell. The S&P 500 is down a full 0.5% now, more than 26 basis points, and we have the Dow Jones Industrial Average also in the red. It is down 0.1%. You can thank energy for a lot of this. WTI trading literally at $57 a barrel now, down 2.1%, and energy, the worst performing sector in the S&P 500 sector as a whole, is down 1.9%. Just three areas that are in the green, and that's industrials, consumer staples, and communication services, and they're barely in the green for the S&P 500. That's because we're waiting for more trade headlines. We're waiting to hear more about trade. We even got some better than expected economic data today, and while that underpinned the market for some of the day, it's certainly not doing it now as we approach the close. That data, by the way, was ISM Services, which showed better growth than expected. 51.6 was the headline number. If we take a look at yields, we'll see the same story. We have the curve steepening, although not quite as steep as at the beginning of the session. We are seeing two-year yields rise more than a basis point and a half, and we're seeing 10-year yields rise about 3+ basis points. 33.75 is what we're seeing there on the 10-year yield. In terms of other asset classes, gold continuing to move higher. We have it trading at $3,335 an ounce now, up almost 3%. Bitcoin is lower, but not quite as low as it was, so a little bit of buying after selling. It's trading at $94,435 a coin. And if we take a look at the dollar index, that's also quite interesting today as well. Weaker once again as we continue, as I say, to await more headlines in terms of what we're going to get out of trade. So let's get back to the Milken Global Institute, where we're hearing plenty about trade, and we'll get back to Romaine Bostick and Carol Masser. Carol.
All right, Bonnie, thank you so much. Well, the companies that get private credit loans are looking increasingly wobbly, and banks are among those that could eventually be on the hook for losses. Now, many companies, they are getting direct loans from private lenders, and they are struggling to produce cash, but at least one key measure. At the end of 2024, more than 40% of borrowers had negative free cash flow from their businesses. That is according to the IMF, the International Monetary Fund. They warned in a report over the past week. Now, that is up from closer to 25% at the end of 2021. Curious what our next guest had to say about the environment. With us is Stephen Tenenbaum. He's founder, managing partner, and chief investment officer of the credit-focused asset management. We're talking about Golden Tree Asset Management. They've got nearly $57 billion in assets under management for institutional investors. So nice to have you here. I know you're leaning in. It's loud. It's loud. Tell us about the environment right now, and I'm curious, where do you see some opportunities when it comes to global credit markets?
So it's hard to believe. In just these past 4 weeks, we've done a round trip. So right now, spreads, HYG, which is the ETF, it's pretty much unchanged. Yet the expectations for the economy have shifted down. So right now, the market doesn't seem to believe that there's an issue, but predictions and the environment certainly doesn't reflect that.
So round trip, are we back where we want to be, or are we back at a place that's very different from where we started?
So I think the real issue is this 2022, where the concerns about a recession are overblown, and we're going to play through this. Very much the resilience that Treasury Secretary Besson talked about this morning. Or are we in for something that's more turbulent, and that the expectations that the economy is slowing is actually going to be realized, in which case spreads do not reflect that. And it's developing.
What do spreads reflect right now in your view?
Benign environment.
When you look at how much spreads did increase in early April, along with all the other market ructions around April 2nd, and the rollout of those trade and tariff policies, and the narrowing that's occurred since, similar to the rebound that we see in public equity markets here. Yep. Is that in sync?
They certainly are complementary. There's been more dispersion in the equity market, and particularly in mid and small cap, than what we've seen in the credit market, which has really been pretty much technically, recovered pretty much to the levels that they were before.
What about valuations? When you're looking around right now and you see what's already on your portfolio, but also new opportunities, do you have some sort of transparent price discovery right now, or are things kind of muddy?
So, in terms of the stuff we're doing now, there's always idiosyncratic. I've been a portfolio manager for 35 years. There's always something to do. But in terms of this market, that interesting, there's no FOMO of not participating. But we're going to get more evidence about how things are in the next 4 to 8 weeks. And I'd rather be tighter with more confidence, or believe that the market reflects the uncertainty.
So you don't want excitement, you want boring.
No.
Or something in between.
I'd rather have a lower price with excitement or a higher price with boredom. Yes.
Well said, well said.
Yeah.
Are you looking to do capital raises because you anticipate there's more opportunities to come once things settle down?
So we're pretty good with capital. So we have our catcher's mitt, and also we're pitching some deals. One of the things about this current environment is there's the M&A and some of the asset sales that private equity was expecting isn't coming realized. There's a wider gap between buyers and sellers. So one way to return capital to LPs is through dividend deals. So we want to facilitate that.
I am also curious, we have seen spikes in terms of, credit spreads widening. I think about the last month, the moments of stress here. Do you think that's it for this year? I mean, the volatility has been immense, and I understand what you're saying, the difference between the public and the private markets, and I'm curious which one is right.
Sure. So I remember during the UBS Credit Suisse, and it lasted for maybe a day. And there was a good reason, because the dynamics of that deal that were onerous to the Credit Suisse junior debt holders, that you could extrapolate that. And it turned out, because the Swiss regulator is different than the rest of Europe, you could pretty much isolate that. I think it's very different in the U.S. It's still developing. And then there's the tariffs with our allies, and who we have very healthy relationships. And there's the more developing relationship with China that is unclear. So I think that there's two ways and those are two different discussions, and how they turn out, we're going to see.
We only have about a minute left. I am curious about opportunities outside the U.S., particularly in emerging markets. Sure. Of course, Golden Tree has been a big player in that for years, and we've seen really sustained, meaningful outperformance as of late in emerging market assets relative to developed markets.
Sure. So one of the effects of the tariffs and Trump's perspective, I think that their agenda is to weaken the dollar. To weaken the dollar historically has been good for emerging markets. If you look at what's happened in Latin America, they've had some elections, you've had success in Argentina, very good cooperation out of Mexico. So that's been a place, that region has been much more supportive to investing. And so I feel as a neighborhood, it's been a pretty good neighborhood, and it seems like it has a good tailwind still.
Do you think they'll be successful in tamping down the dollar strength, the government?
Well, I think they like the,
That's what they want, but do you think it's going to happen?
It seems to be happening.
Yeah.
And it seems to me that it's had a healthy move, and you could say that it's still pretty reasonably priced. So I think, that it makes sense to me where the dollar is.
All right, so you got to leave it there. We'll let you get back to it. Stephen Tannenbaum, founder, managing partner, and CIO over at Golden Tree Asset Management. Carol, we should point out we are getting closer to the close of trading in public markets. Stocks, at least here in the U.S., deep in the red and now hitting session lows. We'll be back in a moment with Jed Laskowitz of J.P. Morgan Asset Management.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
We're micro investors. So as micro investors looking to invest capital, whether it's in private equity or in direct lending, what we're looking for are opportunities to deploy capital at attractive risk return. When we wake up in the morning, we don't seek to avoid risk. We seek to price it correctly. And so in an environment like this, for sure, if you're looking at a portfolio company opportunity, when you think of the value creation plan, you're factoring in now the uncertainty, which undoubtedly will impact the extent to which you're willing to pay for that asset. Now, in our existing companies, in our existing portfolio, the vast majority are services company. And services companies don't have basically the input issues. But I will say that when we look and we roll up all this data for all of our portfolio companies, and it's quite rich, it's just down now below 1 million employees globally around the world. We're 2,300 at Carlyle itself. But in our portfolio companies, we roll up this data every month. For example, the inventory component of PMI was up about 4 points. I know that's not really news that anybody probably would have focused on, but we could see that happening months ago. So immediately when it looked like the new administration was going to come in and there was the possibility of tariffs, you could see purchasing managers immediately mobilizing to start bringing goods in faster because of the uncertainty factor.
In case you missed it, on the pulse.
I see more and more European suppliers that are becoming aware of the need to increase the pace and to offer something unique. So if, let's say, 2-3 quarters ago, I was them more in a wait and see, now I see more reactive. We have some Chinese suppliers, yes. Are they making strategic component? Not. I think that there is nothing more than that.
Don't miss the pulse, live every weekday.
Welcome back to our special coverage of the first day of the 28th Annual Milken Institute Global Conference here in Beverly Hills, California.
Yeah, busy day, that's for sure. A lot of great conversations. This is a mashup of two of your favorite programs. We're talking about the close and Bloomberg Business Week. I'm Carol Master along with Romaine Bostic, and we're looking at just under a minute until we wrap up the closing day here on Wall Street. And we're kind of seeing some selling going into the close.
That's what's interesting. We've been talking, of course, a lot about what's been going on in private markets because that is the core audience here.
The distinction between the difference, right?
Right, but public markets still in focus as we get the closing bells in New York. Right across the screen, modest losses on the day coming off of that 9-day win streak for the S&P 500. It looks like it's going to close the day down below that 5,700 level, down about 38 points or so, or 0.7%. The Dow Jones Industrial Average down 0.3%, while the Nasdaq lower by 0.8%. The Russell 2000 also moving lower, down by 0.8%. We should point out the VIX relatively elevated, at least from where it was on Friday, back around that 23 level, and no real change right now in the Treasury space. We're talking about upward moves in Treasury yields today of only about a basis point or two, depending on what part of the curve you are.
Yeah, cutting down to that Fed meeting and Fed decision this week. We should point out, too, it's pretty much broader-based selling, some more risk off. You've got more than 300 names in the S&P, a little bit lower today, 179 to the upside. All right, so the trading day just wrapping up here on Wall Street. Our next guest from Milken oversees the JP Morgan Asset Management's markets investment teams that invest really in a variety of investments. We're talking about real estate, infrastructure, transportation, timberland, special situations, PE, macro, and absolute return fixed income. So quite a vantage point. These teams manage about $150 billion in assets for institutions and individuals. So let's get to it with some thoughts on the investment environment, especially when it comes to the private markets. Great to have with us Jed Laskowitz. He's JP Morgan Asset Management's Global Head of Private Markets and Customized Solutions. You've got a big team. You see a lot.
Thank you for having me.
It's nice to have you here. How's that team doing, and where are you guys seeing opportunities right now?
Yeah, I mean, you talked about where the markets closed today, and I think it's emblematic of what's going on right now. It's the markets are really trading on what will end up happening with the tariff scenario and what will that mean for companies doing transactions, where they want to invest, how they want to think about investing in the future. And until there's more clarity, we're going to have volatility. And volatility is not necessarily a bad thing. It depends on how you're positioned and how you can use that volatility to help reposition portfolios.
Jed, if that clarity is a tougher environment that might impact growth, it's a different investment environment than for a while. So, yes, that's fair to say?
Yeah, I think it's fair to say. I mean, we did see a similar type environment if you assume inflation's going to rise. And I think even if there's a tariff deal, we're likely to see tariffs that will be higher than they've been in maybe 100 years. So if that's the case, I think you're likely to see higher inflation. You're likely to see impacts to growth. And if you think about environments in recent years where we've seen that,
did I hear?
I mean, it's a risk, but we're not necessarily think that stagflation's on the horizon. Just more moderate growth, slower growth, maybe a recession. I think we're kind of about 50-50 at this point on that. And you want to think about assets that can protect in that environment. And if you go back to 2022, real assets performed incredibly well in 2022. Real estate, infrastructure, and real estate in particular still hasn't recovered. Equity markets have recovered. Real estate hasn't. In places like Europe, you're still looking at capital values down 20%. And central business districts like Paris, London, Munich have office vacancy of less than 5%. So those real estate markets have really started to come back, but prices haven't recovered yet. So I would think about areas that haven't come back in the last couple years, and I think real estate is one of them.
How do you do that, though? Because when I hear, okay, cheap real estate, I also think, well, a lot of it's cheap for a reason. If you believe, let's take recession out of the question, even if you are anticipating a slower economic growth, does that change how attractive some of those real estate assets might be?
Yeah, I think there are themes in real estate that we're really finding interesting. I mean, housing affordability is at almost an all-time low, particularly if rates persist. And there is a housing shortage, and that's not just a U.S. phenomenon. It's a phenomenon in Europe and Asia. So single family for rent, multifamily for rent, and clearly real estate will have some challenges in a recessionary environment. But remember, prices haven't recovered. So if you go back to the GFC, U.S. core real estate went on a 13-year run after the GFC and provided a 4 times multiple on invested capital following that period. So prices have already reset. Sure, they could go down a little bit more, but there are sectors of the market that we find interesting.
When we talk to people, investors, large investors that are making reallocations and trying to decide how much exposure they want to private assets, real assets, alternative assets as well, universally, it seems to be an increase in that allocation based on whatever their top line limits are. That's not just going to be real estate. Where else are they looking?
Yeah, no, great question. And infrastructure is one of them. Infrastructure is proven to have low correlation to public markets, low volatility, predictable return streams, particularly when you're talking about core infrastructure assets. And we're talking about assets that are focused on providing energy security, meeting increased energy demand, and also funding this energy transition. And energy transition is a really important topic because it's necessary to fund the increased energy needs in the U.S. Electricity needs here could increase by up to 50% in the next 10 to 15 years. That's not just about AI, it's really about the electronification of almost everything. And we've seen the importance of energy reliability. Just last week, 55 million people in Spain and Portugal were without power. So energy reliability is an incredibly important theme, and private capital is going to play a big role in funding those needs.
All right, Jed, really appreciate it. Jed Laskowitz, JP Morgan Asset Management, Global Head of Private Markets and Customized Solutions, right here on the Milk and Sage. And some earnings now crossing the wire from one of the biggest automotive manufacturers.
Yeah, and certainly playing to the environment. Ford coming out estimating that the tariff impact of about $1.5 billion to its fiscal year adjusted EBIT. It suspends its fiscal year forecast due to tariff-related uncertainty. Ford shares right now up about 0.2%, going to its earnings now unchanged. The stock first quarter adjusted EPS of 14 cents a share. The estimate on the street was actually looking for a loss of about 4.3 cents. So maybe that's why there's a little enthusiasm that it wasn't as bad as anyone expected. And I think the tariff impact, we're getting a number on it, but nonetheless, I think to be expected as well.
It's good to see an actual number on it because it means that companies, at least they think they have some clarity. And Ford, of course, has been kind of on the losing end of some of the policies coming out of Washington. One company that in theory has been on the winning end of that has been Palantir.
Big time.
Although those shares oscillating in the aftermarket right now, they're just out with their earnings. First quarter revenue did beat earnings, $884 million. The street on average was looking for $863. EBITDA also beat. Now here's your guidance going forward. The company says that for the full year, it sees revenue into 3.9. Basically, we're just calling it about 3.9 billion. That's above the average of street estimates. So basically guiding above previous forecasts and guiding above what analysts had expected. And a similar story on operating profit, $1.71 to $1.72. The street, on average, Carol, was looking for $1.58.
Investors like what they are hearing, up about 2.8% here in the aftermarket. Another one, Hims & Hers Health, reporting posted better than expected first quarter revenue. Company pivoting away from making copycat weight loss drugs and instead focusing on selling discounted versions of Novo Nordisk's blockbuster drug Wegovy. So the business getting a boost when branded weight loss drugs were in short supply. We know that. It's a story we've talked about, and a regulatory loophole allowed the company to sell those copycat versions. So those shortages have since resolved. It's been a different marketplace, and so they are changing. But right now you're seeing Hims & Hers down about 4%.
And I just want to make a quick correction on Palantir. Those operating numbers that I just gave, that's not actually EPS. That is the full shebang here. So it's 1.71 billion to 1.72. Street on average looking for 1.8. All right, let's keep it moving here. We're going to take a deeper dive into those earnings just a little bit later when we get back to our special coverage of Milken. And pleased to say that the chair of the U.S. Federal Communications Commission, Brendan Carr, joins us right now. Brendan, great to see you here. I know you've been making the rounds. You had a panel here. Everyone right now wants to know what the FCC's role is right now in the broader policies, particularly when it comes to infrastructure being rolled out by the White House.
Yeah, thanks so much. President Trump has been very clear. He wants to unleash America's private sector to build again. If you look back the last 4 years, so many infrastructure projects got bogged down in reams of red tape. We saw it with his $42 billion internet infrastructure plan that went nowhere. And so he directed us to deregulate. In fact, we've engaged in the most massive deregulation effort at the FCC that we've ever done. It's underway right now. We've closed and looking to close 2,000 dockets that have been open. But probably the most important thing we can do for the economy right now is spectrum. These are the airways that your smartphones use. We made a lot of progress on that during the first Trump administration. We fell behind a little bit during Biden. We need to move hundreds of megahertz out in the marketplace. That's actually deflationary. It's going to drive down prices for consumers, and it's going to be pro-competitive too.
Those dockets, I mean, what actually accelerated that? What was the outcome?
Yeah, so right now we're targeting all of those. We're seeking comment on it. We've already closed over 100 dockets. We're doing a massive deregulation initiative, and permitting reform is so key. You know, we have these rules on the books that force broadband providers like AT&T to invest billions of dollars in old copper line networks, but we're taking a fresh look at that so they can move that investment over to high-speed IP networks. So it's effectively moving billions of dollars of capital into new networks. These are some of the economic agendas that we're running at the agency.
So what's the timeline on all of this? It's a lot to get through, but what is the timeline that you guys are looking at?
It is. Our direction is to move on Trump speed, so we're moving very quickly. The first 100 days already, we've taken action across many of these fronts. Also, national security. We set up a new council on national security at the FCC. We're making sure that we're not vulnerable to threats that come from communist China, for instance. We're looking at making sure that people can make and manufacture things here in the U.S. as well. And so we're running a full economic agenda, and we're pretty proud of it.
What are you hearing from members of the telecom community about what they can do in terms of manufacturing here in the United States?
Yeah, there's a lot we can do. For instance, no piece of electronics can be used in the U.S. unless it's tested in a lab. But so far, 75% of those testings take place inside China. So we're looking at steps we can do to reshore a lot of that testing as well, and that'll help give U.S. manufacturers a boost.
How long would it take to do that?
You know, I think it can be pretty short order. We already have some of that testing here already, so we're taking steps to sort of further do it. But these are just, you know, parts of the pieces we're running at the FCC. It's a really important agenda. Again, we got to unleash America's private sector. They were held back too long by different red tapes and regulations. Permitting reform, again, as I mentioned, a lot of state and local regulations still slow down internet builds. There's a role for the FCC to step in there and help clear the way. But spectrum, permitting reform, deregulation, that's the driving agenda at the FCC. And I think it's going to be great for the economy.
How unified is this approach from the administration? We had the director of the White House Office of Science and Technology on a little bit earlier. He obviously talked a lot about reclaiming the U.S.'s lead in technology relative to the rest of the world, particularly when it comes to AI. Is the FCC a part of that?
Yeah, for sure. Look, President Trump has put together just an all-star team, particularly this second administration. Everybody is fully aligned. They're executing the president's agenda. You mentioned AI. I mean, that's going to be the use case that's going to drive so many of these telecom networks. That's why we have to get more spectrum out there. That's why we have to make it easier to invest in these new high-speed networks. When you look at the data demands of AI, you know, data generally is going up, but AI is going to increase through the roof.
Where do we stand, though, on spectrum? Because I've heard that before. What's out there, and even some of the spectrum that has been released over the last few years, there have been some concerns that they might be causing interference, particularly with some of the recent incidents that we've had in aviation here. Can that sort of coexist altogether?
Yeah, look, you know, thankfully President Trump has a playbook on this. In 2017, we had fallen far behind China. He stepped up and said, look, I want to lead in 5G, I want to lead in 6G. We cleared hundreds of megahertz of spectrum. We fell behind China. The reality is we are falling behind China right now. But we have the playbook. President Trump is going to step in. We're working right now. Chairman Ted Cruz in the Senate is working hard to get spectrum across the finish line. We can put it in reconciliation, and that's going to help pay for a lot of the efforts that people want to do in there. It's going to be $80 billion or more to be raised if we start auctioning this spectrum off.
Chair Carr, what does this do for people who really don't have access when it comes to telecommunications, our rural areas? We've heard so much of this post-pandemic. Everyone has talked about helping these areas for a long time. How do you actually help those Americans?
Yeah, there's a couple things we're doing there. When we get more spectrum out, that will bring people across the digital divide. We'll give people more competitive options. But also, think about this new generation of low Earth orbit satellites, whether it's Starlink, Kuiper just started launching. There's other providers out there. When we bring that together as part of the solution, that's really the long-term key to bridging the digital divide in a cost-effective way.
Well, that's interesting that you bring up Elon Musk, Starlink, Doge. We know his certainly close relationship with the president. I mean, how much of the work you are doing is kind of focusing on his kind of technology?
Well, look, I think the space economy in general is probably one of our top 3 issues that we're doing at the FCC. We need to start moving much more quickly. It took, you know, years to get the permits necessary for a lot of the communications for these satellites. We need to be doing that in a matter of days and weeks. But it's not just Starlink.
How do you do it safely, though? There is some concern about how many satellites are up in space at this point. We just did a big deep dive here at Bloomberg about concerns about satellites coming down. I mean, there is a process here. How do you do this safely?
Yeah, we feel comfortable. There's orbital debris mitigation rules that are in place. We license all the satellites at the end of the day. We feel very comfortable that we can still get thousands of more satellites out there. And again, the new trend is direct to people's cell phone. And that's something that's just emerging. In fact, we've given providers authority to go higher power from these LEO satellite systems to get even better direct-to-cell capabilities. So this is a really exciting area.
I want you to talk, though, particularly when it comes to the satellites in space. There's obviously a lot of competition between nations for that real estate, if you will, in the air. The U.S. obviously had the first mover advantage. China China has been launching like crazy. India now trying to get into the mix. And we're seeing other countries, including in Latin America, also try to find space up there. Does this become a conflict at some point?
Look, I think this is going to be a very important geopolitical issue. As you know, China is trying to launch their own version of whether it's Starlink or Kuiper. And when they're able to pair Belt and Road with high-speed internet provided from satellites with their own CCP content moderation filters, that's a real threat going forward. And that's why it's so imperative that the FCC move quickly to allow U.S. providers, again, a full range of them, to launch, to compete, to provide coverage. And so that's what we're going to do with the agency.
I have to ask you just about mergers and acquisitions, consolidation in the industry, and not necessarily just consolidation, but the idea of strategic partnerships and other things that in the past, not only under the Biden administration, but even under previous administrations on the Republican side, have maybe found, I won't say a roadblock, but maybe let's say a road bump, a speed bump, if you will, in getting those things done. What type of assurances can you give the industry that if they do find a need and a desire for those types of strategic partnerships and acquisitions, that the FCC won't stand in the way?
Yeah, we're certainly open for business. We're talking to lots of providers. We have a number of deals before us right now. One thing that I've said to everybody, though, is if you have invidious forms of DEI discrimination, that's something that I think you need to get the House in order before you come to the FCC for an approval. That's one of the gating criteria that I've been looking at. But we are, open for business. We want investment. President Trump wants companies building in America, investing in America, and we're going to play our part.
Paramount, CBS, that deal, what can we expect?
We're running our normal course process on that. Again, we probably have 3 or 4 big multi-billion-dollar deals at the FCC right now. We're working through all of them. We cleared one smaller telecom deal earlier this year. It usually takes about 180 days to get through these deals. We're about 100 days into the Trump administration.
What's really the sticking point, though, at this point?
At this point, we're just running our normal course process, whether it's the CBS deal, we have a Verizon Frontier transaction before us, we have a T-Mobile US Cellular. We're just getting our teams crunching on all the deals right now, and it's just normal course.
All right, so no timeline?
Yeah, no timeline to announce here, unfortunately.
All right, listen, we appreciate it. We know you're a busy man. Thank you so much.
Thanks.
Really appreciate it. FCC Chair Brendan Carr joining us here at Milken. All right, I think we're going back to Bonnie. Some earnings certainly here after the closing bell, wrapping up the trade. Bonnie, all yours.
Exactly, Carol. Yeah, we had a mixed bag of earnings, in fact, and also a mixed bag of after-hours movers. So Ford pulling its guidance, seeing a $1.5 billion hit from President Trump's tariffs, and it suspended its full-year guidance, citing 7 factors, including supply chain disruption. But it did say it'll provide an updated outlook when it reports Q2 earnings, and that its tariff exposure isn't as bad as some of its Detroit competitors. And Ford shares in after-hours trading down about almost 3% now. They had been higher for a moment. Palantir, another one, of course, it's had a huge run. It's up almost 400% year over year. It raised its full-year revenue forecast and reported quarterly sales that beat estimates, calling demand for AI software a, quote, ravenous whirlwind. I'm not sure how they put those two words together, but that's certainly helping the shares of Palantir for a time after hours, although I will say they are also down now in the aftermarket. We made it to a 10th day, but not a 10th day of gains, Romaine. It was the first day in 10 where we saw the market lower.
Democracy.
All right, welcome back to the Milken Stage. Romaine Bostic here with Carol Massar. And of course, we talk about the big market ructions that we had coming in March. And of course, at the start of April, this idea that America had lost its exceptionalism.
Yeah, the Sell America concept, right? Gripping markets last month. It's left a potentially lasting dent in global investor sentiment. It really has been a shift from how we started the year here in 2025.
Yeah, and not only that, but I mean, a lot of people are now looking at our budget situation here, and they're talking about whether they actually want to hold the U.S. government's longest maturity debt, which of course is a big mainstay in our debt financing. And while much has been made about tariff talk contributing to the recent market plunge, let's talk about was the impact on investor psyches of a pre-existing financial situation, and that is our national debt. 120% of GDP, Carol Massar.
Yes, it's a lot.
That's a lot. And it's forced the Treasury to spend more on interest payments than on Medicare and the military. First time that's happened. Joining us now to talk about that, AI, and everything in between is Neil Ferguson. He's senior fellow at the Hoover Institution and really one of the foremost political analysts and economic historians out there. Great to have you here, Neil.
Great to be with you, Romaine.
We got to start with the budget. We just had Philip Swagel of the Congressional Budget Office on a little bit earlier. We were talking with some of the White House administrative folks about where we go next when it comes to servicing debt. When I hear 120% GDP, and I think to myself, that cannot be sustainable. I know we're the U.S. I know we're, in theory, supposed to be the only shop on earth. But at what point do you reach that breaking point where investors, particularly global investors, say they can't deal with that?
Well, I don't think it's the debt to GDP ratio you need to focus on. Right at the beginning of the year, I published a piece in which I set out Ferguson's Law. And Ferguson's Law, which is actually not named after me, but another Ferguson, says that if you're spending more on interest payments than on defense, you're not going to be a great power for much longer. And we crossed that threshold last year, and it's only going to get worse. The Congressional Budget Office knows it. If you look closely at their long-run forecasts, we could be spending twice as much on interest payments within 20 years as on defense. That's not sustainable, and I think that is still the president's biggest problem. And in many ways, all the arguments about tariffs are a bit of a distraction from that reality.
There's one data point that really just jumped out at me when it comes to this idea of spending more to service our debt than on Medicare, on the military as well. Just 2 years ago, that ranked number 7th, our interest payments, in terms of our obligations. It's now number 1. There's an old colleague of mine used to always talk about the rate of change being what really spooks markets rather than the aggregate level. Should we be spooked?
Well, I think we had a kind of respite because of the age of quantitative easing and zero interest rates in the wake of the financial crisis. Now, when rates are practically zero, and of course the government is regarded as the safest borrower, then you can run up debt without feeling the pain in your debt service. Everybody knows this. Everybody with a mortgage knows this. When the rates go up, it suddenly looks a lot different. And that's what just happened to the U.S. government because the term structure of the debt was relatively short. And that has meant that as the Fed raised rates belatedly in response to the inflation we saw after 2021, the federal government had to pay the higher rates on a rising share of its total debt. And the problem is that if you're running a deficit, an annual deficit north of 6% of GDP, even at full employment, that deficit is adding to the total debt, even as your interest payments are going up. And this is the kind of debt spiral that if we were an emerging market would be causing investors to rush for the exits. We're the United States, and I remember saying at the beginning of the year, if you're a superpower, you got a certain amount of slack that gets cut to you by investors. And Britain showed this in its history when it was number 1. Britain had very large debt GDP ratios after the Napoleonic Wars, after World War I, and was able to bring those debts under control. For the United States, it's now that same situation Britain was in the 1930s, when its debt was very large, but its international commitments were also very large. And if you're up against China, Russia, Iran, North Korea, it's very hard for you to cut defense. So what are you going to cut? You can't cut Social Security because the president spends that off. You can't cut Medicare. So you might try and have a go at Medicaid. Good luck with that in the House and in the Senate. It's a very difficult problem. What are you going to cut?
So let's go there, Neil. So tough times call for tough solutions. What does this administration, every administration that's been kicking the can down the road, what does this administration then really need to do to make a difference? Because we're talking about spending a lot on defense and some other things.
And there's another problem, which Secretary Besson alluded to this morning. There's a great, big, beautiful tax bill coming, which is going to extend the tax cuts to 2017 and add some additional tax cuts on top of that. Now, true, the tariffs are bringing in some money. 100 billion here, 100 billion there. It's not trivial money, but here's the big problem. If the economy slows or even goes into recession, as some eminent economists that you know fear it may, the deficit is going to blow out. We're going to end up with a larger deficit than on Joe Biden's watch, the way things are going this year. And that would be my secret fear as if I were Treasury Secretary. This is not going to look great.
What does it look like?
So Secretary Besson's story is that we're going to have the benefit of a weaker dollar, because that's part of the negotiation that is going on. People talk, I think, somewhat casually about a Mar-a-Lago Accord, but it's the 1985 model, where you kind of get a weaker dollar, your trading partners appreciate their currencies, and you get a benefit there. Interest rates, of course, came down in the mid-80s. Paul Volcker was able to cut rates then because inflation had been slain as a problem. The nightmare scenario for policymakers in Washington today is you get the weaker dollar. I think that's coming, and indeed it's already begun. But what if rates don't come down? They have not really come down meaningfully at the 10-year.
I'm curious, with the Mar-a-Lago Accord, I mean, what will we be paying on 100-year debt or whatever the plan might actually be, because there's no guarantee that's going to be 0 or 1%.
Well, when Stephen Myron, now at the Council of Economic Advisors, published his paper, it was a kind of fascinating tale where we were going to get tariffs, but they were going to be gradually phased in. Then we were going to get a weaker dollar somehow or other. Remember, it takes two to tango. The other countries have to accept a stronger currency. Right. But we were also going to tax foreign bondholders. Now, I remember reading that part of the plan and thinking, wait, what? There's another word for that. It's called default. So I never entirely bought Myron's argument, and I think the Mar-a-Lago Accord is full of risk from the vantage point of the United States creditworthiness. And I really hope that the people in the administration tread warily here. Yeah, you could get 1985, weak dollar, lower rates, economy rips. But you could get the 1970s if you get it wrong, where you get a weak dollar, but rates don't come down because there's an inflation problem. And then the stock market is not going to look pretty.
10 seconds. Is now the time to do something? Otherwise it gets almost like a point of no return?
I think they did something, Carol. I think they did something, which was to start a trade war. And now somebody, somewhere, somehow has to end that trade war fast, or we're looking at higher probability of recession, and that's going to blow the deficit out and make the debt look a whole lot worse.
Yeah, Ferguson, thank you so much.
My pleasure.
A little depressing.
Yeah.
A little scary.
Don't shoot the messenger.
I'm not shooting the messenger. Appreciate the reality check. Senior fellow at the Hoover Institution. All right, back to Bonnie. She's in our New York studios. Hey, Bonnie.
Hey, Carol, thank you. Yeah, raft of earnings after the close. We are waiting on many of those conference calls, but those stocks are lower in after-hours trading for the most part. We have Diamondback Energy, which beats on adjusted EPS, but it's cutting its full-year activity due to oil price volatility. It's dialing back CapEx, and it sees full-year production lower than it did before. That stock is lower. Ford is lower. It's pulling its guidance, seeing $1.5 billion worth of a hit from the tariffs. It cited 7 factors, including supply chain disruption. It did say, though, it won't be as badly affected as some of its Detroit competitors, because 80% of what it produces is produced in the United States. And it does estimate full-year revenue higher than the previous forecast, but that's not helping the shares after hours. Clorox also seeing consumers pulling back on spending. It still sees full-year organic sales up 4 to 5%, but that's a little lower than the estimate, and its adjusted earnings also did not beat. It missed the estimate. And Palantir, now it gave a very rosy outlook. It called AI demand ravenous. It called it a whirlwind. It gave its full-year forecast, which was higher than the previous forecast, and it beat estimates, but it's also down almost 5%, albeit after a nearly 400% gain year over year. Back to the Milken Institute Global Conference in Beverly Hills, California, and Romaine Bostic. Romaine.
All right, one of the great things, of course, about this conference is the folks walking around really do have their pulse on what's going on in the economy and in the broader business world. One of those firms, of course, is Oak Hill Advisors, by virtue of their business of directly financing middle market companies or investing in high-yield bonds and other credit strategies. They really do have a great lens into really what's going on. And we're going to talk about that right now, because I'm pleased to say joining us right now is Glenn August. He's the founder and CEO of Oak Hill, which has almost $90 billion under management. Cross-performing, distress, credit, related, everything in between.
We got everything.
I was keeping quiet because we wanted to hear from you.
Okay, don't tell me what we got. It's great.
Big footprint in North America.
Yes.
You have a big presence in Europe.
Yes, we do.
Are you seeing any sort of tension between those two when it comes to investment opportunities?
Look, I think there's opportunities in both places. Yeah. Clearly, we're going through a shock in the economy with the proposed tariffs, but I'm a big believer in America. I'm a big believer in the opportunities here, and also a big believer in the European opportunity. The capital markets are not as developed in Europe, and so there's great opportunity there. And in the U.S. market, there's still a need for capital in private equity across the leveraged finance market. There's an enormous amount of capital that wants to get deployed and get exposure. And so we're there to help our investors achieve their goals and help companies get the capital that they need.
Is the environment right now, when you do that, or do you wait for a little bit more stability?
So we have a range of capital. We have liquid, performing, private, stressed and distressed. At all times, we want to pick credits, pick good companies, pick appropriate places in the capital structure where we think we're getting paid. I will tell you that this volatility, by and large, is a good opportunity for us to differentiate ourselves, because not all companies are the same. It's not just about what's the leverage ratio and how much debt to EBITDA there is. It's understanding the business, the company, and for 38 years now I've been doing this, we take a private equity approach to credit. So it really is about understanding. When there's this kind of vol, there's definitely more opportunity to differentiate ourselves.
So is it unlike any other cycle, though, in terms of the level of volatility? Like, do you think about something historically? You, again, have seen many cycles, and I'm just curious, does this remind you of a certain time?
So
this
it's
is very
interesting.
different?
So look, this cycle is different. This has been, you know, we had the COVID period of 5 years of shock, enormous stimulus, enormous amount of liquidity, and then a change in administration, but we have $37 trillion of debt. And so this time is different. What's also different is there's not the forced sellers that there were in previous crises. So in 2008, there was enormous leverage in the system, and there was a big unwind of that leverage trade. This time, when I look across what we do in the leverage loan market, the CLO market controls 70% of all syndicated loans, and that's locked up without mark-to-market financing. The high-yield market is over 50% double B, so you're not seeing forced selling there. And the private credit market, which has emerged as a giant business for us and so much of the conversation this conference, that capital is generally held by large sovereign wealth funds, large pension funds, longer-term investors.
So they're fine.
And so the capital is there, and while there's definitely going to be some idiosyncratic opportunity from this volatility, there's enough capital there to do bilateral negotiations. So I don't see forced selling in any way. I also don't see this time the typical policy responses to other shocks. If you go back over the 30-plus years, 38 years, every time there was a shock to the system, the Fed would open up the gates of liquidity, and then there'd be fiscal stimulus. This time, we don't see that. This time, it's going to be working out the idiosyncratic challenges company by company, which, again, is great for people that have the skill set.
So you agree that the Fed should not be doing anything? That's a good thing.
Well, my view is the Fed should be patient. I think that you don't want to make the policy mistake of cutting too early. I believe that Powell and the Fed is sitting there ready, willing, and able if there is a need. The market has been swinging back and forth on how many Fed cuts there would be this year. Today, we're at 3 cuts through the end of the year. I think 2 to 3 is a reasonable number, but we're all sitting here today. The biggest question is whether or not the shock to the system and how quickly we wrap up tariff negotiations, and will that cause a slowdown, a recession, or will we just get through it pretty quickly?
I understand the argument for the Fed to stay patient, but what about the communication in between? Because we have seen at least consumers' expectations of inflation really skyrocket, and I do wonder, does the Fed need to address that?
So I will tell you that if you just make your policy decisions based on consumer expectations, that's not so good. If you go back, I laugh to myself, and not because it's any ill intentions, but if you go back into the late 90s, people thought stocks were going to go up 25% forever. Okay, so really the question is the data. Inflation has been coming down. Energy prices coming down is a big positive for the economy. And the real question here is, will we see demand destruction because of uncertainty, or demand pausing that then ultimately creates some slowdown? Or will we see some tariff deals that make some progress, that give people the confidence that we can get this thing going on the right track?
But if you start to see a deterioration in how consumers view things, even if that view might be flawed, I do wonder when it gets to the point where it becomes real.
Don't misunderstand me. I care immensely about how consumers feel, consumer confidence, but consumers, individuals saying what are inflation expectations going to be a year out is not where I'd focus on. So yes, I certainly share the view that to the extent the consumer is concerned, to the extent that corporates are concerned because they don't know what the policies are going to be in effect, that does run the risk of a slowdown. That being said, the Fed has immense power and tools to basically cut rates, and we'll see where we
go. I just think that I'd be patient because we don't know the ripples from inflation on the tariff side, and we don't know how much supply, is going to be cut back as well.
You start talking about government debt, fiscal situation. I feel like we are at a conference where that is constantly coming up. How closely are you watching, and what are you concerned about that we don't get this right?
Look, $37 trillion of debt's a lot of debt, and yet I still am a big believer in America, and all the narrative is America exceptionalism over with. I do not believe that to be the case. I believe it's still an incredibly safe place to invest, especially given the choices in the world. I would like to see some efforts at keeping the debt, taking the debt down, which does not seem very likely anytime soon. But it's also the reason why I don't think we'll get fiscal stimulus, because we don't have the money to do that. Now, again, we'll see what happens on tax policy. We'll see what happens on deregulation. I think the U.S. Treasury market is in perfectly solid shape today. There is risk, however, that rates could spike if, in fact, there's a buying strike. But I also think the Fed has the ability to take action in that course as well. So, again, I think it's all opportunity. We're in this period of uncertainty, and bringing all of the things we've done over years is what we're trying to do.
Every time you say uncertainty, you got to take a drink, Glenn, thank you.
Thank you. Good to see you.
Really enjoyed it.
Thank you.
Glenn August, he's Oak Hill, founder and CEO.
Don't start drinking just yet, Carol. I know you and Tim. This is
No. Not on air. Not on air. All right, back to Bonnie Quinn. She's back at Bloomberg headquarters in New York City. Bonnie.
Well, just wait for it, because it looks like tomorrow might be another down session, Carol, so you may just need that drink tomorrow, because obviously we saw the first down session in 10 today, and with the earnings that we got after hours and the action that we're seeing in those stocks after hours, we could be looking at another down day tomorrow. So the Dow today finished down 0.25%, the S&P down 0.2%, the Nasdaq 100 down 0.2%. Let's take Palantir as an example. Now, granted, it is up nearly 400% year over year, but it did raise its full-year revenue forecast and reported quarterly sales that beat estimates, and yet the stock is sinking, as you can see, down 7.5%, in spite of the company calling AI demand ravenous, and in spite of it saying that it had closed several deals in the first quarter, and it anticipated deals of at least $10 million for those to have been numbering 31 deals. Clorox also seeing consumers pulling back on spending, and Ford suspending its full-year guidance as well on those tariffs, Carol.
Everybody, we are back here at Milken. Carol Master along with Romaine Bostic. Now, Prudential recently released its first quarter results just last week, reporting operating earnings of $3.29 a share, beating consensus expectations of $3.16 from analysts surveyed by Bloomberg. Now, it was a beat. It was a big deal. A very big deal, as Prudential has missed Wall Street's average estimates on its operating earnings per share in 5 of the past 8 quarter shares. Of the nearly $36.7 billion market cap company, they've got about $1.5 trillion in assets under management, still down roughly 12% year to date after check at the close today. But the stock did rally at one point on the earnings news, and it did, though, end that day off about 1%. So investors kind of going back and forth. But we've got a great guest here to talk about the company, the environment, is the CEO of Prudential Financial. He is Andy Sullivan joining us here at Milken. Nice to have you here. This was a big quarter, and you made a commitment going forward. Tell us about that.
Yeah, so thank you for having me, and thank you for recognizing the good quarter. At the end of the day, it's always good to have a beat, and it was in the context of not many firms in our space had a beat. The underlying fundamentals were strong in the quarter, but that said, the reason I said what I said is we have so much more opportunity as a firm. When I look at our underlying capabilities, our people, our brand, and then the long-term tailwinds that our business mix positions us for, retirement and private credit, we can do more, and we can deliver more for our stakeholders.
You did say on the call, and you told Bloomberg, we've deployed capital as a company and not produced the return that we promised and communicated on public calls to our shareholders. That must change. How do you get there, and how long does it take you to kind of consistently provide the earnings picture that you'd like to present to investors?
Yeah, well, so there's two sides to this, right? There's the organic side, and then there's the inorganic side. On the organic side, I'm a big believer. You say what you're going to do. You have an expected return level for the organic capital we deploy, and then it's about executing and executing well. A lot of that is about focus and making sure we're not spread too thinly as a company.
Where were you spread too thinly, Andy?
We were over the past 5 years, we've exited a number of international markets. We now have a portfolio of, we're in the markets we want to be in. We're in the largest retirement insurance and asset management markets in the world, but we were in too many markets and we were subscale. And unfortunately, you can look at that and say, well, that's not a big deal. There's not that much capital deployed, but it's a management focus issue.
Right.
So it's funny, I mean, you bring that up. And a little bit earlier, we were speaking with the CEO of Ventas, and we were kind of talking about the aging of the population and shifting demographics. And prior to your being named CEO, I know there was a lot of talk at Prudential about leaning deeper into that with regards to the potential for retirement income to be a major growth driver. Is that still the case under your leadership?
Oh, absolutely. It's probably our best growth driver in the company. You know, whether you're talking about in the United States where we're at, we call peak 65, where 11,000 people are retiring every single day. You know, a lot of work has been done on accumulation in the U.S. market, but not as much work on how to help people with protected income and decumulation. That's why I think you see this convergence of asset management and insurance, in particular in the annuity space, because there's such an opportunity, there's such a large gap in the market. But it's not just a U.S. issue. We're a major insurer in Japan. Obviously, with the aging demographic there and the fact that those citizens have almost most of their assets in the banks, they need the exact same help.
With regards to the relationships you have with the pension funds and these and the deals that you make with them, are they offloading the risk to Prudential? Are you absorbing that risk?
Could you clarify the question, please?
With regards to some of the annuities and as well as some of the assets being... Okay, go ahead.
So we're actually a primary writer of the annuities product. You may be referring to, we've expanded our capabilities with a reinsurance capability. Really what that's about is we need to bring additional capital to the space. You know, if you're just looking at the mutual insurers or the public insurers, there's not enough capital to back the liabilities that really need to be put into the market to provide that level of protected income. So a lot of what you see is about bringing capital into the space.
I want to ask you about your asset management business, PGIM in particular. You guys reported net inflows of about $4.3 billion in the first quarter. We're now fairly into the second quarter. How are things looking right now?
Well, I will say that the volatility has an effect, right? When you have policy uncertainty and it creates volatility, business decision makers and individuals start to slow up on their decision making. We saw that in the month of March, and we've seen that continue into the second quarter. You know, from an institutional number of transactions perspective, so we're the third largest real estate company in the world. We were on this nice trajectory of recovering from the lows of real estate, but what we saw in March and into the second quarter is a slowdown now in transactions.
How long do you expect that to continue? And I know it is based on, we're all like the trillion-dollar question in terms of what we expect. Do you feel like things are settling down in terms of what we are hearing, the cues from the White House?
Well, I would say, you know, from the conversation this morning with the Treasury Secretary, you know, it is about when do we see these first tariff deals come into place. You know, I'm not going to be able or here to predict when that is, but what we're hearing from our clients is they want to stay invested and they would want to stay leaned in. So whether that's months or quarters is hard to say.
All right, Andy, really appreciate you being here. Everyone talks about just how much energy and the new perspective that you're bringing to the company. Really wish you the best.
Well, thank you. I appreciate your time.
Andy Sullivan is the CEO of Prudential Financial. Let's toss it back to New York and Bonnie Quinn.
Romaine, thanks. I just want to bring you up to speed on earnings after the bell. Many of these stocks are lower now, including Palantir, which is off its lows, but nevertheless down quite substantially. This after a down day, the first in 10 on Wall Street. We saw selling into the close before those headlines. So the S&P 500 was down 0.6%, for example. The NASDAQ 100 the same. The Dow, which has spent most of the day higher, was down about 0.25% as we finished out the session. Now, Palantir raised its full-year revenue forecast and beat estimates, but that stock sank after hours. We'll see what happens on the call, but it did call AI demand ravenous. But then we have a couple of companies that are pulling their guidance, and they include Ford, which sees a $1.5 billion hit from President Trump's tariffs. It said it would give a better idea of an update for its second quarter earnings report. Mattel, another one, pulling its 2025 outlook on tariff-related uncertainties. Mattel saying it's taking price action in the United States. but it's also trying to accelerate diversification of its supply chain. And then we're also seeing Clorox down in the after hours. It's seeing consumers pulling back on spending. It now sees full-year organic sales up still, just 4 to 5%, though. The estimate was for that to grow more than 5%, and its reported adjusted earnings per share for the quarter also missed estimates. The estimate was for $1.57. It came in at $1.45. I just want to come back to Diamondback as well, because it also beat, but it cut its whole year activity estimate due to oil price volatility, and it's cutting back its CapEx forecast as well. It has seen much more CapEx activity in the year. That's now not going to happen, and it sees full year production between 857 and 900 million barrels per day, but that's much pulled back from its previous guidance. So once again, all of those stocks are actually falling in the after hours, but we might get more on those conference calls, because we are seeing futures on the NASDAQ and futures on the S&P 500 trading lower. But if we get a turnaround in sentiment, let's say, we might see that change. Also, if we get some headlines on trade, that's what the market seems to be waiting for. Again, we had 9 up days. We started another Monday on a down note after today's session. Again, the Dow down 0.25%, the S&P down 0.2%. Yields steepening the curve, but not really going anywhere to that extent. We saw the 10-year rise almost 4 basis points in the session. We saw the 2-year rise as well, but only just by a little bit more than a basis point. We did see gold put on some weight, if you like, as well, up almost 3%, 3,333, which is an easy one to remember per ounce. Bitcoin was lower all session. It came off those lows. It's still trading above $94,000 a coin, but just barely. Let's get back now to the Milken Institute Global Conference in Beverly Hills, California, and Carol Massar. Carol.
All right, Bonnie, thank you so much. Carol Massar along with Romaine Bostic here at Milken in Beverly Hills. Right now we've got David Rubenstein, Carlyle Group co-chairman, co-founder and host, of course, of the David Rubenstein Show, peer-to-peer conversations, appearing on Bloomberg. He's also principal owner of Major League Baseball's Baltimore Orioles. We always like to point that out. David, this is an interesting event, always. You've been here several times.
It's impossible to hear you from where you are. I'm sorry, I just can't hear you.
Oh, okay.
Oh, my God.
Maybe you can hear Romaine.
It is so loud here.
It is loud.
And, we've been doing this all day. Okay. You come up here,
right,
and you're the only person we want to talk to, because no, in all seriousness, though, David, we want to know what you think about some of the comments that we heard from Scott Bessent earlier today and his message to investors. Did that message resonate with you?
I think he did a very good job.
Yeah.
Obviously, the business people have been concerned about tariffs and not knowing where it's going to go. He came out and basically more or less repeated what he had said in the Wall Street Journal article today, which is there are 3 elements of the economic program. One is tariffs, the other is tax cuts, the other is deregulation. And I think he did a really good job of explaining why all 3 mesh together. Now, they have to get these things done, but if they can get the tax cut through, they can get the deregulation they want through, I think the business community will be reasonably happy. The tariffs is still a bit of a problem for the business community because they don't fully understand what the end game is. But I think Scott Bessent did a pretty good job.
Obviously, Carlyle has a huge presence in Washington. You know how that city works. The business-friendly administration that was promised during the campaign, is that still intact, or is that still going to show up?
I think the business community, by and large, is willing to give the Trump administration the benefit of the doubt, because the business community, to the extent that business people tend to be CEOs and I'd say investors and Republican perhaps, they want to have this administration succeed. They're a little bit confused about the tariffs, but I think they're willing to give the benefit of the doubt to the administration. Now, the tax cut bill is what people are focused on, and I will interview on a Bloomberg show soon the chairman of the House Ways and Means Committee, Jason Smith. And they are getting ready to have hearings and mark up that bill. And whether that bill goes in the direction the business committee wants, we don't know. But I think tax cuts are what the administration thinks is going to happen. The question is, can you really afford it?
Well, that's what I want to ask you, David. Can we afford, with the deficit, the $37 trillion deficit?
You can afford it if you, depends on how you massage the numbers. There's a $4 trillion number that they haven't figured out how to deal with yet, which is to say they want to make certain tax tax cuts permanent, but not count the $4 trillion as part of the deficit. That's an unusual thing to do. Maybe they can get away with it. I don't know.
Are the people you're talking to, though, whether it's on your shows, on Bloomberg, whether it's privately with regards to your business, are they still optimistic?
Business people, by and large, tend to be optimistic by nature. They generally think things are going to be better than things are not going to be good. So I think people are hoping that the administration can get the tax cut bill through, the deregulation through. They hope that somebody can come along and get some of these tariffs agreements agreed to. I think Scott Bessent is a really smart guy. I think he's done a pretty good job so far representing the administration. I think he's their best voice on the economy by far.
Has anyone approached you about being involved in this administration, whether in a formal or informal role?
I think that's not likely. This administration fired me from being chairman of the Kennedy Center, so I think probably I'm not the first choice. But no, I think my days of being in government are probably behind us.
All right, David, really appreciate you stopping by.
My pleasure. Thanks a lot.
Here. David,
okay, fine.
You're a good sport.
Thank you.
Thank you so much.
Carlyle Group co-founder and co-chairman, also, of course, the host of the show Peer-to-Peer Conversations right here on Bloomberg Television. And you don't want to miss that. Actually, this latest show, Bloomberg Wealth, Season 5, that premieres tomorrow evening.
At 9 p.m.
9 p.m. New York. What time is that here in L.A.? That's
Bloomberg
6 p.m.
Television. Very nice.
Thank you.
Nice math on your part.
I do math on the fly here, and there you see it. Stephen Tannenbaum, a legend, of course, in the space over at Golden Tree Asset Management.
Yep, love the conversations. I love when David goes personal and kind of digs into a person and kind of their life and what they do. It's always fun. Hey, listen, folks, we're going to toss it back to Vonnie Quinn. She's at Bloomberg headquarters in New York City.
Well, Carol, it might still feel like lunchtime there, but it is 50 minutes past the closing bell here in New York, and we did see a down session, another Monday down session. That said, we have had 9 up sessions for the S&P 500. That streak broken today, particularly in the last few minutes where we saw some selling into the close. That index ending the session down almost 2/3%. The broader NASDAQ was down 0.75%, the NASDAQ 100 down 2/3%, and even the Dow, which did spend a lot of the session in the green, down 0.25%. Now, we'll wait for some earnings calls, but certainly earnings announcements after the close would bode ill for tomorrow's session as well. Many of those stocks are down after hours. Let's start with Ford and Mattel, because both of those companies pulled their guidance for the year. Ford seeing a $1.5 billion hit from President Trump's tariffs. Again, suspending its full-year guidance, it did say it'll provide an updated outlook when it reports Q2 earnings, and also in some kind of effort to give the market some hopes that its tariff exposure is less than its Detroit competitors. That's not helping the stock after hours. It's down 2.5%. Its full-year revenue forecast is $3.89 billion to $3.9 billion, and that was higher than the previous forecast. Mattel, meanwhile, also passing its tariff-related uncertainty outlook onto investors today, and Clorox was another one seeing consumers pulling back on spending. So let's get it back now to Beverly Hills, California, the Milken Institute Conference, and Carol Masser. Carol.
All right, Vonnie, thanks so much. Well, the majority of private equity investors, they see South Africa and Kenya as their top investment destinations over the next 3 years, even as President Trump's tariff chaos muddies fundraising outlook for the continent in 2025. This is according to the African Private Capital Association. We've got a great voice who can give us an update on really what's happening today on the content. We welcome Sapiti Morangmong. She is Chief Operating Officer for Africa 50, and she took over that spot in 2021, July of 2021. How are you? Talk to us about since then and the current time period, how it compares and how stressful it is.
So it is stressful, but I think everybody's facing the global uncertainty. And the question is, how do we as an industry, how do we as a continent respond to it? And I think for us as Africans, as governments, as private equity in the industry, we need to figure out what is it that we do? How do we respond? Importantly, I think it's time for us to control our narrative and importantly, our future. Right? We've seen this through the COVID pandemic. One would have thought that would be a wake-up call for our economies, for our countries to say, how is it that we really take control of our future?
Is there a better opportunity to do that now, given some of the disruptions that we're seeing coming out of the U.S., kind of upending that sort of global order, if you will? Does that create an opportunity for you?
It completely creates an opportunity, but I think the opportunity was there. But I think think what this means is for domestic capital to be able to tap into that, because currently there's very little, about 1.5% of local domestic capital that's going into infrastructure investing on the continent. So the question is, how do we harness the $2.3 trillion of assets under management by pension funds, by asset managers, to deploy it into infrastructure? We know that the gap, the infrastructure financing gap on the continent is about $100 billion annually. So just 5% of that is really the panache.
Why aren't they deploying it already? If they see the opportunity, they get it. Why isn't it happening?
I think to a certain extent is not understanding the asset class, because I think you've seen that transition across Europe, across the US many years ago. That's still the alternative asset class on the continent is still not well understood. So it behooves us as private equity players, as infrastructure players, to do that education. That being said, we're seeing that transition happening. Just 2 years ago, as Africa 50, which is the infrastructure fund for which I work for, we were able to get 20 institutional African investors to come into a fund that we're raising, an infrastructure fund we're raising, an Africa First. So this is something that we're really excited about.
Are we going to see more continental integration, particularly when it comes to economic activity and trade? I saw an interesting statistic that showed the amount of trade amongst African nations relative to what we see in Latin America, relative to what we see in Asia. It was a fraction of what we see in those regions.
Romain, that's a brilliant question, because currently there's only 13% inter-African trade on the continent. That's completely paltry, as you rightly said, as compared to other regions. So this, to me, will really force us as Africa to look at intra-Africa trade through the Africa Continental Free Trade Area. This is a trading area of 1.3, 1.4 billion people. It makes a lot of sense as a continent that that's what we should be focusing on to reduce the supply chains.
Are people here receptive to that message here at Milken?
Oh, for sure. I think it's to me, this is a message that we've been talking about. I think the current disruption is going to accelerate that. The current disruption is going to make sure that we look internally, especially with what we're seeing and the policy pronouncements that have been made.
All right, Sabina, we have to leave it there. Really appreciate you
Thank
coming
you so
by.
much for your
Sabina
time.
Moramong, Africa 50 Chief Operating Officer.
Great way to end right on this Monday. I think what a great way to wrap up. Hey,
All right,
listen,
our coverage continues tomorrow. A lot more current conversations coming up, including with the PIMCO CEO Manny Roman, Oaktree co-CEO Armin Panosium, and Guggenheim Partners co-president Dina De Laurentiis.
Bringing you the latest news in private markets whenever and wherever it happens. I'm Kriti Gupta in the south of France, and this is Bloomberg.
Earnings season is here.
Earnings season begins. Is corporate America in a good place?
Wall Street is bracing.
Bloomberg is first to break the numbers.
We got Delta, Constellation Brands.
The wave of big tech earnings.
We've seen a re-rating of earnings estimates.
I got to pay special attention to all this.
With the smartest insights.
Given the degree of uncertainty, you haven't really cut earnings estimates that much.
Anyone who says they have certainty on where the growth outlook is going, where earnings are going, is probably exaggerating.
Continuing coverage on Bloomberg.
When you're talking about retirement, it doesn't matter if you are in rural America, urban, suburban. It's not a blue state, it's not a red state issue. It absolutely is an American issue that we can all relate to. And so I am optimistic. And the reason why I'm optimistic is that the policy that we have been able to achieve over many years as an industry have been bipartisan. It did not matter who was in office. We're looking forward to engaging with the new administration and talking about how do we continue to make sure that more Americans can have access to a secure retirement, and how do we make sure that by doing that, that can put less burden on Social Security. By doing that, that puts more money to work so that the caregivers, children are not having to carry that burden. And so I do think that it will continue to be a bipartisan issue, and it is so important. We cannot close this retirement gap without private-public partnership.
We're micro investors. So as micro investors looking to invest capital, whether it's in private equity or in direct lending, what we're looking for are opportunities to deploy capital at attractive risk return. When we wake up in the morning, we don't seek to avoid risk. We seek to price it correctly. And so in an environment like this, for sure, if you're looking at a portfolio company opportunity, when you think of the value creation plan, you're factoring in now the uncertainty, which undoubtedly will impact the extent to which you're willing to pay for that asset. Now, in our existing companies, in our existing portfolio, the vast majority are services company. And services companies don't have basically the input issues. But I will say that when we look and we roll up all this data for all of our portfolio companies, and it's quite rich, it's just down now below 1 million employees globally around the world. We're 2,300 at Carlyle itself. But in our portfolio companies, we roll up this data every month. For example, the inventory component of PMI was up about 4 points. I know that's not really news that anybody probably would have focused on, but we could see that happening months ago. So immediately when it looked like the new administration was going to come in and there was the possibility of tariffs, you could see purchasing managers immediately mobilizing to start bringing goods in faster because of the uncertainty factor.
In case you missed it on the opening trade.
How big a headwind is that going to be to my performance over the next 6 months, next 12 months? That dollar story, that dollar factor, that FX overlay.
Yeah, I don't think you can overstate the importance of this dollar shift. As we start to see a convergence of relative economic and profit growth rates, you are starting to see some of that overvaluation unwind, and it's shifting portfolio flows as well.
Don't miss the opening trade live every weekday.
From the world of politics to the world of business, this is Balance of Power